And so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Should they worry about $90 crude if it's just a supply shock? Should they worry about that?
They should. I mean, otherwise they're going to repeat the same mistakes they made in 2022. In some cases, prices were falling, energy. Services were inflating, but if you wait long enough, services will start to disinflate as well. And the fear was that goods would start inflating. Now we're seeing goods are going to start to inflate. And that's, I suspect, will keep people up.
That was Mohammed Al-Arian of Queen's College, Cambridge, speaking to me on Friday on the impact of higher oil, potentially for the Federal Reserve, which meets on Wednesday. Crude this morning, 91.45. Brent crude having a little sniff of 95. This is stuff we haven't seen, Tom, for all of this year through 2023. And crude is at the heart of everything, I think, right now that we're talking about.
Three of us got together. We almost never see each other, folks, because of the crazy New York schedule. And to have a full English, all three of us, was really something here. This morning. And
okay,
Jen,
let me cut in. Headline. I come downstairs today. TK's having a fruit bowl. It's a fruit bowl.
Yeah.
You were there for it.
Yeah,
I saw it.
There was witnesses.
That was new. What came before the fruit bowl is what I want to know.
The full English.
Okay, all right. Good to know, TK.
You nailed it, John. And to me, the lead story this morning for global Wall Street isn't happening. And the bond market is moving. It's fractional. We're all jaded by it. But nevertheless, the levels we're quoting, the real yield, Lisa, you mentioned 1.99. These are substantial numbers, and they change the dialogue of these three Fed meetings, particularly the one we're underplaying at 147 yen, which is Japan, the last one.
I like what Mohammed had to say, that this really speaks to this question of goods disinflation and goods reinflation because of petrol and how it influences everything in terms of getting things from one place to another, and transportation costs as well as production costs.
I'll ask the question that I asked Mohammed of you then, Lisa. Do you think it is something the Fed can ignore on Wednesday?
They can't ignore it. They're going to say it's transitory. But at a certain point, if they start to see goods reinflate, can they say that's transitory too? Can they say that that's manipulative? How can we know if we don't know whether the oil price is higher because of demand or simply because of the supply cuts?
What's the signal effect you get from the wage negotiations with UAW and the Detroit 3? TK, I think for a lot of people who have their annual wage negotiations, looking at what's happening in Detroit, kind of matters. They want a bigger share of that. Aren't they going to be more emboldened to go and ask for
Lisa was at Teterboro, Middletown, I can't remember which, getting on the Gulfstream, and she put out that chart on union, and it's really spiked up. I mean, it's back 10, 15 years to the angst we're seeing now, and I do agree it percolates, maybe is the right word. It percolates, like what the percolation of water you do to make hot brown water.
Okay. Do you want to explain what you think hot brown water is? You're calling tea hot brown water?
Well, I was watching, I watched Richmond this weekend. They got relegated, but I watched Richmond, and, And, you know, what was great was walking down the street in West Ham, people were walking by me, like to the
Where did you go?
ballpark. I was like...
To the ballpark?
Yeah, they're going to the
We're
ballpark.
going to stop this now. Brent crude 94.53, TK WTI 91.54.
Let us move on. Amrita Sen joins us to save us here from the ballpark, co-founder, head of research at Energy Aspects, and critically joins us this morning from Canada, which is an oil producer. Amrita, within your racket, within your industry, are they looking at this as a surge that can ebb, or is there a feeling, you know, within the macro petroleum business that this is a new pricing to stay?
Well, it's still early. It's not even 5 a.m. here, so I don't know how they're feeling. But if I had to guess, Tom, I would say they are all going to be very happy. I mean, of course, there's World Petroleum Congress over here. Ministers from all around the world are gathering, including Prince Abdulaziz himself. There's lots and lots of talks with both consumers and producer governments really over the next couple of days over here. And I think the reality is that demand has surprised to the upside, regardless of all the recessionary fears that we've seen. Right. And I think that's why what is interesting for me is, yes, crude is getting all the headlines now. We're talking about it. But if you look at products and crack spreads, that have already been high for the last few months. Gasoline, diesel, they've been trading at $120+ per barrel. Crude was 80. Now crude's catching up, but those prices haven't necessarily gone up further. So this is more of a redistribution between refiners and producers than really end users feeling the impact. So I know why the media is focusing on the crude, but I don't think the end user is necessarily seeing that big an impact versus a few months ago.
Right. What is the representation or tone of China as the marginal demand elephant in the room at the Congress? Is China there in a big way?
I think there is going to be presence for sure. And I think, again, the dichotomy between Chinese macro and Chinese oil demand is definitely going to come up, something we've been highlighting for some time now, because in the West, and Western analysts keep looking at the Chinese macro data and saying, well, oil demand hasn't been performing yet. Oil demand has actually been hitting record highs because it's become more consumer-oriented. Plus, China's got some strategic petroleum reserve filling going on as well. In some ways, the U.S. has been drawing it down last year, and China now is actually refilling it, having locked in some favorable prices earlier in the year.
What's the pressure on Prince Abdulaziz today, who's going to be speaking, I believe, around 10 a.m. Eastern time at the Calgary conference, to really increase production, especially if this is being driven in part by demand, not just their supply cuts?
Well, I think he's been very clear that, look, there still is a lot of uncertainty, be it from the Fed itself or even China, all the kind of noise that's coming around. And he has to be 1,000% confident, I would say, not even 100%, that there are not going to be any of these, surprises with the Fed, for instance. And it's a bit of a chicken and egg, right? If oil prices go up, what does the Fed do, as you guys have been talking about as well? But I think they are going to be cautious. They want to ensure that balances, or at least inventories, do not build because of those macro concerns. And look, Saudi Arabia has extended the cuts till year end. So has Russia. It kind of gives, for them, the main thing they want to provide is stability. And I think that's what he's trying to do. And I think that's what he's going to focus on today.
It's a really interesting confluence of events. At the United Nations, they're holding a conference right now where a lot of the focus is going to be on sustainable energy and moving away from fossil fuels. You have electric vehicles taking over. That is underpinning some of the discussions with the UAW. How much is that underpinning Saudi Arabia's decision to cut production, to get more profits now before some of these groups phase out fossil fuels, before they become less of a focus later on?
Well, you could argue that goes both ways, Lisa, right? I've also heard the argument that that's why other countries want to flood the market and make sure they don't have stranded assets afterwards. I don't think OPEC plus policy works like that. We've written about this as well, that ultimately Saudi Arabia and most OPEC countries are revenue optimizers, right? What they are trying to do for themselves is saying, okay, if this is the price and we cut production or raise production, what is our total revenue going to be? That is what they're focusing on right now. Of course, they're concerned about long-term energy transition, but I wouldn't even use the word concerned. I think they embrace it. They are doing a lot around it, and they very much are aware that oil has to fade over time. They just disagree with the timelines like the IEA has put out.
What's the Amaretto Cent timeline of an oil vector, I guess in June or July of 70-something up to 94.51 right now? Is that just a continued vector up? Do you see 95, 96, 97, et cetera, et cetera, et cetera?
Yeah, if you remember, Tom, our price forecast for Q4 was an average of $92 for Brent. So I think we've kind of hit it now. So the question is, but look, an average of 92 does allow oil prices to go to 100. We're putting out a piece later today, which is calling for $100 by Halloween for Brent. And again, this is just a trajectory. And at this point, look, of course, it's a short-term thing, right? I'm not saying it's going to average above 100, but could it go to $100 for a bit? Absolutely, yes.
The triple digit by Halloween, Amrita, is that just a marketing mechanism? Just, triple digits, Halloween, or is there something about the next month?
No, it just rhymes, right? 100 by Halloween. That's why. No, I'm joking. But it's just, no, I think, look, fundamentals are very, very strong right now, but also positioning. And that's one thing we shouldn't miss. A lot of hedge funds are very underpositioned in crude because of the macro concerns. Now we are seeing quite a bit of passive money come back as well. So I think the combination of that could actually lead to a temporary kind of upswing in crude. And that's why I'm not saying we're not expecting it to average above 100, but it could go above 100 in the next couple of weeks.
Only $5 away right now. Amrita, thank you. Amrita Sen of Energy Aspects. We'll run with that headline. $100 crude by Halloween, TK. It's just around a corner. It's hardly a call at the moment, is it?
Got to change my outfit for Halloween.
What are you going to wear?
I don't know.
A barrel of crude?
Yeah. I don't know. Go as a barrel. I like that idea.
We once joked we'd go as QE, TK, QT, and all of that good stuff, and now it's $100 crude.
I don't think this is a small idea. Javier Blas talking about Arab Light already there, and the way he looks at it, I don't understand it, but that's what he said. And
94.51 on Brent. I've just seen him out of the corner of my eye. Andrew Balls of PIMCO coming up next. Very cool. With us here in the studio, here in London. Live from London this morning. Good morning to you all. With equity futures slightly positive, this is Bloomberg.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
I've had the market analysis. We're going to go get straight to some breaking news.
We'll have a full roundup.
Going through some of the numbers.
And what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
In the middle of a massive exhibition center located on the western suburbs of Shanghai, where the annual car show is taking place. This is the first exhibition after the end of the COVID lockdown. We can feel a lot of excitement on the ground. Electric vehicle is going to be the new theme of the industry. Most of the European companies and Japanese car makers who are considered latecomers to the China EV party are, launching their EV products. They are making their foray, intensifying competition in the market. For example, Volkswagen yesterday debuting their ID.7, which is electric vehicle rivaling the likes of Model 3, which is one of the best-selling products in China. And Mercedes-Benz, they are announcing the launch of their new super luxury model of Maybach, which is going to be a fully fledged electric vehicle priced at $200,000 each. Domestic players are also trying to maintain their lead in the market. BYD, for instance, unveiled its first luxury model called Yangwang yesterday. It's priced at about 1 million yuan. At the same time, it's seeking to gain market share in the mass market as well. Needless to say, attracting all the car makers to the Chinese market is the rosy growth prospect. Demand is surging. By some estimates, EV sales in China are on track to exceed 8 million units this year from more than 5 million last year. The future of the car industry is EV, for sure, no question about it. This is Charlie Zhu, Bloomberg News, reporting from Shanghai Auto Show.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market on the S&P 500, just a touch positive on the S&P. Going into a massive week for central bank decisions. Wednesday, the Federal Reserve. Thursday, the Bank of England. On Friday, TK, the BOJ, just around the corner.
Translated with $94 oil, up goes a gallon of gas. I know they don't pay attention to that. Somehow I think they will on Wednesday, and I would suggest the governor of the Bank of England, you ready for this? $7.24 for a gallon of petrol in the United Kingdom.
That's real money.
That's real money. I mean, you know, we don't look at that. The cars are smaller. Lots of electric vehicles here, way more than I would perceive in the United States. But I'm sorry, inflation's there. And as you said earlier, John, in our leisurely English breakfast, full English breakfast this morning, it's just real simple. I mean, all in, inflation's a story, higher yields.
Look, this hurts, even with 7 to 8% wage growth in this country at the moment. There's a lot of difficulties here in the UK, just as there are over in the United States right now. Do they get harder? At least at the moment, we're looking to a growth forecast from the Federal Reserve on Wednesday that is set to be revised higher for this year. I've got no idea what 2024 looks like.
Recession coming.
Reflecting that, to some extent, yields near cycle highs, crude near the highest we've seen it for the whole of this year. Bramo, these kind of things, I'm going to borrow your word, percolating and hardly been talked about this morning. I find this bond market move, 434, right by intraday cycle highs, and I don't see a headline anywhere on it at all.
And it's being driven by real yields, which means that the inflation adjuster, the expectation of inflation baked into the market versus the actual yield is the highest going back nearly to 2009. We're bumping up against 2%. At what point is this a statement about some of the wage negotiations on the heels of some of these price increases, pointing to some sort of wage spiral? And at what point is this pointing to some sort of fiscal pushback? And at what point is this just great yield, go get it, because you're not going to get it for very long?
I'm not in the rate of change of a quote-unquote wage spiral and all the emotion and baggage of that from the 1960s, but Andrew Balls is over here next to me. We're going to bring him in a moment. He's nodding his head on real yields. And the key question for me is the benchmark real yield that the pros follow is a 10-year yield. And the answer is the 5-year real yield, to me, has uncommon value. And I'm sorry, it's a melt-up. There's no other way to put it.
We'll return back to that in just a second. Just to give you a flavor of what's happening cross-asset at the moment, futures slightly elevated by 0.1% on the S&P 500. Last week, a very mild week of losses on the S&P for a second consecutive week. In the bond market, yields a single basis point higher at 434.25. And just to finish on the euro, Lisa, 9 weeks of dollar strength against a weaker euro. We're trying to bounce back from that. 106.67 on the euro against the dollar.
The FT did a poll of economists. 40% of them expect more than 2 more rate cuts or two more rate hikes, at least in the next couple of years. Today, we're looking at oil very much front and focus. 10 a.m. we get some words from Saudi Energy Minister Prince Abdulaziz bin Salman speaking to the World Petroleum Congress in Calgary, curious how he dovetails supply versus demand. How much of the increase in crude really has come from a stronger than people give credit to China and just the rest of the world. Today, sort of in contrast, you hear a lot about electric vehicles and renewable energies at the UN General Assembly, which is a beginning. We're also going to hear from perhaps a discussion with the U.S. and China. More on that later.
Just to say that's why we're here.
What? Because
to avoid this.
100%.
This is like the worst week of the year living in Manhattan. Unger. It's just, I hate it. The traffic everywhere. I wish they'd move it.
Yeah.
Maybe that's controversial. I don't know.
Schools,
I wish they would move the UN
schools
General
being shut
Assembly
down. Afterthought
out of New
schools
York,
being
out of
shut down
Manhattan.
this week.
Well, yeah. Honestly, we all had the same thought. How lucky are we that we get to be in London?
Take it to Queens.
Okay. Meanwhile, so it is also, of course, celebrating birthday week. We'll have to do this every year. Today, also, we're kicking off a week of monthly housing data. This is when all of the data gets dumped out, including today at 10 a.m. Eastern, the NAHB Housing Market Index. This comes as affordability hits the lowest levels, at least by this measure, in the United States, going back to when this series was created in 1986. This raises a question: what goes first, the price of houses, or do wages just keep going up to respond to this?
That's all the data, the look ahead for today, and a sneak peek of the rest of this week as well. With us around the table, you got a sneak peek of this. Andrew Balls, Global Fixed Income CIO at PIMCO. Andrew, good morning.
Good to be here. Thanks very much.
10-year, fantastic to be with you. 434 on a 10-year yield this morning. To build on what Lisa said, is this a moment in time, buy, lock it in before it goes away, or can we live with this?
So I think it looks pretty attractive. We're in the middle of our forum discussions, which we had in London as well, actually. So we're still talking about this with the investment committee.
Give us a head start.
But it looks pretty attractive here. If you have a high-quality bond fund, 5-6% yield in US dollars with more credit, kind of 7%, maybe 7.5% yield. This looks very attractive. Equities have done very well this year. Looking forward, 6.5%, 5.5% type yield for a bond fund looks very good to us.
There are 2 points here. One is, does this look attractive now? And the second is, where is the next rate? Where does the move come from? Is it higher or is it lower? There are two different discussions, right, and how sticky this is going to be. How big is the argument right now in some of these meetings at PIMCO?
Well, I think you were talking about real yields, and I was nodding. When you look at real yields and look at long-term history, it's starting to look attractive. Here, we had this period after 2008, quantitative easing and all of that, and depressed real yields. But you're now seeing real yields at attractive levels, and nominal yields I was quoting before look pretty good to us. You have, in the outlook, you have inflation still stubbornly high at the core level, improving much faster in the US compared with Europe. But I think the jury is still out there. But then don't forget the recession risk. We have had very significant global tightening across the world, and yes, the data has been better than expected, particularly in the US this year. But as we all know, these central bank tightening takes time to feed into the real economy. So looking forward, the jury's still out on inflation, but that recession risk remains significant.
Critical question for PIMCO, and it's not only the heritage of PIMCO from Bill and Mohammed forward to the great call you people made a number of years ago. You've got the advantage of the former vice chairman, Richard Clarida, I believe, darkens the door. I can just see Balls and Clarida in a debate over where we're going to reset on our start and almost on a global R start. Do you sense within all the great work you do, Andrew, that we're going to reset at a new rate regime, something that we've never experienced before?
So I think it's a interesting debate. Rich and I tend to agree and on this point that as you look forward beyond this inflation episode, the cyclical rise in policy rates we've seen, there's good reasons to think that our star neutral rates are at the low levels that we've seen for the last several years. We'll see this in the Fed's projections this week, but the chances are the Fed will also see 2.5% as their long dot. So compare the 4.5%, 4.3%, 4.4% for the 10-year Treasury, or look at the forward rates and compare it with that neutral anchor. We believe that anchor remains the correct way to do the analysis, and then the long-term outlook versus that then looks very attractive, I'd say.
Does Lagarde have an R star? Does Ueda have an R star? Dare I say, does Bailey have an R star?
They all have their they all have the variations on this. I think the Fed maybe is a bit happier to talk about it sometimes, but again, looking at bond yields now. Even in Japan, you are getting to levels in terms of the 10-year yield where it's starting to look more interesting control for volatility, return per unit of volatility.
I agree with that. This is
and
really
it becomes a little bit, once we get beyond the YCC, once we get beyond the yield curve control. So if you think that you have that anchor, and we do, then look at your five-year forward rates to isolate the long-term expectations beyond this central bank cycle. And that's the environment when it's much easier to come in and be positive like I am today compared with the lows of the COVID period.
We don't spend nearly enough time talking about this. How different this regime is to the regime of the last decade before the pandemic. How different is it for you and the team? What have you had to change just in terms of your approach away from zero rates and QE forever towards potentially the Bank of Japan hiking interest rates, the ECB going to levels I never thought they'd get to? I thought maybe they'd go back to zero, but here we are at 4%. How different is this for you and the team?
Well, I think it's very different, and I think as a bond manager, you like to see these high yields at the front end of the curve. It becomes really interesting, the relative value at the front end of the curve. The zero yields, remember those, something that hopefully we've consigned to history. I think one important thing looking forward, different to the last 10 years, is uncertainty around inflation. So we see inflation coming down towards central bank targets, a little bit above, but coming down over the course of next year. But I think clearly there's much more uncertainty in the inflation picture for the next few years compared with the last decade. And so back to the discussion before, you should be getting term premium. You should be getting paid appropriate term premium for holding the 10-year part of the curve. But again, comparing our forward rates with our expectations for our start, it looks like you're getting fair compensation after a period when, with quantitative easing and all, the risk premiums were really compressed.
What about in credit, though? I mean, given the fact that you're looking at greater vulnerability to an oil price shock or a unionization shock or a technological shock, some of these things that become that much more important when your cushion is that much smaller.
So I think the baseline for credit looks fine. I think credit should do well in an environment where you avoid the tails, not just about recession, but real recession, not just a technical recession. And on the upside case, if inflation is coming back into line with that fairly benign middle path, then credit should be fine. From our perspective, though, we want to guard against the tails. And if we do get deeper than expected economic downturn, that's going to be painful in credit. So I think up in quality, IG looks attractive versus high yield. Avoid cuspier credits, avoid any kind of exposure to real default risk in what remains a really uncertain environment. It's not often you have these sorts of tightening cycles globally to such an extent. And then the final thing, there's lots of other stuff we can do in the world. US agency mortgages, very, very high quality instrument, very attractive in terms of the valuation. So again, if you can get to the kind of 5-6% type yields on core bonds, that looks pretty good to us in terms of the next few years.
Andrew, always a privilege. Thank you, sir. Andrew Balls there of PIMCO. Your bond market, 2-year just north of 5%, 10-year at the moment about 4.34. If you are just tuning in, welcome to the programme. Equity futures on the S&P positive by literally nothing, 0.04% higher. Outside of that, in the foreign exchange market, 106.68 on a euro, positive by 0.1%. Crude, new highs for the year in sight once again, 91.52 on WTI. Andrew Balls now needs to explain to Tom Keane who Norwich City is. TK, if we're going to do a football tour, you've got to talk to Andrew about Norwich.
Well, they're destined. Are they going to go up or down? I mean, I loved watching this weekend. Who played Chelsea?
Who did you watch?
Bournemouth, maybe?
Okay.
Brentwood, I can't remember. I love the little stadiums.
Brentford?
Yeah, there's no American equivalent to how close the people are, like in Norwich.
What's the Norwich Stadium like?
It's great. It's very loud. It's the old-fashioned stadiums.
The old-fashioned stadiums.
I go as often as I can without really annoying my wife. But I go to quite a few games.
But there's there's 10 Fenway Parks. Seriously.
Oh yeah. I prefer the older stadiums as well.
It's very cool.
And then the new owners want to come and they want to rebuild things and.
So who are you
go
playing
in a different direction.
EFL? Norwich. See how I did that?
That's perfect. Well
next
done.
one is Leicester, so top of the table clash coming up.
There we go.
Did I do okay there?
I'm proud of you, TK. Good stuff. Anne Marie is in New York City for the UN General Assembly.
Leicester.
She's going to be joining us next. From London, this is Bloomberg.
London and Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
I feel we made some good progress this weekend. I want to make sure we don't shut down. I don't think that is a win for the American public, and I definitely believe it will make our hand weaker if we shut down. I've never seen somebody win a shutdown, because when you shut down, you give all your power to the administration.
I can't believe there's another story that I follow less than this one. House Speaker Kevin McCarthy discussing the possibility of a government shutdown on Fox over the weekend. Bramo, so many people that listen to this programme find this subject absolutely tedious, and they start to ignore it. They ignore it, and then it starts to matter. Does this matter?
It seems unlikely that they're going to come up with some kind of proposal based on the fact that the proposals that they have out there aren't going to even pass measure within the own House. Here's the question. When do people start caring enough to possibly get on the same page and get to some agreement? When do people care enough to start putting that into economic projections, considering it does have something of a drag?
How linked is this mess with the impeachment inquiry that was started in the last week or so? Is that the bargaining between House GOP at the moment and the Speaker?
I honestly am not going to come up with rationale, but right now there is a bit of try to cater to the right of the parties so that you can get some sort of deal through so that you're not accused of shutting down the government, and that probably is part of the wrangling in the House.
Equities right now on the S&P 500, just about positive to kick off things this Monday morning. Good morning to you all, up by 0.1%, let's call it. Yields just about unchanged on the session, came really close to intraday cycle highs on a 10-year a little bit earlier this morning. 435.45 was the high of the session, high of the cycle 436.18, and in foreign exchange, Tom, 106.69 on the euro, just a little bit stronger here. And if you're wondering where crude is, it's near the highs of the year, 91.40 on WTI.
I'm going to go to $94. A 95 print would be shocking on Brent. We're not there yet, but that gets my attention. John, I'm just riveted with what we heard from Andrew Balls. I mean, I just think the three of us out at Norwich with Lester here on the 20th.
Well, I wasn't aware that Andrew's brother is no longer the chairman of Norwich City. He's since
Josh
taken on a
Sargent
different
hurt
role.
his ankle, the United States player playing for Norwich.
Oh, nice.
And, you know, I think
watch him play Leicester.
They're strong. They start 4-1-1.
Okay.
It's a draw, not a tie.
Thanks for that.
Thank you. But it's good to see that from Norwich. Keeping up with Norwich football is Anne-Marie Horton in New York, our Bloomberg UNGA correspondent, and we welcome her to the worst traffic in the world. That would be Midtown Manhattan all this week. Your message, Anne-Marie, away from the follies of Washington is you're watching the meetings away from the green marble of the United Nations. What meetings really matter?
Well, the meetings that actually really matter this week are the meetings that are not happening at the UN General Assembly. So what we've learned over the weekend is that President Biden's National Security Advisor, Jake Sullivan, met with Wang Yi, of course, Xi Jinping's foreign minister, in Malta. And what those two were talking about, a number of issues, of course, but really the potential for Xi Jinping and President Biden to have a meeting. These two individuals, these leaders, have not met since the G20 in Bali. But obviously, we've seen a number of high-level meetings from counterpart to counterpart taking place in Beijing. This could potentially see Xi Jinping coming to San Francisco, to California for the APAC summit. That meeting took place, and then Wang Yi later this week is going to Moscow, where he'll sit with Sergei Lavrov, who will also be at the UN, but Putin will not be at the UN, Xi Jinping will not be at the UN, Mohammed bin Salman will not be at the United Nations. So I think I want to see what happens between that Wang Yi and Lavrov meeting, which is happening on the heels of Jake Sullivan's Malta trip.
Well, I want you to report right now, Anne-Marie, why is the UN suddenly a non-event? I mean, everybody used to parachute in. I have the memory of being at the Council on Foreign Relations, Lisa, and Muammar Gaddafi walking by me, granted with a security entourage of 14 people, but it used to be a big deal. Why is no one showing up now?
It's still a big deal. For Diplo nerds, this is amazing. You can walk down 3rd, 2nd, 1st Avenue and potentially run into, say, Erdogan. Like these moments have happened, and you get some of these moments where you can see also who they're speaking to, and it's the sideline meetings, of course, that happen alongside the UN. Like President Biden will be sitting down with Benjamin Netanyahu. Interesting enough that this is not even happening at the White House. It's a meeting, a bilat alongside the UN. Obviously, there's been some tensions between Jerusalem and Washington. I'm just saying, in the broader aspect of what is happening in the geopolitical landscape in the world right now, the most important meetings, when you look at Jake Sullivan and Wang Yi in Malta, then Wang Yi going over to Moscow, those meetings are happening outside of New York City.
Yeah. It's like, Lisa, when I talk to Pharaoh, it's so rare, it's like it's a bilat. When John and I talked to him, it's a bilat.
I immediately Googled Diplo nerds, and there's actually an entire website devoted to games called Diplo nerds. I am curious, though, Anne-Marie, this idea that the United Nations is losing relevance is something a lot of people have been talking about, which raises a question of where are the forums going to be held, in what kind of space to bring powers together at a time of increasing divergence. Is this something that people are really talking about at this UNGA meeting?
At every UNGA or UN General Assembly meeting, people will cast the fact that, is the UN obsolete? And I think the past year and a half has showed just how constrained the UN. I mean, Russia sits on the Security Council of the United Nations. The most they can do is get the General Assembly to condemn Putin's invasion of Ukraine. But can the UN actually do anything to stop this war? No. And that's part of a lot of criticism that the UN gets. But really, it is just a forum to bring individuals together. Another interesting story that will be happening alongside the sidelines of the UN General Assembly, I reported this last week, and the Iranian Foreign Ministry confirmed it this morning. We will be having a prisoner exchange today between Iran and the United States. I've also have reporting that $6 billion of Iranian funds that were held frozen in South Korea have now been delivered as of this morning, about 4 a.m., 5 a.m. Eastern time this morning, have been delivered to Qatari banks. And what our colleague Arsalan is reporting is that potentially there will be some discussions on nuclear program in Iran between intermediaries with the United States and Iran alongside UNGA this week.
Just to follow up on what you were talking about earlier, this idea that one of the most important meetings already took place between Tony Blinken and his Chinese counterpart. Was there any resolution from that? Was this paving the way for some sort of Biden-Xi bilat or something further to really shore up relations?
This Jake Sullivan meeting, I think, really is the preview for the potential Xi Jinping-Biden meeting. These two individuals have that unfettered access to their principles, and they could speak a little bit more candidly than you would see, say, a Gina Raimondo and her and her Chinese counterpart, or Yellen and their counterpart. Jake Sullivan and Wang Yi are the ones that can really set the parameters of this meeting, which the United States has been asking for. And Xi Jinping at the moment is dealing with a difficult economy domestically, and also difficult issues within his government. You know, we still have missing Qin Gang, the former Chinese ambassador to the United States, who was the foreign minister. He was the one that should have been sitting with Jake Sullivan, but he has disappeared, and unclear where that individual is right now. And then, of course, Li Shangfu, who U.S. officials believe was removed from his post. This was the head of the military, the defense minister, who they've refused to have a meeting with Lloyd Austin with because of the fact that he was sanctioned by the United States. So you see some movements within the Chinese government. You see concerns domestically with the Chinese economy. Potentially, this is the time Xi Jinping wants to come to the table, and it would be on U.S. soil.
MH, we've got to squeeze this in. How has the U.S. military seemingly lost an F-35 fighter jet?
I do not know. I do not have answers for this. I've been looking to see what the command center is saying. The pilot was able to evacuate, but still this F-35 seems to be missing. I have a lot of questions, as you do.
Amazing story, amazing story. Anne-Marie, over in New York all week for us for the UN General Assembly, or locally known as UNGA.
I hate it.
I feel sick saying it.
UNGA. Actually, it's really fun. Just say it repeatedly.
No, I'll take a pass on.
UNGA, hooked on a feeling.
Wow. What was that?
It wasn't B.J. Thomas. Yeah. It was after that. Somebody did a redo of Hooked on a Feeling, and they go, UNGA.
So that's actually a song?
Yeah. It was a big hit. Huge hit for B.J. Thomas.
It's a great grammar. I don't know how you feel about that.
I think that it would be really great. I think it would be good. Let's do it.
How do you lose an F-35?
I don't know. I mean, here's my question. What do they know that they're not saying?
There's always something.
Right. So is this an issue of the weather needs to clear to then go into the lakes or wherever that they think that there could have been some sort of accident? Was this something about the transmission system and what could have gotten hooked in? I don't know.
So was it on autopilot still with fuel?
I don't know the details.
Oh, okay.
I don't understand. We don't even know why he ejected the pilot.
Pretty fascinating story.
It is.
Isn't it? Catherine Neese of PGIM Fixed Income is coming up shortly as we kick off a trading week full of central bank decisions. Equity futures totally unchanged on the S&P 500. Live from London, this is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Coming off the back of a very mild week of losses on the S&P 500, trying to bounce back, but no sign of a bounce currently. Unchanged on the S&P 500. Likewise on the Nasdaq 100, down by about 0.06%. No drama this morning. The week really begins on Wednesday. We'll talk a lot about those central bank decisions throughout this morning and, of course, through the week. In the bond market, 2-year, 10-year, 30-year, just to slice up the yield curve as we often do across those three maturities. Your 10-year yield came very, very close to a cycle high a little bit earlier this morning. Within a basis point of it, this morning we're now just about unchanged at 433.85, but still here, Lisa, in the 440s on a 30-year. Still there.
We were supposed to be down to 3.5%, according to some. We were supposed to be already talking about recession in the U.S. Instead, we're talking about the ongoing potential for a wage spiral. We're talking about ongoing upgrades to economic growth. And we're talking about a 10-year Treasury yield that is closest to the highest levels back to 2007, raising real questions what the Fed is going to do on Wednesday in terms of projections.
Climbing for 3 consecutive sessions, just building on some of the moves we've seen recently going into the Fed on Wednesday. Lisa, I want to finish on foreign exchange. Just get to the euro quickly. It's been 9 weeks of dollar strength against a weaker euro, and those numbers just tell the story, don't they, Bremo? 106.66 for the ECB.
Is this driven by U.S. strength or European weakness or both? And so how do you get the dollar really dictating what we hear, not just from the Bank of England and the Bank of Japan this week, but also the Bank of Sweden and Turkey and everyone else who's going to be reporting?
I think we really focus correctly on bonds, but I really want to state here something we haven't stated. The resiliency of the equity markets is shocking. If you gave me the news flow, including U.S. government shutdown right now, I suggest we'd pop down 8%, even 12% on equity markets as a guesstimate, and it hasn't happened.
So question of the moment, I'm going to go back to it, and forgive me if you've heard this a million times because I'm on repeat on this point at the moment. Reflection of the extension of the cycle or a recipe to end it? Crude in the 90s, bond yields back to 430 something, 2-year at 5. Which one is it?
It depends on what's driving it, especially with crude, given the fact that if you look at it on an inflation-adjusted basis, it doesn't look so bad relative to recent history in the U.S. When it comes to rates, is that being driven by healthy inflation or unhealthy inflation on the heels of some of those crude moves?
Top stories this morning. Under surveillance, the Fed set to make its next rate decision on Wednesday. Investors betting the FOMC will hold rates at a 22-year high. Meanwhile, in the labour market, they've got to talk about this. The UAW rejecting a 21% pay raise from Stellantis. Negotiations between the UAW and automakers will resume today. If 20% doesn't get it done, I spoke to David Welch about this about 2 weeks ago, going into the deadline, and I said, what do you think gets it done? That's our Detroit reporter, incredibly well connected. He thought 20% around that kind of level would get it done. 21% isn't getting it done.
So what does it have to be, and what does it do to the Detroit auto manufacturers at a time of incredible competition? Or even
Who says it's just
Europeans?
about the pay? It's about the other themes as well.
Totally agree.
32-hour
Yeah,
work
sure.
week.
It's super nuanced.
And the whole EV dynamic is interesting me more and more. They want union electric vehicle jobs. And Mari Barr is basically saying no, right?
Well, Tesla's rubbing its hands together, Tom, because they don't have to face that problem. Europe is facing the consequences of underinvesting in the continent for a long, long time and being behind this race. Behind, and Lisa, ultimately, it means perhaps competing with Chinese manufacturers that do this at a much, much lower cost. And as we mentioned in the previous hour, Jeff Yu of BNY Mellon said it, something changed in Europe over the last couple of weeks just on this front. It feels like the EU aren't going to tolerate that competition. They won't allow it.
Because they understand how much ahead China is when it comes to that. But from a worker's perspective, how much are they getting in to try to affect how some of these technological changes affect their jobs before it's too late?
Let's turn to this story. Speaker of the House, Kevin McCarthy, outlining demands to avoid a government shutdown. McCarthy calling for an 8% spending cut to domestic agencies and for work to resume on a border wall. The House expecting to vote on the measure on Thursday. Tom, we're doing this all over again.
We're doing it over again. I love what the Washington Post had this morning, where there's 5 ideological cohorts of the Republican Party. My basic idea is even the least sophisticated people know an 8% budget cut, either, I assume, nominal, maybe they even mean real. It's just foolishness. It's like, why waste our time of all political persuasions doing that?
This is not popular with voters. Let's just put that. Nobody really likes seeing government shutdowns. How divorced is Washington getting, frankly, from voters, whether it's on the Republican side with government shutdowns or whether it's on the Democratic side in terms of Biden and the viability of his candidacy? And it raises this question, at what point will political dismay at a potential government shutdown actually mean anything in D.C.?
Let's finish on the commodity market. We've talked lots about the economic perspective of this, but let's talk about the politics of oil pushing closer to $95 a barrel after a 3-week rally. The surge boosted by higher demand and continued supply cuts from Saudi Arabia and Russia. The Saudi energy minister, as Lisa has pointed out all morning, is set to speak a little bit later on today at 10 a.m. Eastern time. Energy costs putting pressure on businesses, consumers, central banks, and arguably maybe even putting pressure on this White House, TK, going into an important 12 months of campaigning.
It's a sustain of it. What my attention here is, I don't see people going up and back down again. I don't hear many people saying we're going to wander back to $85 a barrel. I just, which frankly is still high for people.
Do you have to bake that into forecasts for next year over at the Federal Reserve?
It's a loaded question because they have this foolishness of core inflation. I'm really old school on this. I put much less weight, and a lot of respected people disagree with me on this. They think our core analysis is valid. I'm with Larry Kudlow, ex-Bear Stearns over at Fox now. I just don't buy for a minute the core analysis.
TK crude getting close to 95.
Yeah, $95 a barrel. We're going to see how it folds into the global markets and, of course, into the dollar. A student of that is Marvin Barth. He's founder of Thematic Markets and does a wonderful cross-asset analysis right now. Let's just start with basics, dollar 101. Surprising resiliency in the dollar. Does it sustain?
Yeah, I think we are in the midst of an unheralded dollar cycle like you've never seen one before. This was actually the first piece of research I turned out at Thematic Markets. It's about what's driving dollar cycles. I go back and look through time at what drives these big, huge, previously 17-year cycles. And what it seems to relate to is innovation cycles that come out of the U.S. and drive CapEx cycles. And until the CapEx cycle finishes, the dollar doesn't finish. We're not done with the CapEx cycle.
I mean, John, you thought Quantitative paid for the Washington Capitals. He doesn't. So if you believe in a Quantitative cycle and you're going to tie it into innovation, that screams to me American excellence. Is that overplayed?
I don't think it is. I think there's actually a couple different things here going on. One of the things that's very different from this dollar cycle from past ones is the shortness of the investment cycle. So as we are seeing every day, the technology cycle is getting shorter and shorter and shorter. So the U.S. is still running ahead of everybody in a way it didn't in those previous cycles. The second is, take a look at the data. U.S. per capita incomes left Europe behind in 1990 and have never looked back. There's no convergence anymore. And now it's starting to happen versus emerging markets.
What's interesting here, John, is your investment cycle on your ARM shares was what? 2.5 days?
You're going to get me in trouble. Just for the record, no ARM shares at all. None at all. Okay, are we done with that?
We're done with that.
Okay, good.
I'll move it forward. There is this question, though, about what this means in terms of central bank policy, or if that's not relevant, because people here are expecting the ECB to be dealing with a more intractable wage spiral and inflation problem than the one in the U.S., and that's going to leave a tighter ECB policy, all things considered, for longer than in the U.S. Are you saying that that really doesn't feature in here in terms of the dollar cycle?
Oh, I think it absolutely does. But remember, I think one of the key things people forget is central banks don't actually set rates. They respond to the economy. It's, you know, if you look at the Fed's forecast, they didn't tell you they were going to go this high. They had to because the economy told them to. All the things you were highlighting earlier about the mystery about why the economy is doing so much better than expected, why earnings and the equity market is doing so much better than expected. This is all a technology cycle. They have to respond.
If that thesis holds true, then wouldn't the Chinese yuan be doing better than it currently is, considering the innovation cycle around electric vehicles and how underestimated that has been based on the recent reaction from German auto manufacturers?
So, Lisa, this is a great question, and I think it's one of the things that if I go back to some of my previous research, I got wrong early on. I thought it was all about the tech companies. It's not. It's about something called localization. If you look in the data, it's not geopolitics or COVID or any of that. Those accelerated it. That has been driving the move away from globalization. It's been localization of production that's been enabled by technology. Nobody's doing that better right now than the U.S. That's what's driving this.
Haven't we also proven that preventing conflict through trade has totally failed?
Well, you can go back to World War I. Who were the two largest trading partners of each other? The UK and Germany. This is a failed concept. I don't understand why people thought it was going to work this time, but it doesn't.
Where does that leave China?
Well, China has its own set of problems, right? So China pursued this massive industrialization policy through subsidizing capital, repressing consumption. The same thing that many of its East Asian predecessors did. It's just done it on a much grander scale. But it now is going to have to pay the price. Fortunately for China, it's the creditor to itself. So like Japan, you're not going to have a global financial crisis type thing. You're just going to have a lost decade or so.
Which is the reason why, and John asked me this question earlier this morning, what's the most important meeting this week? The Fed, the Bank of England, or the Bank of Japan?
So I do think the Bank of Japan is really the most interesting one. The Fed, they are finally caught up with the curve. Yeah. That doesn't mean that they're at the end, but they actually have a chance to pause. And so it's a toss-up there. But the Bank of Japan is actually potentially changing course.
I love the big picture you're taking. I'm going to go back to a podcast David Merritt did with Mariana Mazzucato. It's one of my favorite people here on economic history. Are we at a junction here, as Mazzucato would say, where there is a new, where leadership like at the UN can actually piece together a new world, or is it going to be a Marvin Barsh slog here forward?
So one of the things I've highlighted about this theme of localization is that this is actually wholly new in human history. We actually have records going back 300,000 years, before actual Homo sapiens existed, of increasing levels of trade among hominids. As you know, it's all David Ricardo's specialization of labor, right? What changes that? When I can substitute a machine for all different variants of human activity, intellectual and physical, why do I need to use the cheapest labor anywhere in the world to trade with that specialized labor?
Do I need a new iPhone? That's what I want. I just want to know, Marvin, do I need a new iPhone? Going back to Ricardo.
Yes, because they're limiting your memory and speed.
They are. Thank you. It's all nanometers, 3 nanometers.
We'll leave that there. Marvin Barth there of Thematic Markets. If you are just tuning in,
can you come back tomorrow?
Of course.
Equity futures on the S&P, just negative here, rolling over in the last 10 minutes or so. We're down by 0.14%. In the next hour, don't miss this conversation with Jules Moak of AXA Investment Managers. The lineup of guests already this morning, absolutely fantastic. Some of the headlines: triple-digit crude By Halloween was the call from Amrita Sen.
Yeah,
over at
this is
Energy
real.
Aspects. We're not far away. Andrew Balls at PIMCO talking up buying duration like right now. Thinks this is a moment in time you don't want to miss. Tom with a 10-year in the 430s.
And Gilles Marek, for Global Wall Street, this is must listen with Gilles Marek of AXA, because he's going to fold into the post-Lagarde ECB world. I mean, some of those headlines were shocking here, and you just wonder, you know, on the gloom basis, where's Germany 6 months from now? But it's much more the holistic view of Europe is a struggle.
And a question, Tom, that you've asked, which is on a gloom basis, why have stocks been so resilient to where we are in terms of real yields, in terms of yields, in terms of oil prices? We're looking at a market that is not what anyone expected it would be 6 months ago, 3 months ago, 3 weeks ago.
Do we have to go to break here? I mean, is it commercial free in England?
In about 30 seconds, TK.
Okay, damn.
You've got a bit of time if you want.
No, but I just think Larry McDonald was great about this. There's a wall of money out there that's got to go somewhere. That's all there is to it.
It's gone into the equity market so far this year. Equity futures on the S&P negative by 0.2%. Coming up next on this program, Catherine Nice of PGIM Fixed Income. That conversation just around the corner. A triple header of central bank decisions this week. The Federal Reserve Wednesday, Bank of England on Thursday, BOJ coming up on Friday. Live from London. Good morning.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Access the financial world on
Connection
demand.
lost.
Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
I think that the markets are still thinking the inflation is going to drop towards 2%, and therefore the Fed is going to cut rate and cut them aggressively. The Fed is pushing back against that view. They're saying we're going to be essentially higher for longer, not just the Fed, but other central banks. There are structural forces that imply that inflation may be higher. I think markets are still a little bit too optimistic that the Fed is going to aggressively cut rates starting early next year. That's not going to be the case.
Nouriel Roubini, Associate CEO of Macro Associates, Roubini Macro Associates, speaking early today on Bloomberg Brief, a news show with Manus Cranny and Danny Berger out of London and New York, respectively. Catch that at 5 a.m. Eastern Time. Just to get you up to speed on some of the price action, equity futures just slightly negative on the S&P. We're down by 0.16% on the S&P 500. In the bond market, we are totally unchanged at 433.65. It is absolutely fascinating to see developments over the last month, to see yields get very close to cycle highs again on a 10-year within a basis point this morning. And in the commodity market, to have crude back in the 90s, not just on Brent, but also on WTI, 91.25 on WTI, up by 0.5%, and a conversation about maybe $100 Brent by the end of October. TK, that's quite a surprise. It's quite a surprise to see that. given where we were back in the summer, I think it's actually a move of something like 35% on WTI since June.
Yeah, I think I took it off June or August, and it was a 30% move, and annualized out, I believe, 248%. Granted, that's a baloney number, but the fact is, here we are, and you know, we pride ourselves here with Will Kennedy's desk on hydrocarbons, actually based out of Queen Victoria Street. And John, you look at the Bloomberg News hydrocarbons analysis and all the experts. How many people do we see saying, we're going back to $70 in oil? I don't see it.
Well, what I hear and what I see is basically what you will see. Lisa, you blame Saudi, you blame Russia. This is not about demand, it's about supply. But at some point, you've got to ask the demand question. It's pretty phenomenal. Demand holds up in the face of it.
Yeah.
Given everyone's talking about recession, slowdowns in China, and problems in Europe.
The only person who is calling for prices to come down that I'm seeing right now is Ed Morse of Citigroup, who put out a note. And he was the one who actually got it most right this year. And he said, the swing factor here is supply. And you've pointed to this, John. The U.S. is producing a record amount of crude. If they continue to do so, that could potentially change the scenario.
Near 13 million barrels a day. The latest figures on that, 12.9 million barrels a day in America. I was reflecting on this in the last week. We've talked so much about the anti-fossil fuel stance coming out of this White House. Does it make a difference if we're pushing 13 million barrels a day, regardless?
That's a good question. And do you sort of see a difference in the actions of the White House versus some of the rhetoric?
One of the great things in economics is every region, every school has a specialty. British Columbia owns econometrics, like really, really extraordinary. She's out of the University of British Columbia. Catherine Nice joins us now, Chief European Economist for PGIM. She gets to tell bond portfolio managers who tell her she's smarter than they are what actually is going on, and she joins us this morning. Thank you so much for joining. I want to go to the right-hand side, rather, of the algebraic equations you're expert at, the epsilon. What's the level of uncertainty right now? Do you have a conviction, or is there such a jumble out there that your uncertainty is just off the chart?
I think what is going on uncertainty is looking very different to the world that we got used to in the decade before the pandemic. And I think that is particularly the case if you look at long-term, where we think long-term nominal yields are going. We were in a world where effectively central banks were promising to buy, and we saw a lot of risk premium compression. We saw very low stable inflation with very little variation around that, very little volatility. That led to further compression into the risk premium. And in terms of the real economy, we weren't really seeing huge real side shocks. And on all of those fronts now, things look to have turned. And so I think this question about where is uncertainty taking us in terms of market pricing is a really relevant question.
I mean, I totally take your point. I've talked about it many different times in a simplistic Hicksian basis. Everybody's in the financial world, and you're overlooking at the real economy impacts of this new interest rate structure. Does that put a dampening on global GDP as the IMF calls for?
I think it really depends on where you look. The U.S. economy is showing real resilience. You've got a substantial amount of fiscal spending. I'm hearing about Inflation Reduction Act, obviously through, the European lens. That's where my focus is, on the euro area economy. And policymakers in Europe are really, hyperventilating about this Inflation Reduction Act. They're very concerned about the negative spillover effects of that for Europe. Whereas if you look at Europe economic activity, I mean, it is already slowing. That is not something that is as yet on the horizon. It is already looking quite weak. And so, the prospects for the real side of the economy, I think is the potential is there for a divergence between what we're seeing in the U.S. and the euro area.
Which is the reason why people are talking stagflation in Europe, and they're not using the S word in the U.S. How long can Europe stay in a stagflation type of environment?
Potentially, how long is a piece of string? I think potentially this could persist for quite some time. I mean, if I just think back to the experience of the UK, the UK is obviously small open economy. Euro area is a large open economy. It's quite different. we experienced here in the UK a very large series of large relative price shocks that meant that inflation deviated from the target for almost 4 years. And this happened against a backdrop of very little sign of pay growth picking up, certainly not to levels that were inconsistent with the target, a recovering but tepid real economy. And it took 4 years for inflation to get back to target. So that to me already suggests that these shocks will take some time to work their way through. And if we get more such upside shocks like what we're seeing with energy prices, the potential is that this does get drawn out.
So what is the monetary policy response? I mean, is this even relevant at this point at these levels if this is something else, if this is being driven by other features that aren't related to growth and aren't related to what the central bank can control?
It makes it a lot harder for the policymaker, for sure. But, my view, and this is a debate I think to be had with Bank of Japan framework review, potential of a Fed framework review down the line, is the flexible inflation targeting regime flexible enough that it can account for this? My view is perhaps one area that we haven't explored is around the horizon over which policymakers get inflation back to target. So built into that framework is an understanding that if an economy gets hit by a very large relative price shock, the policymaker should look through that, and it might take longer for inflation to get back to target. That was the message we were hearing from central banks when inflation was undershooting, and maybe there's going to be more of that messaging when inflation looks like it's overshooting, on the proviso that we don't see these second round effects crystallize.
Let's finish there then. If we took the clock back to the late 80s and caught up with that gang over in New Zealand and said, what should the inflation target be? Would they come up with something closer to 4 for the period we're in right now?
There are no strong and compelling economic arguments to have an inflation target at 2. If you were starting from a blank sheet of paper, I think 3 or 4 is probably, an equally, if not more sensible place to be. The problem is that, we are not starting with a blank sheet of paper.
Sure.
And my view is that is going to be a very difficult thing to change. If it's not a good idea to change it when inflation is below the target, if it's not a good idea to change it when it's above the target, then it seems a bit odd to change it when you're at target. And so I think to me that tells us we are where we are, but maybe we need to think through other elements of the framework, like the horizon over which we get inflation back to target, and maybe the measure of inflation itself. Is it really accurately reflecting what people are spending their money on?
Well, most people feel like no, and have done for a long, long time. Isn't that a really sophisticated way of saying, just push it out? Just basically just say, we can't hit it now, we probably can't hit it over 2 years, so let's just adjust the time horizon, which is basically just saying, let's tolerate a higher inflation number, isn't it?
For a period of time, yes.
Okay.
And as I say, that's always been part of the framework. It hasn't really needed to have been utilized because we haven't really been hit with these kinds of upside real shocks.
This is what's so important about the IMF projection and the shock of going out to 2028. Who's doing that? Nobody's doing it. Nobody's looking out as Catherine is over a longer time frame. She's talking, she's not saying the x-axis we're going to move out. It's a bunch of fancy language, but the answer is, as you say, it's longer.
We said it this morning, I think, for President Lagarde over the ECB, just wants to get through 2023, never mind thinking about 2027. Catherine Nice of PGIM Fixed Income is coming up. Catherine Nice, thank you, rather.
Nailed it,
coming up, Sophie Lund-Yates of Hargreaves Lansdown is joining us very shortly. Catherine Nice of PGIM Fixed Income. Thank you. Equity futures on the S&P 500, negative by 0.2%. Live from London, good morning to you all.
They're brimming with sensors. There's several cameras that look out at your world because we're mapping your physical world so we could put the content in there. There's several cameras looking at your eyes so we know where you're looking in your physical world. And that's a lot of data. That's a lot of very personal data. There's a number of other sensors on the device that are needed to make it work in the way it does. So we feel strongly that, first of all, people should know what these devices can do. And since we're at the beginning of the curve, let's work on the right guidelines and put those guardrails in place now versus letting it out of the bag and trying to rein it in, several years from now.
So what rules would you put in place, and who should make up and enforce the rules?
I think it's definitely a public-private discussion, but it's a very complex technology. So I actually spend quite a bit of time in DC talking to folks, saying, just educating them on what it could do. But I think first and foremost, the data that it collects, there needs to be an understanding, the user needs to understand the level of data that it's collecting, and then be the one who says where that data goes.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
We've had the market analysis. We're going to go get straight to some breaking news.
We'll have a full roundup.
Going through some of the numbers and what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Yes. Not keeping, look, people have conviction, or they invest if they invest for the right reasons, just keep at it.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
I think we may very well be at the end of rate hikes.
Most central banks, I think, probably done hiking now.
The double-digit losses of last year are clearly behind us.
I think the S&P is going to 4,800 by the end of the year.
We actually may see higher than 2% GDP growth on a 5-year time horizon.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene from London. Our studios at Queen Victoria Street on Bloomberg Radio, Bloomberg Television. We've been looking at bonds, equities, the rest of it. John, it's time to look at the equity markets.
You want to look at the equity market right now?
Not right now, but we'll look at it as we go forward.
What kind of lead-in was that? Okay.
All right, the S&P
I'll do that right now. The S&P's on. Futures, slightly negative on the S&P 500. It's time to look at that. It's time to look at central bank decisions through the week, TK. Wednesday, we've got to talk about the Federal Reserve. Thursday, the Bank of England. Friday, the BOJ.
But it's such a good, a good feeling. Greenspan had a good feeling about the equity markets and the backdrop to real concern over oil near $95 a barrel. You mentioned the rates popping up today, price down, yields ever higher. There is that good feeling of a market that's been resilient.
Look, TK, I'm with you. This was the dream. This is the dream.
Yeah, for
the Fed's about to market on Wednesday. It's going to upgrade its growth forecast and downgrade its inflation forecast in the minds of most people we speak to. At the same time, got an equity market that's seeing double-digit gains on the year. And we're doing this with yields at 5% on a 2-year, 430-something on a 10-year, and crude in the 90s. If that can stick, I don't know. But where we are right now is what people were praying for. at the start of the year.
In the back of this is a social aspect, not only the UAW strike, and Lisa put out a chart earlier this week, was the boom in striking, but John, the very fabric of this nation's being tested with the NHS junior doctor strike. I was shocked at the impact of the residents and interns walking out of the hospitals in the United Kingdom.
The United States is getting a flavour of what we've been living in the UK now for the best part of 12, 18 months. And that flavour is hurting these automakers. If they have to cough up more than 20%, based on what we've heard from the UAW, it's going to have to be much more than 20%. Stellantis have offered 21. UAW have said no thank you. That's not where a lot of people thought we would be a couple of weeks ago. David Welch, who will catch up with in about 10 minutes, Tom, thought 20% would get it done. I understand there's lots of other stories outside of just the wage piece of this, Tom. But to see 21% batted away the way it was by UAW tells you that there's going to be some problems on the horizon for Detroit's Big Three if they want to compete with the likes of China. Now, whether they'll be able to compete with the likes of China is one thing. Whether the US will just turn around and allow these Chinese competitors to come into the US market is another thing altogether. Because based on what's happening here in Europe, the real prospect of much, much bigger tariffs to insulate this economy and German manufacturers from low-cost competition coming from elsewhere.
Well, you see it with the German automakers as well. Lisa, I think you nailed this. I bust your chops about wage spiral, but that's what the fear is you do get into some form of embedded, maybe not a spiral, but a wage oomph, up, and that makes it tough for Jerome Powell.
That paired with oil really challenges this idea of a soft landing. It really challenges the idea that we can remain in Goldilocks for a prolonged period of time. It challenges immaculate disinflation. How do you get immaculate disinflation with increasing union actions and really wage negotiations, not just in the U.S., but around the world?
First thing I looked at today, 10-year real yield. John, help me here. I'm going to round it up to 2%. We made 1.99. 2% sounds, fancier, but there it is. Real yields elevated.
So let me get this straight. You go across the pond and you're not wearing a jacket. Tom wasn't wearing his glasses, and Lisa is still a bear. 1 out of 3 ain't bad. That was the latest feedback this morning. I just saw that pop up on my screen on the Bloomberg. Equity futures on the S&P 500 negative here by 0.1%. Yields up a single basis point, 434.25. Jackets off because the aircon in Europe's just not that great. I mean, it really isn't.
It is.
It's not like US aircon, which is just like super powerful.
Absolutely. You go in the US, you walk down a sidewalk on Lexington Avenue, and there's a store where the doors open.
It's like Arctic freeze comes out.
There's none of that here.
We're getting more European. I will just say that. We are getting more European.
On some fronts, that's a good thing. On the aircon front, I don't think that's a good thing at all.
I'm going to quote you on that.
I don't have the number in my head. John, a gallon of gasoline for all the little itty-bitty cars here and the many electric cars.
In dollars, north of $7.
$7.24.41. I can't remember what it was.
That's brutal.
So it's a whole...
A lot of that's taxes.
Did we do a data check yet?
We did. I did that briefly.
Okay, you did that data check. Okay, well, we welcome... It's going to be a great week here in London. Lots of really good guests to come up. And we have a credit conference we're doing. When are we doing this? Is it Thursday?
That on Thursday, Tom,
Thursday.
With Apollo's Jim Zelter.
And it was great when we started talking about it, and it's now even greater, because I would say credit is really front and center.
And the compare and contrast between Europe's experience and America's experience.
Yeah. Well, we'll do that Thursday, and there's a modest Fed meeting there on Wednesday. We'll have complete coverage for you on that. Now in the equity market, Sophie Lund Yates joins us now. Excuse me, lead equity analyst Hargreaves Lansdowne. Excuse me, I'm gasping. It's the hot brown water. It's killing me. Sophie, I look at the equity markets, and everyone's flabbergasted at how resilient they've been. Let's start with that. Why is there a bid to global equities as a general statement?
Yeah, this is the big one, because I'm absolutely someone who's in the camp who I'm a little bit of a bear here. I think that
I should be sitting over with Lisa, but continue.
I've still got my jacket on as well. Is that okay?
That's okay. I have my jacket on.
All right.
There's no rules here, Sophie. Just make it up.
That's not the vibe that I'm getting. I feel like there are some rules. But jackets aside, in terms of what we're seeing, there is a great deal of optimism, and I think that's kind of what you're alluding to here. And I think that unfortunately that isn't going anywhere. What we're seeing is consumers in particular. They aren't behaving like there is a recession in any form coming around the corner, particularly when we look at the UK, Europe as well to a certain degree. There's a great deal of resilience still in the consumer, and everybody's just very excited. I think there's also a great deal of this notion that central banks are going to be sticking to the script and that interest rates are going to be doing exactly what everybody predicts it to be happening. And unfortunately, as we know, that's not necessarily going to be how this plays out. So I do think there's potentially some overexcitement in the markets.
What does it mean to be a bear in equity land as bears have gotten beaten up all year long again and again and are now throwing in the towel?
Are we throwing in the towel? I mean, I'm on the cusp. I think for me, what I want to really kind of just shout about, and I think is getting forgotten here, and I know it's boring and it's not what people want to hear, but let's not forget fundamentals. There are so many people out there, they are talking about incredible thematics and mega trends, but fundamentals to me are where people need to be landing as well. I'm talking about looking at consumer staples, non-discretionary spend. Where is that being funneled in the next few months in particular? I don't want to bring it up, but we are heading into the festive trading season. This is going to tell us so much about where strength lies as well. So for me, it's please remember about your fundamentals, because I think they're getting left by the wayside.
Speaking of fundamentals and pairing it with this idea of the latest tech thing, there was a huge boost to European markets with the idea of a weight loss drug and what it did to Novo Nordisk and the whole question around Ozempic. And suddenly people were talking about how this is going to rejigger the European markets because suddenly this is going to be the preeminent type of trade. We were talking yesterday about some of the side effects increasingly of this. How do you get ahead of fads that are perhaps bigger in name than they are in reality?
Precisely. It comes back, first of all, to fundamentals. So when we look at big pharma, for example, we know for a fact that you're looking at hundreds of millions of dollars of falling off that patent cliff in the next decade or so. And obesity treatment is a really exciting mega trend. It's something that is going to generate a great deal of money. It's I think, a really good place to be. But in terms of getting ahead of that trend and making sure it's not just a fad, you need to also look at what else these companies have on their books. What does R&D look like? What is the pipeline? Because if their pipeline is only this, that's problematic to me. What else do they have that can back this up? But as a mega trend, I do actually think obesity treatment and the drugs there, a lot of that excitement, takes a lot for me to say this, a lot of that excitement is warranted, but it's not enough on its own.
Sophie, how investable are car makers right now?
So I think there's a lot of strength in the sector still. Do I think it's going to be bumpy? Yes, I do. But I think there is some strength there, not everywhere. This is not a sector that is created equal, and the divides here are becoming much, much larger. And I think so much of it, perhaps unsurprisingly, is going to come down to this pricing pressure as well.
So 20% plus makes US autos, GM, Ford, Stellantis uninvestable for you?
It's borderline. I think for me, a lot of that, the problems and the risk probably does outweigh for me. A lot of the excitement is probably where I'm at. But when we look at some of the maybe more exciting names in the sector, I think there are still quite a lot of opportunity. But also this industrial action that we're seeing as well has a lot of read across as well for broader equity inputs as well. So people that are supplying car parts, those areas of the market too. These are really quite vulnerable right now.
Help us with your savings and resilience index. It's acclaimed. Bring that to the UK, but also over to the United States. It sounds so, talking points of consultants. Tell me about our savings and our resilience, given what we're going through.
Yeah, so here in the UK in particular, you mean kind of the savings rates that we came into the pandemic with. So the UK in particular, we had a far higher savings rate than a lot of our peers in particular, and this means that it's kind of feeding into our inflation problem in a really big way here, because we're only just starting to chip away at that. Whereas over in the US, those that kind of resilience and those savings levels have already been depleted. So that's also kind of feeding into things and pulling things down in the trajectory that you would hope for, and that is not playing across in the UK right now.
Sophie, this was great. Sophie Lund-Yates there of Hargreaves Lansdown. Thank you. Thank you very much. Did you see no business attire on the Senate floor? Did you see that new one?
No, I missed it.
They've got rid of the rules. You can wear what you like.
Really?
Yeah, on the Senate floor.
Let me guess. You have thoughts?
I have strong thoughts.
Yes.
I'm sure you have
I'm
strong
shocked.
thoughts too.
They're right.
What?
If you're leading a country, if you're representing the people, shouldn't you dress for it?
So in other words, no sneakers, or I should say no trainers.
Those hybrid things that senators have started to wear anyway with suits.
What if they've got bad feet? I mean, 1 in 5 are over 70.
What did you have to do at school? You got a doctor's note if you had bad feet and had to wear sneakers. That's what I did at school.
So you think that they've got to get a doctor's note if they want to wear the hybrids?
Get a doctor's note if you want to wear the hybrids.
That's fantastic.
You're representing the people, the country. If school kids have to do it, why shouldn't they?
So you think they should have a uniform?
They should wear a business suit if they're a male, yeah, without a doubt.
All right.
Business attire is the right way to go. For sure. Don't you agree with this? I'm surprised they're silent on this. They're going to go to the Senate floor in what, hoodie?
Camp than you.
A hoodie and shorts?
I think decorum...
Go ahead.
Decorum has slipped, to say the least.
There is also a sense of respect, but there's also a sense of service. And this goes back to a discussion of, are you representing, are you serving a nation, or are you trying to be an Instagram
My
star?
mother got dressed up to go to the grocery store, and she wore white gloves to go to the department store.
There you go, TK.
I mean,
Well said. It's like Trudeau in those light grey suits.
Okay, well said.
G7.
Well said.
You have such issues with those light grey suits. I just think that
Trudeau's got a lot of problems right now. The light grey suit is also one of them. Just, you know, just to
But he's
throw
got
that
great
in
hair.
There. He does. Something
So
I
it's
don't
all
have.
fine.
If you are just joining the programme, welcome to the programme. The S&P 500 negative here by 0.16%. In the bond market, yields are unchanged, 433.65. Looking at crude in the 90s, 91.27. Weighing in on all of this, Gilles Moek of AXA Investment Managers with a big week ahead. 3 major central bank decisions.
Joe, we're 9 points under 4,500. I mean, the resiliency of the markets
It's
with 95
impressive.
oil is stunning.
Given where the dollar has been over the last 2+ months, given where the 10-year is right now, where crude prices were and where they are currently, these are big changes, and equities are hanging in there, Lisa.
Well, which equities? And this, I think, is important because you have seen a market underperformance of the big tech names in the U.S. They have not kept up. And this, to me, raises a question. Is this the beginning of something, or is this the dip that everyone was hoping for? It wasn't even a dip. It was just a lag.
This.
Yeah.
0.1%.
You don't see this on radio, but behind John is St. Paul's. I just saw some birds there. Feed the birds, tuppence a bag. They're doing it.
Is that what you're going to be doing later?
Yeah, that's what they're doing. I just saw the birds over there. You know.
Do you want to sing us out? You're desperate to sing us out. David Welch on the UAW strike out of Detroit, coming up next.
Countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays. From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
An average of 92 does allow oil prices to go to 100. We're putting out a piece later today, which is calling for $100 by Halloween for Brent. And again, you know, this is just a trajectory. And at this point, look, of course, it's a short-term thing, right? I'm not saying it's going to average above 100, but could it go to $100 for a bit? Absolutely, yes.
Absolutely, yes. Triple-digit crude by Halloween is the call from Amrita Sen, the co-founder and head of research at Energy Aspects. Crude right now on WTI, 91.37. On Brent, getting closer and closer to 95, 94.50 currently. Outside of that, in the equity market, futures just about unchanged, negative 0.1%, rolling over in the last hour or so. In the bond market, going nowhere, 433.65. Talked lots about that record run, that weekly streak of dollar strength, 9 weeks of it against the weaker euro, 106.66. Positive this morning on that currency pair by 0.08%. The story for the three of us all week potentially, and maybe for longer, the strikes from UAW against Detroit's big three, not one, not two, but all three major manufacturers over in Detroit. And TK, the ask, 40%, 36%. What they've been offered at the moment is 21% over at Stellantis, and the pushback was pretty swift. That wasn't entertained really in any way, shape or form.
Well, the two of you mentioned this, the pay is front and center, and that's what gets the media's attention, but I'm looking at all the other attributes as well, and particularly the ability of the union to capture present and future electric vehicle jobs. I'm not hearing enough about that.
How do these guys compete with China?
How do they compete with BMW in the Carolinas, or, you know, 3 plants by Atlanta? That's what I don't see.
How do they compete with Tesla?
Well,
that's what Dan Ives of Wedbush said. Look, I get it. Tesla bull, I understand. If you were bullish before, you're bullish now. But surely, you're looking at this play out. Union versus non-union. It's a pretty clear investment thesis there, isn't there, Lisa?
Which is the reason why some people think that the reason why you're seeing this playbook from the UAW is to try to capture some of the workers from Tesla, to say we actually can make inroads at a time of technological change. They're throwing it all out there because a lot of people view this as the last opportunity that they have to do this. And if they don't get those workers, you're right, it's game over.
Yeah, we're going to have to see here. Right now, we're going to get a briefing, and we have been so advantaged by our Detroit shop, I should say. He is our Detroit bureau chief. David Welch joins us on the worry of industrial decline. David, you and I lived it on the New York Thruway. It was Carrier in Syracuse. It used to be a huge operation for Syracuse, New York, and then there was manufacturing decline and the Eastern Rust Belt. Is there worry here about manufacturing decline in greater Detroit?
No, there's always a bit of a what me worry sort of thing when it comes to that. By the way, it wasn't just Carrier, it was GE and Miller Brewing and a whole bunch of factories, so there's nothing left up there. But look, there is concern about being competitive with Tesla, with being competitive with Japanese, Korean factories. At the end of the day, though, for automaking laborers, you know, it's well under 10% of costs comes from labor. And if you boost wages up by 5% a year, it's not like suddenly every vehicle loses money. It cuts into what have been record profits, but it's not something that devastates them. They are at a competitive disadvantage from a labor. With labor costs, they already are, and they will more so. And look, now you know the union's going to make a big stink about this. And they've been saying that they need to organize Tesla and organize Toyota plants. They've never been any good at it. They've just routinely failed. They've never failed to disappoint when it comes to that. And so if they get a good contract, they've got to be able to say, you know, go back in 4 years and say, look, we did organize these other plants and we're driving the wages up.
Have you been surprised or understanding or interested in how the executives of the three auto companies have reacted?
Look, actually I have. They've voiced frustration. You know, you can see that from Farley. Farley's a pretty open guy, pretty colorful guy when he speaks. Mary Barr is always composed. You guys have interviewed her. She's always on message. For her to come out and say she's frustrated with the union really says that they're having a tough time with Sean Fain and a tough time getting what they think is a fair deal. And, you know, in the story we have out today, Bill Ford said to the bargaining committee, well, he said, I can look you in the eye and I can say, I believe this is a fair deal. And I don't think he's wrong. It was a pretty good deal that they've got. But the union's they're going to run it to the brink and try to get more.
What are they after, David? You and I talked about this a number of weeks ago, and I said, what do you think gets it done? And you said something like 20%. And at the time, I thought, yeah, 20% sounds about right. That's the offer right now. Ford 20, GM 20, Stellantis 21. What do you think gets it done now?
It's tough to say. I mean, I don't think it's a lot higher than this, and clearly you and I were wrong on that before, but the tenor of things did change over the weekend. The union, reporting coming out of the union saying that they made progress with Ford over the weekend, kind of a more neutral to positive view of meeting with General Motors, and they're reconvening with Ford and Stellantis today. So it went from heated, nasty rhetoric about greedy billionaires and awful CEO salaries to we're making some progress. To me, the big thing isn't really going to be wages, because I first off, I think 21% would get it ratified with the membership, but does the union really stick to its guns on pensions, or was that kind of a throwaway demand in order to get leverage for better raises and cost of living allowances? The companies will take a very long company-wide strike before they give in to pensions, period.
Unionization has fallen really dramatically. I was looking at one figure. It's about 6% of the population, of the working population in the United States, from much more just a little bit ago. Is this whole action by Shawn Fain going to actually get more membership, increase the actual participation in areas like electric vehicle making?
I think he will have success organizing some of the battery and electric vehicle plants simply because of the relationship with Detroit's three automakers. They've already organized the Ultium plant in Ohio. Of course, that's jointly owned by GM and LG. And they'll get wages up there, and that could help them organize some of the other battery plants owned by other companies that are coming over the next few years. So, yeah, I do think that will help. In fairness to the UAW, there is a moment here for labor. Public perception of unions is much better. It's actually, favorable 75% now, which is double what it was about 5 years ago. You have successful organizing drives at Starbucks, at Amazon distribution centers. So there is good organizing going on. And look at what the Teamsters got out of UPS without even going on strike. They got a great contract there.
Amazing.
So I do think if Fain can score some victories here, workers will start to see the value of joining a union. And there's a lot of anger out there. Look, I think one of the toughest things for the companies to explain, everyone knows that a CEO is going to make a lot more money than somebody working the line or even a rank and file engineer with a degree. But the fact that, they now make, someone put a figure out, 200 times what the worker makes, and it used to be 30 or 40 a couple decades ago. The fact that their pay went up over 40% and union workers' pay went up about 12%. It is tough to explain that to a public that's very anxious about AI and worried about losing jobs to EVs and worried about income disparity.
Yeah.
With the cost of housing, cars, food, and college tuition soaring faster than income does. It's really tough to explain why very wealthy executives get to more than compensate for that sort of inflation, and workers have to eat it.
It's almost impossible for them to explain currently. David, appreciate your time, sir. As always, David Welch there of Bloomberg out of Detroit on this battle between Detroit's Big Three and UAW to come to some kind of labor agreement. Lisa, as you often do, nailed it about attracting workers from elsewhere.
This, to me, is one of the biggest questions. We're seeing this boost in union activity, striking activity that is now the most over the past of this year, going back to 2000. And you're starting to see real pushback. So what is the next sector to really get hit with this? It can't just end here.
But imagine if Teamsters had lost at UPS. The fact is they won at UPS, and there's a wide understanding they're going to win again here. I didn't hear that from David Welch. This is not UPS saying, let's get this done so we keep the trucks going. I don't get any sense of that here.
What's your position on eating on morning shows? In America, they always eat. You see what Bramo's got for a birthday?
Oh, look at this.
Look at
this. My word.
Like
I'm just shoving it in my mouth.
For Bramo?
Yeah, it's good. That'll go really good with the hot brown water. Somebody said
absolutely not.
Go for it.
Absolutely not. No, they do that on US morning shows.
Yeah,
they like
exactly.
Eat burgers
they have a
and
cooking show.
Eat ice cream.
It's like people come in, and then we sit around. We all like, I
Happy
like
birthday, Bramo.
If I ate this,
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
TK absolutely crushing Bramo's birthday cakes in the commercial break.
Is that right? With my Yorkshire
Two
tea.
Two down.
My Yorkshire tea.
Nice.
Somebody emailed in. They said, what kind are you having? I said, not PG. I'm going to Yorkshire.
You're calling it brown water for your
hot
1
brown
week
water.
stay.
Yeah,
I imagine you'll get kicked out of the hotel for that. Equity futures on the S&P, positive. They're negative, up and down and all around. We're down by about 0.1% on the S&P 500. On the Nasdaq, we're down by 0.2. A little bit softer here. The Russell's still higher by 0.14%. Flat equity market, down on the week last week, but pretty flattish anyway. We were down by just 0.1%, not even by 0.2. In the bond market, 2-year, 10-year, 30-year, 2-year still around 5%. 10 years still in the 430s, 30 years still in the 440s, going into the Fed on Wednesday, Tom, expecting an unchanged decision, but maybe some changes to that outlook and the economic projections they supply every quarter.
Am I right that they're going to, the guesstimate from Mike McKee is they're going to raise the growth view?
Growth up, inflation down for 23.
Not to Atlanta's stupidity, but, lift it up a little bit.
A little bit, and then look to 24.
Yeah,
that's where the surprises might
Let's
come
go back 9 months. We're on the edge of October here. We're talking about Halloween and $100 oil with Emerse Sen. Go back 9-10 months. Did anybody think the equity markets would be here with the data check John just did? No way.
How many stories have you read recently about how wrong everyone's been and how just people keep repeatedly getting everything incorrect? And I thought that was really interesting in light of this Financial Times survey of economists talking about how more than half of them think, or almost half of them, think that the Fed is going to raise at least twice more before they are done.
As I'm often reminded, they are year-end forecasts, so there's still 3 months left or something like that.
And they
Who
could
knows?
be right just late, right? I mean, honestly,
Sure.
they could have the correct thesis.
Could you
just
do a
have it
2024 outlook right now? Could you provide us with any insight whatsoever on what
I could
you
provide
expect
you
in,
with one.
in 2024? I
Would
got
be
no
right.
idea.
No, I can't.
24? No idea. We're going to be pushing out the recession game again? Is that what 24 looks like? Who knows?
I think I would predict there will be continued recession foolishness, and Neil Dutt has been brilliant on this. I think it's feasible. What we're going to do right now, this is really important. We're trying to piece together with the trip to London, the credit conference we'll be doing on Thursday. We're really trying to piece together 2024. They're the political conventions in America and that. But front and center for Bramo, John and myself, is we need tickets to the Paris Olympics. The only reason he's with us now with AXA Investments Paris, Gilles Moek is with us here. Give us an update right now on Mr. Macron, AXA, and the Paris boom you're going to see. Can Paris get any more boomier than it is now off the Olympics next summer?
Right, it's looking good. I guess tourism is helping a lot. So yeah, I mean, the city is having a good run. Gas is going to continue until the Olympics. Now the country around Paris, it can be a bit more complicated. We've had a good first half of the year. Things are starting to look a bit more complicated. So there's a lot of positivity at the moment in France because if you compare yourself to Germany, things are so much better.
Right.
Even the German Stellar stopped now, so it's quite unusual. But actually, if you look at the latest business confidence survey, it's not as bad as in Germany, but it's also heading south.
This is really important because I think to our listeners and viewers, particularly in America, when we say we went to France, we went to 3 arrondissements wrapped around Notre Dame and the wonderful repair of that cathedral. We don't have a real picture here of the greater European economy. We just see the boom of European tourism. Separate the European tourism from your caution on the rest of the European economy.
Yeah, I mean, definitely the weakness in the euro is helping from that point of view. So tourism is actually a function of that weakness. The rebound in the US, I think the appetite for traveling to Europe at the moment. But even in the most tourism-sensitive countries in the Eurozone, it's 15 to 20% of GDP at most. And the rest is the usual stuff that is dependent on either world demand in the generic sense of the meaning, or on consumer spending. And consumer spending in France, for instance, has been contracting for 2 quarters in a row. So we have to be, yes, a bit broader in our assessment of the situation.
It takes us to the ECB, so let's be slightly provocative in this question. Trichet 2008, Trichet 2011. Should we add Lagarde September 2023 to those?
Well, they're trying hard not to fall in that trap, because actually if you compare this with 2008 and with 2011, there was not a great sense of caution at the time when they actually hiked. There was a sort of self-righteousness of we are definitely delivering what we need to and we're probably going to continue. Whereas this time it feels very much like it's the last hike that we probably need, maybe for tactical reasons internally, to get the hawks on board. Also because I think it's true there is a resilience of inflation which is more tangible in Europe than it is in the US. But the entire body language from Christine Lagarde last week was about, yes, they're now selling the long for, the high for long, sorry. But in terms of further hikes, we're probably done. And I think, yes, what happened in 2008, what happened in 2011 must be on their minds. And even the hawks are getting a bit less vocal, I would say.
I've noticed the same thing. It begs the question about what we can learn from the European experience on the other side of the Atlantic. Do you think there are any lessons? You see Germany essentially go into recession and inflation's still a problem. Growth in Europe essentially stagnate and inflation is still a problem. Is softer growth the cure for what we're experiencing at the moment?
Well, I know that lots of economists, including myself, have been wrong on that for the last year, but history would tell you that it's very, very, very hard to get disinflation without proper pain in the real economy, especially when inflation is no longer about exogenous forces, it's about your domestic forces. So as long as proved otherwise, I would say that what's happening in Europe is probably a lesson for what might happen in the US, even if, yes, the US resilience is amazing at the moment. I guess a big difference between the two is that there's, I think, in Germany a more structural issue, which is coming back to bite them at the moment, which is to some extent, how to say, disconnected from monetary policy. They would be probably in a softer patch anyway, and that is dragging the Eurozone average down. But you want to kill inflation, especially when it started to get entrenched in wage negotiations. You probably need to engineer some sort of softening of demand. Now, there is not a lot in the textbook that would tell you otherwise.
Is Europe completely different than the U.S. when it comes to how well it can withstand the oil shock, or just perhaps the oil prices going back to something more normal on an inflation-adjusted basis?
Well, our big problem for the last 2 years has been gas rather than oil. But on average, we tend to be more sensitive to oil shocks than the U.S. for complicated reasons, due to the fact that even if we are less oil intensive than the US, the actual price of a gallon of gas in Europe is much higher than in the US, and people are probably more sensitive to that particular item. But if it was just about oil prices, I don't think we would be really concerned. I think most observers at the moment are more focused on what's going on with food prices. Hopefully it will continue to slow down. At least this is what wholesale markets would tell you for most of that. And gas. And we went through last winter much more positively than what was expected, we need to do it again this winter, and to some extent it's beyond our control.
Which feeds into the whole discussion of wage spirals, especially in light of some of the labor movement that we've seen in the U.S., but also around the world, maybe taking a page from Europe, if anything. How much do you think that that's more noise than signal, or vice versa, in terms of wages staying sticky and labor power continuing to be stronger than it has been?
No, I think there's something profound happening there, which is that there has been a change in the balance of power between employees and employers, and it's very trivial to say that, but in Europe, where we have in most countries a collective wage bargaining system, what we tend to have is more inertia in the way wages react. I mean, in the US, you could make the case that wage accelerate when people actually can leverage the job opportunities and go back to their employer and ask for a pay raise. It's not really the way it works in Europe. I mean, some of it obviously happens, but most of the pay increases here happen as a result of collective bargaining. And it always takes a while for instance, the unions to realize that maybe the economy has become softer, job opportunities are falling, maybe it would be time to move back towards wage moderation. But you need actually a proper proof that the labor market is softening. And even in Europe, and that's actually one of the big positives of our current situation, is even in countries which have been used to mass unemployment for decades, the current situation of the labor market is more than okay. I mean, take France, my country.
Right.
Unemployment rate at 7%. If you had told me that France would be able to deliver that 10 years ago, I wouldn't have believed you.
I got 8 ways to go here, but just because of time, then can you state Europe is vaulted beyond eurosclerosis?
I mean, eurosclerosis is, I think, in many cases, what we have is sort of a magnified version of what happens in the US in terms of demographic changes, for instance. We are a sort of more acute version of what is going to happen in the US anyway. But one point on which I think Europe at the moment is doing better than the US, it's on participation. The big positive right now in Europe is that our participation rate is rising and has been rising through the pandemic. It's today much higher than it was before COVID. It's exactly the opposite of what's been happening in the US, even if there has been a catch-up recently. We've put more young people, more older people back to work. And basically, I think we're benefiting from structural reforms which have been pushed through in Europe for the last 20, 30 years. Not spectacular ones, but gradually, I think we have a much better functioning labor market than what we had 20, 30 years ago. And it's definitely positive.
Jill, that is a bright spot. Thanks for being with us. Jill Moak of AXA Investment Managers. Europe finding itself in a very difficult spot after the ECB decision that we saw last week from President Lagarde and the Governing Council. It did feel like a bit of a trade-off, Tom, between Doves and Hawks. A deal that was struck just to get that extra 25 basis points. But as Jill mentioned, I think we've been talking about this over the last couple of weeks, even the Hawks on the Governing Council at the ECB weren't screaming for a rate hike going into this decision, which I think speaks to the moment we're at right now. I would say the same thing over at the Federal Reserve as well. If you hear from a hawk on the FOMC, they'll talk about the prospect of maybe going 1 and maybe staying there for a long time. But they're not screaming for 50, 75, pushing this much further than where we already are.
To go back to our early conversations, and particularly with Jeff Yu earlier this morning, it comes down to a mass adjustment over a new rate regime, and that the negative rate regime, I believe we have Folkers Landau with us here through the end of the week, and the answer is a negative rate regime is gone. And we're adjusting to that right now.
And likely not going back to it. Very short, just short of 92, very close to 92 on WTI, I should say. 91.99 on WTI just moments ago, 91.83 at the moment. And a 2-year yield that's higher by 3 basis points on a session, Lisa, 5.06% on the 2-year currently.
Markets are buying into the idea that the Fed might not cut rates in the future, at least not next year, or at least not until later next year. And that is the change.
Slowly internalizing that message in a much more profound way. If you are just joining the program, welcome to the program. The S&P 500 on equity futures right now, negative by 0.09%. In the bond market, 434. In the commodity market, we talked about that crude move at 91.80 and a euro 106.59. It's a quiet start to the week. The week really does begin on Wednesday. Got a couple of days of quiet mornings, I think, in store potentially, based on what's on the schedule. Then it's on to Wednesday when you get that Federal Reserve decision. Thursday for the Bank of England, Friday for the BOJ, and then you get some PMIs as well for the month of September, Tom, to end the week.
Well, they're end the week there, but I'm still recovering from this weekend. Thank you for teaching me about Formula One.
Oh, what a race, eh?
Singapore Lisa, it was nuts. They're on the streets of Singapore that I've been on. They're bouncy, bumpy. They're wicked narrow like Monaco. The violence, John, near the end of the race.
Serious endurance test.
Yeah.
That Formula One race is.
And
so I'm taking off. I'm at JFK yesterday morning in New York, and there's like 10 laps left. And we start doing that taxiing thing. I lose the signal, and I don't get to see the last like 5 laps of this race. And the last 5 laps of this race were just magic. You've got Russell and Hamilton and Mercedes chasing Norris, Lando in a McLaren, and Sainz in a Ferrari. And Russell goes off on what, the last lap?
He goes off in the last
Hamilton
lap.
can't
His
catch
tires just
Lando, and
wore out.
Ferrari get a win.
They were saying that Sainz, when he won, the tires were barely working.
Do you know what you did to him? He came to London and he spent an entire day watching Formula One.
I know he did.
Like literally the entire day.
Watched quali, and then watched the whole race.
Well, the difference is we had it on the Gulfstream. It was great. We had the feed on the Gulfstream, which was really good. Yeah,
must be nice.
David Livingston of Citigroup is coming up shortly. Equities right now down about 0.1% from London. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Fixed Income Fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
One important thing looking forward, different to the last 10 years, is uncertainty around inflation. So we see inflation coming down towards central bank targets, a little bit above, but coming down over the course of next year. But I think clearly there's much more uncertainty in the inflation picture for the next few years compared with the last decade.
Andrew Balls, Global Fixed Income CIO at PIMCO. Clearly, Senator Schumer is not my boss because I've got to put my jacket back on for our next guest. Equity futures on the S&P 500, slightly negative. We're down by 0.1% on the S&P 500. Yields unchanged, 434 on a 10-year. Eyes on crude, 91.88 right now, 91.99 just months ago on WTI, and just short of 95 on Brent, 94.78. High of the session was 94.89. And Rita Sen of Energy Aspects on the program with us a little bit earlier this morning. That headline was always going to catch on, wasn't it? Triple-digit crude by Halloween.
Yeah, of course.
Scary stuff, TK, going into the end of October.
Well, it is. I mean, at the end of October, what we're going to see are including Jobs Day, which we haven't even touched upon after the Fed meeting here, but it's fluid. But I'm sorry, 94.79 on Brent crude. Is there any other story all of a sudden for our listeners and viewers? When does a gallon of gasoline pop? That's all.
Oh, that's happening. That's happening, yeah. Bramo. Equities just a little softer then in the FX market. Going nowhere here, Lisa. On the euro, 106.50 58.
I wanted to take a look just quickly at the auto manufacturers, including Tesla, since that is sort of the other side of this whole debate and what they were doing. And what you can see right now is Ford and Stellantis very much negative. Tesla actually joining the crew, although they did pop earlier this morning after the Wall Street Journal put out a report saying that Saudi Arabia is in talks about possibly building some sort of EV factory in that nation. I am curious, though, about the Stellantis underperformance, down almost 2%. Is there a signal here in terms of the union saying no to a 21% gain in their salaries? Does this mean that the bar is going to be that much higher and there's going to be that much more in terms of profit erosions after years of record profits?
We're going to have to see. I mean, it's the union day. When does the president speak again? I mean, you know, what is the path forward Monday, Tuesday, Wednesday?
I spoke on Friday, and he actually handled this situation pretty well, I thought, based on his address on Friday, given how difficult this position is for him at the moment. We said a lot of weight was on his shoulders to come out on the side of the union and the strikers, and I think he did that in some ways.
Please stay with us. Of course, Balance of Power tonight with Anne-Marie Horton and Joe Matthew on what's going on in the United States. We're in London, and what that means is a sense of international banking for the banks of the United States. No one, not so much uncertainty, but is in a mode of restructuring, is Citigroup. Jane Fraser has called upon David Livingston to be her chief client officer, to pick up the pieces and to move forward for a stock that has been challenged coming out of the great financial crisis. David, thank you for joining Bloomberg this morning.
Tom, great to be here.
What's mission number one? What has Jane Fraser said to you? This is the marching orders. Go.
So we now have a structure which fits our strategy. So our strategy didn't change on Jane's announcement last Wednesday. What did change is the structure that's going to implement that. And in my new role as the Chief Client Officer, which is a new role in Citi, is very much to say we cover clients around the world, tens of thousands of them and millions of them in the US in our personal banking business. Are we doing it the best way we possibly can? Are we as coherent as we can? And are we delighting them as much as we possibly can with our capabilities? And so the number one is to make sure that we bring that dimension through all of our decision making.
You were an undergraduate in Australia a few years ago. It's the same then as it is today. You have to have a distinctive defining feature. What is going to be the defining feature of Citigroup 5 and 10 years out versus the other major U.S. banks?
Always going to be two dimensions on that. One is the fact that we offer the broadest set of capabilities, and particularly institutional client capabilities of anyone. And secondly, we do it on a geographic dimension, which is we are the most international organization. We do business in 160 countries around the world, and that serves our client base. That's those clients with cross-border needs of whatever nature, financing, payments, advice. That will continue to be the distinctive feature of Citi.
David, the uncomfortable conversation, it always is, job cuts. Are they focused or going to be focused on specific geographies or functions? How's that going to work? What's the approach?
So I think, firstly, job cuts is not the story here. It is unfortunate. We will have people leaving the organisation, some very talented people leaving the organisation, but that's not where we started. We started with the need to simplify our structures and our management routines, and therefore the job cuts are the output. They are going to be, as you've seen, that there is my former role as the Chief Executive of Europe, Middle East and Africa, that layer, the Asia-Pacific layer and so on, they are being taken from the organisation, as are some of the capabilities that we had sitting above our products, which now our businesses report directly to the CEO. So it'll be in those areas where if you like, the reduction in the number of roles that we need will be felt.
Do you have a decent idea of numbers already?
We're not talking about numbers at this stage. We're talking about the strategy and the change in structure.
Because you don't want to focus on them, but internally there must be an assumption of what the number is right now.
There is a sense, but again, that's not exactly where we're spending the core focus of what we're doing.
The reason why we're talking about things like this and the reason why people pick up on the idea of job reductions is because it seems like even though banks had been looking for higher yields for so long, it's been difficult to pass them along in a meaningful way at a time where people are worried about recession, people are worried about the ability to repay those loans. How much are you expanding your loan book? How difficult is it at a time when you are seeing those concerns about recession looming on the horizon?
Different answer in different parts of our business and different by geography. If you take the United States, for example, the US is as we know, flush with liquidity, which has been stimulus, which is from the US government. And so therefore, loan growth and demand at the consumer level and even the institutional level has been a bit more muted. If you take also what's happened to interest rates, particularly companies are looking and saying, what is the profile of interest rates and when is the right time to borrow, particularly entering into long-term commitments. And it's not that there's no activity, but there is cautious activity in terms of more autonomy and authority in order to be driving, which is happening within their geographic clusters, which means that they address the situation that's relevant in order to be driving the client activity, which is happening within their geographic clusters, which means that they address the situation that's relevant in front of them.
You are deeply experienced at this, and it's outside your remit to talk about shareholder return, use of cash, etc. But the crushing disappointment from Mr. Weil to Ms. Fraser has been the share price. It just hasn't moved off the 10-for-1 reverse split of 2007. How do you counsel Jane Fraser to move that stock price higher to where your competitors are?
So I think Jane takes counsel, of course, from many people, but I'd say she also is able to be decisive in her own right. I think what she's done in terms of this reorganization, again, where our structure now fits our very, very clear strategy, is that we have the best possible platform now in order to make it clear what our return potential is, because ultimately it's returns that will drive the share price, and we need to be able to demonstrate that to our investors.
Let's finish on some easy stuff. What's office attendance like in London at the moment for you guys?
It's improved, and
is it better than New York in London?
Yes, in some parts, I think it is. But they're actually New York and London pretty much on a par. But I think it's becoming very clear, not only to management, but also to our broader organisation, that being in the office is just so much better.
Are you making the 5-day push?
Well, our policy is three days as a minimum. So
is that
that's
going
where
to
we
become
are.
4, then 5?
We'll see over time.
David's not wearing the shoes with the white soles. Just
no
so
hybrids
you know.
here.
No hybrids here. David's, I'm looking down here. It's you know.
David, thank you. David Livingston, Citi.
Thank you.
Appreciate it. Fantastic. I know that was something you were focused on, Tom, coming over to London. Office attendance here compared to, say, New York.
My sense is that here it's better than, I wouldn't want to editorialize, but then the disgrace in New York.
Given the direction of travel, it starts at 3, Bramo. You know what happens. Then it becomes 4.
100%.
And then it's like 5.
Basically, this is the global executive class coming out and being like, it didn't work for a lot of jobs, and you need to come back to the office, and sort of easing into it with workers pushing back and now getting a better sense, okay, I need to relocate back to the city I was working in.
It's celebration time, Bramo. We're going to take Bramo to the pub. Get Bramo a pint. We can do that because it's 1:56 in London, so that works, doesn't it?
100%.
5 o'clock
I
somewhere.
saw people at noon with big pints.
Coming up on Bloomberg TV, don't miss this, the Stellantis CEO at noon Eastern Time. Live from London, more through the week from us. Thank you for choosing Bloomberg TV. This is Bloomberg Surveillance.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Could be that given that we have this productivity enhancing technology that is AI, that has come off the back of this transformative communications network that's the internet, and we have a fundamental shift in the way the energy system is working. So there could be the ingredients of a pivot point of a kind that we've only seen a couple of times previously in history.
But let's ask what the driving forces will be. The world is propelled forward and has been for thousands of years by great power competition. That is the thing that drives innovation right now across the board. It is a competition which is intensifying between two superpowers, the United States and a communist-led superpower. Now, is this starting to sound familiar?
It does.
So what is really significant about this historical moment is that we are in the first inning, the early phase of Cold War II.
Right.
And that is going to drive all the things that we've talked about, and it will not necessarily drive these changes in directions that are benign. That the big technological advance of Cold War I was, of course, nuclear weapons. And the arms race with nuclear weapons was an extremely dangerous one that very nearly blew the world up, particularly in 1962, at the time of the Cuban Missile Crisis. I don't believe for a minute that we can have a Cold War II without a similar risk.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
From New York City, for our viewers worldwide, I'm Matt Miller, in for my good friend Jonathan Farrow. We're looking at markets right now that are doing a heck of a lot of nothing in terms of the equity indexes, right? S&P futures right now down just 0.1%, a little bit less. Russell 2000 futures gaining about 0.2%, but oil continues to ride. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up, Treasury yields testing multi-year highs as well, with global central banks in focus all week. Auto workers remaining on strike after the UAW calls the latest offer a no-go. And the UN General Assembly kicks off amid simmering U.S. tensions with China. Don't try and drive in Midtown Manhattan. We begin with a big issue, looking ahead to a Fed rate decision.
There's obviously a pretty critical Fed meeting.
The Fed will do what we all expect it to do.
They'll pause.
Pause.
It's going to be probably a hawkish pause.
A hawkish pause.
The pause, but an indication that they're prepared to do more.
Leave the option open that there'll be another hike.
They'll keep wide open the possibility of another hike.
I don't think they can say they're done. They're going to remain vigilant.
November is really what the market is going to look towards.
We may very well be at the end of rate hikes.
We see inflation coming down.
They're going to raise rates in November.
The economy is still growing above potential.
It's a really tricky needle to thread in terms of doing just enough, but not too much.
Whether they hike again in November is yet to be seen.
Joining us now to discuss is BlackRock's Marilyn Watson, as well as Nuveen's Anders Persson. A lot going on in terms of the Treasury market, a lot going on in terms of oil, not a lot in terms of stocks right now. Marilyn, what do you think about 434, 435 on the 10-year?
Yeah, I mean, I think, as you say, this is a very, very busy week for central banks. I think the market has just been trying to really absorb the price of oil, try to absorb the recent data that we've had in the US, which continues to be, pretty positive overall. And I think, this week our view is that the Fed will, continue to pause, be on hold this week, and then, but they'll make it very, very clear that they are still data dependent and that, November, we'll see what happens. But I think the market's just trying to really position itself and gauge what's going to happen this week, because we also have, the Bank of Japan, which is potentially more of an unknown. We have the Bank of England, we have a range of central banks. And I think given the focus on those, I think the market's just sort of, moving around with that.
Anders, what do you think? I mean, right now, back up to 435 on the 10-year. It's been a choppy morning for the yield trade, but you don't sell these bonds going into the pause, do you? Expecting a Fed hike coming later?
Yeah, at this point, we're certainly not expecting a hike this week. I think it's going to be this kind of hawkish pause that a lot of people have been talking about. I think they're going to reiterate this message from Jackson Hole to proceed carefully, kind of staying data dependent. And the big question mark is, are they going to do something in November? And the markets are pricing in roughly a 40% probability of some kind of move maybe later in the year. But right now, I think they're going to try to buy some time. I think really the markets will probably look at the dot plots a fair bit, kind of see if there's some changes there, particularly for the 2024 kind of type dot plot. Because from that perspective, we had 100 basis points cuts kind of lined out from the Fed. We think that could maybe change to 75 basis points. So a little bit of new messaging from that perspective, but all in all, not expecting much fireworks this week from the Fed.
Marilyn, what do you expect from the dot plot and from November? I mean, this market has been overly optimistic throughout this Fed rate hike cycle.
Yeah, so in terms of the dot plot, as you know, at the moment it's essentially showing sort of 5.6% year end this year, down 4.6% end of next year. I think we'll be focusing on, we expect them to remain pretty much the same for this year, given that while we think they'll be on hold, they are still very, very data dependent. The question is, I think, more whether we could see an adjustment to that, but more I think it's, again, next year, what could we see, whether we expect to see, or whether the voting members expect to see rates higher for longer. And as we do expect, at the moment they're showing a cut of 1% in total next year, but from where they currently think they'll end this year. But we could see, next year and also further out into 2025 as well. If they expect rates to be higher for longer, then I think that will have an impact.
What has to happen for a 1% cut, Marilyn? What has to happen for 4 cuts next year?
So at the moment, the economic data, I think, has consistently surprised to the upside, both for the FOMC as well as for many market observers as well. And I think what we would need to see for them to change, or what they're expecting next year, is to see if they were to, maybe reduce their forecast further for next year in terms of interest rates. We would probably have to see more deterioration in terms of economic activity, the US economic outlook. Also in terms of inflation, it has been moderating, it is coming down, but it's still above the target. And so, but I think really what we would need to see is a deterioration really in economic activity, in GDP, in the unemployment rate, in the labor market. And at the moment, we're just not really seeing that in terms of the data.
All right, Anders, Marilyn, sit tight. I want to get over to Mike McKee because, early this morning, I thought crude had to be the asset class to watch today. But you look at these intraday graphs, and yields are just taking off right now. The Fed obviously headlining this busy week of central bank decisions, with the Bank of England and the Bank of Japan among the others meeting, and maybe the latter being more interesting. But Bloomberg's Michael McKee joins us now for more as we watch. We just saw almost 508 on the 2-year. We're looking at 435 on the 10-year. They're taking off.
They're taking off, and it's because who needs the UN General Assembly, Matt? We've got the Global General Assembly of Central Banks. Not only did that chart show you a few of the people who are meeting beyond the big three, but we have meetings this week for central banks all over the world: Indonesia, Philippines, South Africa, Sweden, Switzerland, Taiwan, Turkey, Egypt, Brazil, Norway. Just the list goes on and on and on. And in general, most of them are going to be looking at raising rates, or at least sounding hawkish as inflation continues. And now we see those oil prices going up. The big three will get the big attention, however, and rate hike odds, as you mentioned, Matt, are getting a little interesting. The Fed, nobody cares. They don't think the Fed's going to raise rates this meeting. It'll all depend on what Jay Powell says. But the Bank of England is pretty much priced in for another move. And then you take a look at the Bank of Japan. It's been a long time since people really traded on the idea that the Bank of Japan might do something. They don't think they will actually raise rates this month, but they do think that what we're going to see at some point here is them getting a hawkish tilt towards their policy because inflation has risen high enough. And you can see there that they are going to be the most interesting of them all because the Bank of England and the Fed have already raised rates so much. Look how far back you have to go to see a movement in the Bank of Japan's base rate. The number to watch, though, this fall or this Friday is the dollar. Once we get through this week of all these central banks moving, where does the dollar end up? We've seen the dollar index continue to rise as the Fed has raised rates, and that'll be a signal to the rest of the world about where we are going now. If the world thinks that maybe the Fed has slowed down, then we will maybe see a little bit less pressure on the other central banks. So right now, keep an eye on oil prices going into the week. At the end of the week, let's see where the dollar is.
Yeah, we're looking at $92 now for WTI, West Texas Intermediate on the NYMEX, $94.84, so nears the to $95 for Brent. What do we look for in the dot plot, in the SEP? I think we get that this time, in the face of rising oil prices.
Well, we're probably not going to see a whole lot of change, Matt, because we don't know how long those rising oil prices are going to, A, continue to rise, and B, how long demand is going to hold up for gasoline prices when they start going up. So the Fed can't really forecast that. But look for the dot plot to still retain the idea of one more move this year because they don't want markets to start pricing cuts. And then look for the summary of economic projections to suggest we may have a little bit stronger growth and a little bit less unemployment than the Fed had forecast going forward. We'll want to see what they say about inflation as well.
All right, absolutely. I hope we don't hear the word transitory, though, even in relation to oil. Mike McKee there with a look ahead at this busy central bank calendar. Sticking with central banks, Nouriel Roubini delivering a warning to the BOE and the ECB. Take a listen.
The problem is that the Bank of England right now is sending sort of dovish signal in a situation in which the policy rates are well above the Fed, but inflation is well above the United States. So what they should be doing is actually hiking rates all the way to at least 5.75. The signals are telling us right now is they're not sure whether they want even to hike more. If that happens, there could be a de-anchoring of inflation expectation. You could have a true stagflation. That's a dilemma for both the ECB and the Bank of England.
Marilyn Watson and Anders Persson back with us. Anders, let me ask you your take on the other central banks. I mean, how close are you paying attention to what happens at the Bank of England, what happens at the Bank of Japan, considering that the Fed has been driving policy globally until now?
Yeah, no, at this point, you definitely have to pay attention to all these kind of key central banks for sure. I think, certainly the Fed is still setting the tone more or less globally, certainly here for the U.S., but I think all these data points are important. I think Bank of England, I think, is probably in the most tricky spot right now of most central banks. We do expect, as Michael mentioned, as the market is expecting one hike here coming to 5.5% and maybe one more after that as well. I mean, it's just a very tricky environment going on in the UK at this point more broadly. The Bank of Japan is probably going to be a little bit less influential here for the near term. I think the market has already kind of accepted that the yield curve control is playing through a little bit here, and I think overall that's been fairly well messaged in the market at this point. So all in all, I think the focus will quickly go back to the Fed and potential next steps that the Fed's going to be doing in the November timeframe.
Marilyn, what's your take? I mean, everyone's excited about the Bank of Japan because it'll actually, potentially do something interesting and different. But does it matter as much?
So it does matter. And I think in particular, it does matter increasingly going forward as we do see the Fed get to the end of this rate hiking cycle. And then we look at the divergence in terms of the economies, the economic activity of the different regions. I mean, we're seeing increasing divergence between the US economy, the UK certainly, the Eurozone, and then Japan, again, is in a very different situation. So I think it does matter, and it will matter increasingly as we do start to see, this divergence in terms of when central banks get to the end of the hiking policy, but also in terms of economic activity, prices, valuations, and then where investors can find opportunities globally, in the different regions and in the different, financial asset markets as well. So I think as we do see, the Fed potentially pause and get to the end of the cycle, I think it does matter, and I think it matters for investors to be able to really be nimble and really get at the different opportunities that we'll see as we do see, a dislocation potentially between market pricing and the opportunities for investors.
All right, looks like we bounced off 148 yen to the dollar with greenback strength continuing, but maybe that's a level to watch. Marilyn Watson and Anders Persson are sticking with us, joining us now with a look at the stock market ahead of the opening bell. Here's Abigail Doolittle. Abigail?
Well, Matt, we do have U.S. futures lighter by just a little bit. Let's take a look at what's weighing, starting out with the shares of PayPal, down about 1.7%. This as MoffettNathanson has downgraded the stock to a market perform from an outperform as the growth outlook slows. Lisa Ellis is saying that profit growth will remain anemic and EPS growth is slow as PayPal is facing fierce challenges. Tesla had been higher earlier in a Wall Street Journal report that Tesla and Saudi Arabia are in early talks for an EV factory, but with yields higher pressing big tech down. Ford down 0.8% along with Stellantis. This as the UAW strike is in its fourth day, so a little bit of soft stock action this morning, Matt.
Yeah, very interesting developments on that front. A 21% pay rise offer pushed aside at Stellantis by the UAW. Thanks very much, Abigail. We're going to talk more about the union coming up unmoved by this sweetened offer.
So 21% is a no-go for you?
It's definitely a no-go, and we've made that very clear to the companies.
U.S. auto workers extending their strike to a fourth day. That conversation up next. This is Bloomberg.
We can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but expand is expand. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
So 21% is a no-go for you?
It's definitely a no-go, and we've made that very clear to the companies. We're prepared to do whatever we have to do, so the membership is ready. The membership is fed up. We're fed up with falling behind. It's been decades of falling behind.
UAW President Shawn Fain rejecting the latest pay raise from Stellantis, the automaker calling the offer a compelling solution for protecting jobs at an idled Jeep plant in Illinois. The disagreement signaling, though, that the union and Detroit's Big Three are still pretty far from a deal 4 days into the strike. Bloomberg's David Welsh joins us from Detroit. He's our bureau chief there and has been covering this very closely with his team. David, you know, we focus so much on the pay part of their demands, but the union has asked for a lot more than just a 36% pay increase at this point. They also want to bring back defined benefit pension plans, and I believe they're still sticking to a 4-day work week. What's the status of the demands from the UAW?
Look, they still want those things. The companies, if you look at their offers, that stuff's never in there, particularly the retiree stuff. They've even asked for retiree health care. Those are the two big ticket items that just weighed down the balance sheets of all three companies, played a role in driving GM and the former Chrysler into bankruptcy. Ford had to borrow $24 billion to stay out of bankruptcy. They're not going to do that. The companies will take a very long company-wide strike before they would agree to those, fixed retiree benefits. They are willing to move on pay, obviously. They're already up over 20%, and I think they'll continue to bump that, not interminably, but they will. That's something they can play with. But those other retiree benefits and the 32-hour work week, I don't think they'll budge on either one of those.
In terms of the damage this could do to companies, when you think about handing out a 21% pay increase to so many tens of thousands of workers, you might worry that it bankrupts GM, Ford, and Stellantis. But they've done well, and it's not actually a huge part of the cost of a car, is it, labor?
No, I've seen estimates. It's somewhere between 5 and 10% is the cost of labor. There's a lot of other labor in there from the suppliers, but they wouldn't all be getting 20% raises. So, yeah, it will bring their costs up. It will bring their labor costs would definitely be uncompetitive with Toyota, Honda, Tesla, Hyundai, and Kia. They'll be in a worse position. But there are two things. One, it's not the kind of money that bankrupts the companies. It eats into what are now very good profits. And two, these other companies, and we've seen Toyota do it over the years, they've had to raise compensation and improve benefits to keep the UAW out of their plants. You can't be at a $5, $8 labor disadvantage versus a UAW contract and expect your workers to not maybe listen when a union organizer comes around. So union contracts do, and they have, raise all boats. Now, they've always stayed, something under what the UAW can get to maintain the advantage, these other companies. But they will end up having to pay more as well if they want to keep the UAW out of their factories.
Yeah, it's a very interesting point in terms of the competition, and it'll be interesting to see if a win here for the UAW can actually get them into some of those competing plants. David Welch has been covering this. We'll continue to, obviously, the big story, I would argue, not just in Detroit, but nationally right now. Marilyn Watson and Anders Persson are back with us, and let's talk about how this strike could translate into the fixed income world that you guys are so focused on. Marilyn, clearly it's going to drive up compensation, so there's the concern about a wage spiral, driving inflation further. Is that the only connection that you can see?
So I think it certainly, highlights the strength of the labor market at the moment. And I think in terms of the fixed income market in the long term and what that means, also when you look further down the line at monetary policy as well, I think that, one of the factors to really bear in mind is that the US has an aging population in terms of demographics. You're seeing, many people becoming of pensionable age. You have a workforce that, you don't have the same supply in terms of younger workforce. And I think we'll continue to see these pressures for some time in terms of, we've already seen the last couple of years, particularly since COVID, just how strong the labor market has been, how there's still a deficit in many areas in terms of getting the number of employees in different sectors back to pre-COVID levels. We've seen pay rises, across the board in most different industries. And so I think, in the long term, it just really highlights the fact that it is an aging population, that the economy is still very strong at the moment. And we've already seen this in other sectors where we have seen wage rises.
Anders, obviously, wage price spiral is the phrase that was eluding me there. It doesn't seem that monetary policy is really holding that back. What connections do you see with the fixed income world that you run at Nuveen?
Yeah, no, I would echo those comments, basically. I think the broader dynamic here is more key here, that the labor market remains very tight and wage pressures really haven't eased sufficiently. I think the Fed is going to keep a very close eye on that. And you know, more broadly, these kind of type actions and discussions is going to put pressure on wage prices and inflation moving forward overall. That being said, I think it's important to keep in mind that you know, from a credit perspective, we're not expecting these discussions to really put a whole lot of pressure on these issuers. You're seeing bonds and stocks and CDS, for instance, holding up just fine for GM and Ford and what have you. So it's been pretty well flagged, and we're not seeing much deterioration from that perspective. So I think investors, you know, they basically appreciate that this is an uncertainty, but you know, this industry and this sector has come a long way and is pretty well positioned. And so I think there's a balance there that we're trying to make sure that we're kind of basically taking into account at this point.
All right, Anders, thanks so much for joining us. Anders Persson there from Nuveen, Marilyn Watson joining us from BlackRock. Pleasure having you on the panel today. Coming up, the morning calls, and then later Morgan Stanley's Andrew Slimin joins us, making the case for an equity rally in the next quarter after this September lull. That conversation still ahead. This is Bloomberg.
Maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. You know, my job's far from done.
Time now for our morning calls. A look at some of the analyst recommendations on Wall Street that could affect the market this morning. First up, MoffettNathanson downgrading PayPal to a market perform, expecting softer EPS growth due to mounting competitive pressures there. Next up, Guggenheim upgrading Ralph Lauren, or is it Lauren, to a buy, seeing an attractive entry point with shares 14% down off of this year's peak. And then finally, Deutsche Bank upgrading Micron, the chip maker, to a buy, saying recent checks point to improving chip prices and strengthening demand for that sector as well. Coming up, Morgan Stanley's Andrew Slimin on why he expects stock to rally heading into the year end. That conversation up next. This is Bloomberg.
crucially important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
This is the countdown to the open. I'm Matt Miller for John Farrow. We've got equity indexes moving down for the big caps, not so for the Russell 2000. You've got an all-star lineup of bell ringers at the NYSE and the NASDAQ moments away from the start of trading. Here are the opening bells. One stock to watch at the open, we're going to get to in just a moment. Here you see the euro dollar at 106.69, the 10-year yield. That's really the stock to watch, is the 10-year yield, I think, or the price of oil. Both of them soaring to highs that we haven't seen in months, if not years. 435 almost on the 10-year. NYMEX crude at 91.86. So there you go. Former Vice President Al Gore ringing the bell at the NASDAQ. One stock to watch at the open, I was going to say Apple. Shares edging higher as pre-orders for the new iPhone 15 surpass expectations. Bloomberg's Abigail Doolittle is here with more on Apple. Abigail?
Well, Matt, it's interesting because there's a little bit of a mixed picture in terms of these pre-orders. Let's save the bullish picture for the end to end on a bright spot. But there are a couple of analysts out there saying that these pre-orders for the iPhone 15 might be a little bit flat. In particular, Barclays is saying that the early pre-order data point that China continues to point to a difficult iPhone 15 cycle with a negative mix shift, meaning trending toward the lower end phones. Bernstein saying historically Apple, the stock, has treaded water a bit after these iPhone launches. That is true right now. We have Apple breaking down to some degree, down more than 9% or around 9% in this quarter. Although today we do have Apple up 1.1%. So let's get to the positive. Morgan Stanley saying that the early iPhone 15 pre-order data is good. And Wedbush going even further, saying that the trend is toward the higher end phones and that it could be 10 to 12% above the iPhone 14 orders. Most important, Matt, I think to some degree are the numbers. This company has been showing over the last few quarters negative growth for both top and bottom line. The first quarter of their fiscal 2024, which is the December quarter, is expected to show a return to growth. If they can have that growth for the December quarter, well, Apple might come out of its recent doldrums.
All right, Abigail Doolittle there on Apple. Let's turn to the media space right now. Disney holding preliminary talks with potential buyers for its India streaming and television business. Bloomberg reporting Disney is weighing strategic options for the business, including an outright sale or setting up a joint venture. Plus, heck, we've had so much news on big asset moves over at Disney. Let's bring in Bloomberg's Ed Ludlow from the West Coast here in New York.
Yeah, good morning. Good morning to you, Matt. Disney modestly lower, 0.3%. What Bloomberg sources are saying is they could take the Disney Star property in India and sell it outright, or they could do more of a piecemeal approach where they take the sporting rights that are India-based and the Disney Hotstar regionalized streaming platform, put them in combination. As you said, Bloomberg had also reported first in July that forming a joint venture in the region is an option. It's interesting because one of the parties in talks, according to Bloomberg sources, is Mukesh Ambani's Reliance Industries. That goes back to Disney losing the rights to the Indian Premier League cricket in that nation. Where did those rights go? They went to a JV between Mukesh Ambani's Reliance and also Paramount. So now Disney looking at his options, an outright sale potentially, a joint venture, or a more piecemeal deal where specific rights and properties sold off. By the way, the stock's off to 0.2%. It was initiated at Raymond James this morning with an outperform. And their argument's basically like, it's been a horrible time for media companies, but beyond that, cash flow looks good, valuations look good compared to the rest of the sector.
All right, Ed, thanks very much. Ed Ludlow there taking a look at Disney for us. Now, a cybersecurity incident that affected Clorox last month has been contained after addressing the unauthorized activity. The company saying the attack damaged portions of the IT infrastructure, which caused wide-scale disruption of Clorox's operations. The company now believes the impact will be material on Q1 financial results. Simone Foxman here with more. You'd rather hear marginal there than material, wouldn't you?
I think you would, and it's unclear, the company says, if this will actually weigh on its full-year guidance as well, and that's why we're seeing shares fall in today's trading, now down about 1.5%, weakest since early February. But more details of this cyber attack is really that it's continuing to have all these impacts on operations. The company's saying it's operating at a lower rate of order processing, and that customers are feeling some of the impact of product availability issues. It damaged the IT infrastructure that the company has, and I think this is really concerning as well. The company isn't going to be able to move back to its normal automated processing for orders until the week of September 25th. So we're not already back where the company should be. Now, this will have a material impact on the Q1 financial results. That is the quarter that ends in September 30th. But the company's saying, again, it's premature to look at the year and potentially see an impact there. Bloomberg Intelligence is saying that this is really a concern for the company as it tries to transition from this price hike-led sales growth to the volume-led sales growth, has the potential to weigh on margins, and that's clearly being reflected in trading today. Matt.
All right, Simone, thanks very much. Clorox down 2% at the open. Let's turn to the IPO market, stories around which have been very hot lately. Online grocery startup Instacart has been flirting with an IPO for years now, and it's finally taking the plunge, making its trading debut tomorrow. Bloomberg's Sonali Basak has more. Sonali?
Matt, you're looking at Instacart, which will price tonight, start trading tomorrow, as you've been saying. And last week, after the successful ARM IPO, Instacart and its bankers went ahead and increased its price range. Now, at the high end of the price range, you would have a company worth more than $9 billion, almost $10 billion. And while that's below its most recent funding round, where it was valued at about $13 billion, the name of the game for the IPO market is no longer high flying. The new game in town is smooth sailing. So you do have these companies now looking to set expectations, make sure that they're making it into the market with a popular IPO pop. These pops, as we saw with ARM, could be muted at first, but you saw ARM continuing to hold steam into the next day of trading. Now, one thing Instacart has on its side so far is the cornerstone investors that it has lined up. Even though the market is watching the story on margins moving forward on Instacart, you do have PepsiCo coming in as an investor into the IPO, as well as cornerstone investors that could take up 60% of the shares. That includes a division of Nordea Bank and Dan Sundime's D1 Capital. Now, do those names give the market enough heat to buy into the stock? One thing these firms have in their favor is timing. They're all coming ahead here of that big Fed decision on Wednesday. They're trying to get a calm market into their debut. Klaviyo, the following day, has also increased its pricing range. Will price tomorrow night, trade Wednesday.
All right, Sonali, thanks very much. Sonali Basak there on IPO Watch. Let's get to Morgan Stanley's Andrew Sliman right now. He has been making the case for a rally in the fourth quarter, writing, quote, underweight to equities will likely become more painful into year end. According to consensus estimates, earnings are likely to inflect from negative or flat to in 2023 to positive in 2024. Investors should greet the resumption of positive earnings growth warmly. I'm pleased to say Andrew Sliman joins us now. Andrew, great to get you on this. You know, as we start to see all of the bears throw in the towel, has every last one capitulated, and wouldn't that make you nervous?
Sure. Well, it's one thing to say that you've turned from bearish to bullish. It's another thing if you put your money where your mouth is. And if you go and look at fund flows on a weekly basis, that follows from funds and ETFs, they remain negative on a weekly basis. And that is very symptomatic of the early stages of a recovering bull market off a bear market low, where investors are sellers. It happened in 2020 off the March low. It happened in 2009 off the great financial crisis low. Investors sell into the rally. That is consistent with the first stage of a bull market. Eventually they capitulate and they turn back and go in, but that hasn't happened yet. So it's one thing, sentiment is one thing. I watch what people do with their money. I think that's much more significant.
That's exactly, well, it's paraphrasing what Alan Greenspan, I believe, said, Andrew. In terms of valuations, what's the best measure to look at? Is it still, you know, forward PE, and where do you put that?
Well, what Wall Street is classically overconfident in is their ability to predict earnings. I mean, it is yet again this year has turned out to be a better earnings year than what many on Wall Street predicted. So what I watch much more is revisions and what companies are saying versus what's expected. And you know what? That's turned out recently to be better than expected. So that number for next year, the consensus is somewhere just below $250. That's come up recently. And so I think that's more important. There's no question that interest rates weigh on multiples, but I think in a recovery earnings, we're going to get a rally first and then ask companies to deliver on what's expected next year. So I suspect this year will turn out to be an even better year for equities than next year.
In terms of the headwinds, are you concerned about, you know, the consumer seems to be putting a lot more on plastic. Default rates on credit cards are rising. Same is true with auto loans. Student loan payments are going to resume. Oil prices, we're looking at $92 a barrel now for WTI, 95 for Brent. Households have run out of excess savings. I mean, the bearish list could go on and on and on, but I'm not sure how you feel about it.
Yeah, I mean, many of those statistics are what the bears throw out, but really has the household run out of excess savings? I mean, energy as a percentage of a consumer's expenditures continues to drop. Am I worried that the Fed is raising rates, interest rates moving higher tends to deter economic activity? Of course I'm concerned, but I think the story is that it's very hard to know when that will occur, and the simple reality is the consumer and corporations fixed a lot of debt during COVID so that they're less interest rate sensitive than they've been in the past. Doesn't mean it won't have the same effect, it just will take longer, and I think that's really what the story is. The inverted yield curve is telling you there's a slowdown out there. It's not very good at telling you when, and I take comfort from the fact that we keep pushing out the first Fed cut. I don't want a Fed cut because that's a sign of the economy weakening. The fact that we keep pushing that out, the fact that the 2-year yield remains high tells me the economy is stronger than what many people predicted.
What sectors do you like, Andrew? Because we've obviously seen most of this year's rally supported by only one, not even one sector, just a handful of companies. Do you see a broadening out? Do you like something besides tech here?
Sure. Well, but yeah, I mean, I like growth and I don't like value, or I don't like value, I like growth. I think you want a combination. What is clear, and again, consistent with the first leg coming off a bad bear market is the worst performers are the defensives. And lo and behold, that's because, last year the market went down, defensive stock, consumer staples, utilities, etc., healthcare, they held up the best. And so what do investors do at the end of last year? They all piled into dividend-paying strategies. It was the #1 selling strategy last year, and yet that's lagged this year. So I think you want to have a combination of growth, technology, and value, financials, energy. And right in the last month or so, energy has really done very, very well relative to tech. So I suspect going into this fourth quarter, you'll get money coming back into many of these well-known cap names because they're liquid, they're easy to buy, and I suspect that their quarterly earnings won't disappoint.
Andrew, great to get some time with you. Thanks so much for joining us. Andrew Sliman, they are coming to us from Morgan Stanley. Coming up, GOP tensions looming over a potential government shutdown.
I want to make sure we don't shut down. I don't think that is a win for the American public, and I definitely believe it will make our hand weaker if we shut down.
Our team coverage up next. This is Bloomberg.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Could be that given that we have this productivity enhancing technology that is AI, that has come off the back of this transformative communications network that's the internet, and we have a fundamental shift in the way the energy system is working. So there could be the ingredients of a pivot point of a kind that we've only seen a couple of times previously in history.
But let's ask what the driving forces will be. The world is propelled forward and has been for thousands of years by great power competition. That is the thing that drives innovation right now across the board. It is a competition which is intensifying between two superpowers, the United States and a communist-led superpower. Now, is this starting to sound familiar?
It does.
So what is really significant about this historical moment is that we are in the first inning, the early phase of Cold War II.
Right.
And that is going to drive all the things that we've talked about, and it will not necessarily drive these changes in directions that are benign. That the big technological advance of Cold War I was, of course, nuclear weapons. And the arms race with nuclear weapons was an extremely dangerous one that very nearly blew the world up, particularly in 1962, at the time of the Cuban Missile Crisis. I don't believe for a minute that we can have a Cold War II without a similar risk.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
I want to make sure we don't shut down. I don't think that is a win for the American public, and I definitely believe it will make our hand weaker if we shut down. I gave them an opportunity this weekend to try to work through this, and we'll bring it to the floor, win or lose. I believe we'll get agreement this week.
That was House Speaker Kevin McCarthy speaking yesterday as tensions rise on a possible government shutdown. House Minority Leader Hakeem Jeffries saying, quote, "The House Republican civil war is hurting hardworking American taxpayers and limiting our ability to be able to solve problems on their behalf." Let's bring in Bloomberg's Kaylee Lines in Washington for more. So, Kaylee, it looks like the Speaker making some pretty adult statements there. Is the class going to listen?
Well, this is the question, Matt. We are now just 13 days out from a potential government shutdown, and so it was a working weekend for House Republicans. We do have on the table now a deal between two very key factions, the far-right House Freedom Caucus, which includes many of the members that are giving Speaker McCarthy a headache on this issue, and the center-right Main Street Caucus. They have a deal that would temporarily fund the government for 31 days, so through October 31st. The issue is, even if it can pass the full House, which remains a massive question because Speaker McCarthy is going to have great difficulty getting enough members in line with only a 4-vote margin of error, it wouldn't necessarily pass a Democratic-controlled Senate or be signed into law by the Democratic president, Joe Biden, who would have to sign it once it comes across his desk. The reason why is this measure that they have agreed to would include an 8% cut to domestic agencies funding everything basically except for veterans and the military. Also includes some measures on the border, like resuming construction of a border wall, making it more difficult for migrants to claim asylum in the U.S. It also doesn't include any funding for Ukraine or disaster aid that the Biden administration has asked for. So it's likely a non-starter if it can even get through the House of Representatives. That said, the Rules Committee is going to take it up today. They're planning a full floor vote in the House on Thursday. It's just not really clear that this measure is going to get us any closer to averting a government shutdown. And Matt, the clock is ticking louder and louder.
Absolutely. Kaylee, thanks very much. Kaylee Lines there covering all things Congress for us out of Washington. Turning now to foreign affairs, National Security Advisor Jake Sullivan met with Chinese officials in Malta over the weekend, discussing a possible November meeting between Presidents Xi and Biden. The White House writing, quote, "This meeting was part of ongoing efforts to maintain open lines of communications and responsibly manage the relationship." This coming just ahead of the UN General Assembly here in New York City, which Xi plans to skip. Bloomberg's Anne-Marie Hordern is in New York, and she joins us now. So, AMH, what do we know about, who's not coming to this meeting and how, we're doing communication with our with our foes and allies in other ways?
Well, that's right. I think what's interesting about this UN General Assembly, or as everyone likes to call it, UNGA, is the meetings that are happening not here. So Jake Sullivan over the weekend sitting down with Wang Yi in Malta is almost a breakthrough, I would say, in the meetings we have seen and the outreach we've seen from the U.S. administration to their Chinese counterparts, because this would really be the meeting that could set the tone and the agenda for a Biden-Xi bilateral meeting, which potentially could happen before the end of the year at the APEC summit in San Francisco in November. Then you have Wang Yi on the heels of his meeting with Jake Sullivan going to Moscow to sit down with Sergei Lavrov. So obviously there's going to be a swapping of notes, I imagine Wang Yi will take from Sullivan to Lavrov. So that's one of the interesting developments around this UN General Assembly. We also have President Volodymyr Zelensky to be attending UNGA in New York City. And while he will meet with individuals here and he'll give a speech, more importantly is going to be his meetings that take place later this week in Washington, D.C. Of course, he'll be at the White House. He will go to Congress. How does he convince Republican lawmakers that at the moment are still unnerved and concerned about sending more taxpayer dollars to Ukraine that they should pass that bill? Remember, the U.S. administration, the White House, asked for in a supplemental spending bill more Ukraine aid. And what Kaylee was just talking about, that Ukraine aid was missing from that CR that the Republicans were discussing last night in a phone call.
It's amazing that, so many people are skipping not just Putin and Xi, but we saw there Macron and others in the Western world who are our allies not coming. Is the UN kind of dropping in its level of importance?
Well, that's a great question. I think every time you have these big UN General Assembly meetings, the question remains, is the UN obsolete? I mean, Zelensky has said that the Security Council should be dissolved and the whole thing needs to be really redone because Russia stands on the Security Council while the UN writ large has condemned the war in Ukraine. they really can't do much about it when you have Putin sitting on the Security Council. So it's a big question, but at least this forum does provide an area and an arena for a dialogue.
All right. And we're glad to have you here in New York. Anne-Marie Horder, thank you very much for that. For some of the sector price action this morning, let's get over to Bloomberg's Abigail Doolittle. This market just opened 22 minutes. Abigail, what do you see?
Well, we have a very small decline here for the S&P 500, Matt. And from a sector standpoint, not a lot of drama here, as John would like to say. On bottom, real estate, utility. So as yields go higher, the dividends of those sectors look less attractive. Up top, communication services, energy getting a bid once again on oil strength, tech also higher. Now, interesting, Andrew Sliman earlier was saying that into the end of the year, he expects this rally and he would like a diversified growth value portfolio. That's actually what's happening over the last month. You can see tech, energy, financials, utilities, a little bit of everything there for anybody, all higher. It's going to be interesting to see whether this trend will in fact continue into the end of the year.
Yeah, absolutely. Although I think even Andrew said September is, not the strongest trading month. Historically, we know it's the worst, and he expects that trend to continue. Abigail Doolittle, thanks very much for that. Coming up, the market-moving events you need to be watching out for. That's next in our trading diary. This is Bloomberg.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
This is Bloomberg's The Open. I'm Matt Miller, in for my good friend Jonathan Farrow. Quick look at the markets as we stand 25 minutes into the trade. We're looking at the NASDAQ 100 up about 0.1%, the S&P 500 down about 0.1%. It's time now, though, for our trading diary to show you what you should be watching all this week. President Biden speaking at UNGA, the UN General Assembly, tomorrow on Tuesday. On Wednesday, we get the Fed rate decision and a news conference from Chair Jerome Powell. Then the BOE announcing its decision on Thursday. Plus, we'll get U.S. jobless claims and existing home sales on that day for the U.S. of A. And finally, on Friday, a BOJ rate decision. This was the countdown to the open. I'm Matt Miller for John Farrow. This is Bloomberg.
don't think we can replicate Tesla. Tesla is a unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Coming up, the auto strike, it is a thing. It is also the subject of a big take story. We're going to break it all down going forward. Plus, we're going to check in with Ira Jersey. What's his Federal Reserve going to do this week? And then Matt Breitert, he's the Senior Portfolio Manager at Ecofin. He's going to join us to discuss his market call coming up. But first, let's kick things off with Mr. John Tucker.
All right, after Friday's sell-off, looks like kind of groping for direction for the major averages. Oil, again, a major focus for the markets as we start the new trading week, with NYMEX crude above $91 a barrel. Energy among the best performing industry groups in the S&P 500. Technology also doing some of the heavy lifting. You have shares of Apple, Alphabet, Meta, and Amazon all higher. Investors are looking ahead to the Federal Reserve interest rate announcement on Wednesday. And economist Nouriel Roubini, chairman of Roubini Macro Associates, says the Fed's work isn't done.
I don't think they can say they are done because the economy is still growing above potential. Headline inflation is going higher now that oil prices are going higher, and therefore potentially they have to leave the option open that there'll be another hike.
And right now you have the S&P 500 2 points lower at 44.48. Dow Jones Industrial Average down 32 points. That's down about 0.1% at 34,588. And the NASDAQ 100, that is higher, up 14 points right now, 15,216. The two-year yield 3 basis points higher. We're at 5.06%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you so much. We appreciate it. Matt Miller, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio. also streaming live on YouTube. So head over to youtube.com and search Bloomberg Radio. Matt, this Brent crude here, we're pushing like $95 a barrel.
It's unbelievable. It just keeps marching higher and higher. And that's Brent. I mean, WTI, I saw it hit 92. Where are we right now? WTI, West Texas Intermediate on the NYMEX exchange, 91.54. So it's come off that high a little bit. But Amrita Sen said it's not unlikely that we go into the triple digits on Brent. Yeah. So you'd have to think.
Where's the supply? I need some
That's either a headwind for this economy and OPEC is going to push us into a recession, or that's a sign that demand is so strong, these prices just keep going up.
I don't get it.
But we don't put Brent crude oil into our cars, do we?
No, of course not. It has to be refined, and, you know, we use different grades here. You check Boyle, I know, to see the different grades of oil on the Bloomberg terminal. And also, I feel like you and Paul would put pretty much anything into your engines.
You put only 93, right, octane?
I have to go for 91 or higher,
Okay.
Yeah,
All right,
that's
good stuff.
expensive.
We'll get more on that going forward. All right, let's see what's happening in the marketplace, because we've got a little bit of red on the screen, but Alex Semenova joins us. She covers all the equity markets for Bloomberg News, joining us live here in our Bloomberg Interactive Broker Studio. Alexandra, what are you looking at?
Hey guys, great to be on with you. Well, all eyes, of course, today are going to be on Apple. It's up more than 1%, of course, because there's a broader risk-on move across tech stocks, but also analysts are considering pre-order figures on the iPhone 15. They're so far tracking better than expected, with particular preference for the iPhone 15 Pro Max. Quite a mixed reaction, though, from analysts overall. It depends on whether you're a glass half full person or a glass half empty person. Barclays analyst Tim Long says that early pre-order data from China continues to point to a difficult iPhone 15 cycle, with a negative mix shift due to weakening consumer spending and macro pressures. On the other hand, Morgan Stanley says that early iPhone 15 pre-order data points to a better than feared cycle. Eric Woodring thinks that the data shows a solid start to the iPhone 15 cycle, with lead times the longest of any model launch, kind of reflecting the demand for the phone. While China points are also better than expected, but overall he says that the data points are encouraging given the extreme negative investor sentiment around Apple lately. Of course, investors have been concerned the rally in the stock has kind of hit a wall this year.
But Paul, you're getting a new one.
Maybe.
Dude, this is the year for you. I can feel it in my
everybody
bones.
always tells me, oh, the next one. But I just, whatever Anurag.
Whatever, you have the 11.
The 11.
Right?
Oh, okay. At the 11.
So what he needs to get in there.
I think I have the 13, although I'm honestly losing track of them.
Well, what do you got?
I have the 14. And to be honest, it doesn't matter in terms of the upgrades, right? I don't need a better camera than the already unbelievably good camera I've got. I remember when 12 megapixels was a lot, and now that was for an actual camera, and this phone has like 48 or something. The point, though, is that there's a rumor, let's say, there's a conspiracy theory that Apple engineers the battery life on your phone to basically 2 years.
Haven't they admitted to that?
No, they've settled the case without admitting any wrongdoing. So, of course, they're willing to pay hundreds of millions, no problem, but they won't admit they've done it. Nonetheless, your battery has to be dying, Paul.
It is.
And you don't have enough room to store the amount of data that you need these days.
Well, you're pitching me hard here.
So
Am I going to get
like,
subsidized by Verizon Wireless?
Yes, you will.
All right.
A buddy of mine over the weekend told me he got basically a free phone. They subsidized him $1,000 to renew.
Yeah, if you trade it in, then there's some
All right, I just bought a car. Can't you just give me a couple days to deal with that?
Yes, I think you deserve
before I do the phone. What else you got over there, Alex?
Well, Disney, right?
Yeah.
I mean, geez Louise.
Yeah, Disney and Warner Brothers Discovery are kind of flat today, but they were up earlier in pre-market trading after the two media and entertainment companies were initiated with an outperform recommendation from Raymond James. Kind of an interesting recommendation there given the broader pessimism in this industry. this breaks with that broader negative sentiment around media companies across some of Raymond James's Wall Street peers. Analysts there cited compelling cash flow growth expectations and cheaper share valuations in the sector. They also did acknowledge this tough environment for television and streaming companies, but said that there's a seismic shift in streaming strategists to focus away from subscriber growth to what generates cash. So that was driving their optimism there.
I will point out here, the analyst in question here at Ray J, Rick Prentice, excellent analyst. I competed against him for many, many years. His specialty over the years has been telecom and tech, and now he's kind of going into media. But I will point out, this is a seriously good analyst, and we're getting some fresh eyes on the media industry. So I kind of took a little read of his research here to see if there's something new in there. But basically, boy, if you're going long these media stocks, boy, you have to have some confidence here because there's so many headwinds out there. Short term in terms of advertising, long term in terms of just this whole streaming thing. So tough call to make, but he makes it. I like that. Anything else?
Yeah, well, Paul, you're going to like this one since you just mentioned your time on Wall Street. I know that you like these strategist stories, but Jess Menton and I had one out this weekend where we were tracking.
You guys write stories that go on the weekend, right? Jess is always quoting, well, she writes like a million times a day, but I mean.
We do a little bit of writing on the weekdays too, but yes, the weekender stories are always fun. And this one is about how Wall Street has really been caught flat-footed by the rally in this year in U.S. equities. Consensus going into the year was, of course, that we'd get some sort of sell-off in 2023 and then end the year around flat. But instead, the S&P 500 is up 16% year to date. That's kind of prompted a wave of target revisions on the index. It's cornered a lot of people into changing their view, but it's been kind of a mixed bag when it comes to what these strategists are thinking, because of course, after you've been bearish all year, it kind of raises some flags when you suddenly turn bullish. It's a concern for a lot of investors. So we're seeing across the board that there's some folks like Savita Subramanian at Bank of America who kind of led the way, and they went in with a bearish forecast and turned bullish. There are the people who, like Mike Kantrowitz at Piper Sandler, Greg Boodle at BNP. They were kind of cornered into marking up their target, but they actually are still very bearish and are worried about recession risk for U.S. stocks. And then there are people like Manish Kabra at SocGen who actually pushed his pessimism out into 2024. That's an interesting one. So he hiked his target up for the second time to 4,750 by the end of the year. He said that he's bullish near term, but then he sees it going back down to 3,800 by mid next year. He said that recession risk is actually being pushed out.
All right, great stuff. Alex Semenova, thanks so much for joining us. Alex Semenova covers all the equities for us at Bloomberg News. All right, the auto strike, it is on in a big way. The UAW striking all three big Detroit automakers at the same time. And that is the subject of our big take story today. You know, Matt and I love the big take stories because these reporters go deep on some really big topics. Today we've got a UAW's bid to upend the auto world. Begins with a snub of Bill Ford. Joining us is Keith Naughton. He covers the auto industry along with David Welch, Gabrielle Coppola, and Josh Idelson. All out in Detroit doing a great job on this big take story. Hey, Keith, what's interesting to me at least is the fact that the UAW is striking all three Detroit automakers simultaneously. They haven't done that before, have they?
Yeah, that is a first, but they're taking it in small bites. Rather than shutting down all of the factories of the big three, they targeted one factory at each company and have threatened to widen that strike if they don't get an agreement.
I mean, Keith, you cover Ford especially closely, obviously the entire industry, but as far as I understood it, the unions have the best relationship with the Ford Motor Company because they like, you know, the idea of a family-owned operation. Ford also didn't take a bailout during the great financial crisis, and Bill Ford gets personally involved with union leaders, right? So is it especially fascinating that they have really snubbed him and he seems frustrated?
Yeah, that's a really keen observation, Matt, because Ford and Bill Ford in particular, going back to when he first joined the company in 1979, has been involved in every single labor negotiation since then. You know, he's a guy who grew up playing hockey with union workers, so he has kind of, I know it sounds odd, but he has a very good rapport with the rank and file from his hockey playing, to be honest. And what happened here is he took what Ford says was their best offer ever to the union, 20% raises, a restoration of cost of living adjustments, 5 weeks vacation, 19 personal days, all sorts of goodies. He took it personally to the bargaining table last Tuesday, and he was greeted at the door by UAW Vice President Chuck Browning, who said, Sean Fain is not here. The UAW president is not here. Bill Ford's like, why not?
Yeah. Hey, Keith.
And,
Keith,
that's crazy. Bill Ford.
I know.
The scion of the Henry Ford family is
well,
there.
That kind of goes to my next question. What do we know about this UAW president, Sean Fain? He seems to really kind of be grabbing the spotlight here.
And he's not in jail.
Yes.
Like the last two union leaders, right?
That's correct. Yeah, that explains the rise of Sean Fain, this kind of fiery leader. He was the reform candidate who narrowly defeated the incumbent candidate who was from that traditional group, which had, 2 previous presidents go to jail for corruption, misusing union funds on their own lavish lifestyles. Fain is, really a true believer, and I'm not sure the auto executives fully understood that when he first was elected back in March. And he sees this as much more than just an auto contract. He sees this as class warfare, balancing the scales of 40 years of kind of the wealthy class, winning over on the middle class. And so he's on a crusade, and that attitude is something that the auto companies haven't dealt with before. They've dealt with pragmatists who, when it came down to it, were able to horse trade and get a deal done.
It makes sense because, I don't want to sound like a bleeding heart liberal, but the CEOs used to get 30 to 40 times what the guy on the factory floor got, and now it's more like 200 times, right? And you say wealthy class versus middle class. What middle class? Are auto workers really the middle class anymore? I don't think that's how they feel. And then, their demands look outrageous because they throw in 4-day work week and defined benefit pensions, which, none of us is going to get that anymore. But the wage increases look to be okay and aren't going to bankrupt these companies, are they?
Well, these are big wage increases. Stellantis upped their offer over the weekend to 21%, but the union is asking for 36%. So there's a pretty wide gulf. And just one point on those defined benefit pensions. You're right, Matt, none of us get those anymore. But the point that Sean Fain makes is the CEOs do.
Wow.
That's a good point.
That's interesting. I did not know that. Well, they also get like $20 to $30 million a year.
Yeah, so that's nice.
Right.
You could argue they should give up those pensions just as a show of solidarity with the factory floor.
Right. Yeah. So no, they probably won't get the defined benefit pension back, but Fain's trying to make a point.
Yep. All right, as we go into, the second week here, I don't know, I can't keep track. Keith, what's the feeling in Detroit about how this thing plays out? Because that's a
Today's
big...
day 4, by the way, day 4.
Day 4, okay. A big bid-ask difference between the union and the companies. What's the feeling in Detroit, how this might play out?
Well, first off, there's a lot of support in Detroit for these strikers. One of the striking plants is here in suburban Detroit, not far from where I'm sitting right now. So they got a lot of honkers, a lot of support. There's a Gallup poll out that shows that 75% of America is on the UAW's side in this dispute. So this is labor's moment, man. They're in ascendance. There's this feeling that, in the pandemic, they were getting left behind, and there's nervousness about AI and all sorts of things that could replace jobs. So they have support. And it seems like the companies are going to have to try and meet them farther than they have in a halfway battle. They have actually met them halfway because the union asked for 40% initially and the companies have offered 20%, but they're going to have to go farther.
I was going to ask about Brampton, Ontario, and the Canadian union
And
but I just got an email from Dodge.
challenge?
my vehicle has been built.
Nice.
Yeah, in Canada, if you care, Unifor
Matt cares.
Negotiate. Unifor is the union up there, and they're also negotiating a contract. But they're doing it in the traditional way, where you pick one company and set a pattern there, and then take it to the other two. That's the way it's always been done. They're doing that up in Canada, and the company they have targeted is Ford.
Ooh, okay.
Again, Matt, to your point that Ford tends to, have a better relationship with the union and have been able to reach agreements with them through the years. There has not been a national strike at Ford since 1976.
Ooh, okay. All right. Good. Keep that in mind. But here in the U.S., it looks very contentious here. Keith Naughton, thanks so much for joining us. Keith Naughton covers Detroit for Bloomberg News and all the auto guys. He's out there. And he is one of the authors of the Big Take story today, which really takes a look at the UAW and their unique strategy for striking each of the big three automakers simultaneously under the leadership of Sean Fain at the UAW. So big play here for both sides. I mean, both sides seem to have really good points. We'll have to see how it plays out over the coming days and weeks. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Well, pre-orders of the new iPhone 15 look promising, and that has Apple's shares slightly higher this morning. They're up nearly 1.5%. Well, Bloomberg's Abigail Doolittle says there's a bit of a mixed picture.
Bernstein saying historically, Apple, the stock, has treaded water a bit after these iPhone launches. But let's get to the positive. Morgan Stanley saying that the early iPhone 15 pre-order data is good. And Wedbush going even further, saying that the trend is toward the higher-end phones and that it could be 10 to 12% above the iPhone 14 orders.
Now, Abigail says the first quarter of Apple's fiscal 2024 is expected to show a return to growth. Meanwhile, Apple is releasing its iOS 17 today. Bloomberg's Gina Cervetti has that story.
New features include customizing what people see when you call them, easily swapping phone numbers using AirDrop by holding two phones close together, and sending a call to voicemail and seeing a live transcript of the message while the caller is leaving it.
Now, you can also record a video or audio message when someone misses your FaceTime call, and there's a new check-in feature to let friends and family know when you arrive at a destination. And TikTok is stepping up the competition with Amazon and Walmart this holiday season by offering up big discounts on its Shop tab. Bloomberg reports the social media app is offering to subsidize discounts as much as 50% to entice sellers into its Black Friday program, which begins October 27th and runs through November 30th. Now, globally, it aims to reach $20 billion in gross merchandise value this year. Those are the company stories we're following this hour. We'll have more Bloomberg Markets in just a bit. I'm Lisa Mateo, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash, brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with the solutions they need to grow a thriving business. Commonwealth, go where you grow. Visit Commonwealth.com to learn more. The major averages struggling for direction right now. Energy, the best performing major industry group in the S&P 500 as oil prices push higher. Benchmark bond yields inching back towards 16-year highs. Investors also looking toward a busy week of central bank action. The S&P 500's earnings recession that may be nearing its end. The latest analyst projections from Bloomberg Intelligence show the S&P 500 set to post only a 0.6% drop in year-over-year earnings per share growth in the third quarter. And go long, Raymond James analyst now says Walt Disney and Warner Brothers Discovery stocks are buys following, I guess, what we could call a turbulent few years in the streaming space. Right now, the S&P 500, 1 point higher. Dow Jones Industrial Average down 17, and the NASDAQ 100 up 31 points. We always like to bring you news you can use. It's National Cheeseburger Day today. So
nice.
Wendy's offering a junior bacon cheeseburger for a penny.
A penny?
A penny.
Do we have a Wendy's around here?
There's not a Wendy's around here that I know
Otherwise, you guys would have sent me out.
I would be there instantly. Yeah.
No,
that's a
you wouldn't
breakfast.
be there. You'd send me out to get you cheeseburgers.
That's right. Intern John Tucker. Thank you so much. We
cheeseburger.
appreciate it. Matt Miller, Paul Sweeney, live here in the Bloomberg Interactive Broker Studio, streaming live on YouTube as well. So go check it out and search Bloomberg Radio. All right, Ira Jersey joins us, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. I'm guessing from Princeton. Who knows where this guy is, but he's joining us via Zoom here. All right, Ira,
I can't believe he's not with the surveillance team in England.
In London,
Because
right.
I don't really know why they went there. I'm guessing there's a soccer game that they want to see.
Probably, and there's probably doing some pub crawls over there. But Ira is our soccer guy, and we'll get to that in just a moment. But we do have a Fed meeting this week. So
Well, plus the 10-year yield was at 4.35 this morning. That's, as far as I can see, I'm looking back. Ira, is that the highest level we've seen since like 2007?
So it's tied for the highest level. Yeah, we've tested that just a couple of weeks ago. So 435 seems to be a level that the market likes to be at. If we break through that, I suspect that you'll see a lot of selling just on people stopping out of longs who above a pretty important technical level. Last November we hit intraday. We hit this kind of level. So this is like the third test almost of this 4.35% level on 10 years.
So is that your market saying we're not buying off on any rate cuts, or what's going on?
Well, not really. I mean, keep in mind that we're talking about still the 10-year being over 100 basis points lower than the upper bound of the Fed funds target rate. So the market is still thinking that on average, the interest rates are going to be lower over the next decade than they are right now in terms of the Fed funds policy rate. But that being said, with additional supply, if we don't get a landing, right? So that's becoming more and more of a narrative now. I was on the West Coast last week. One reason I'm not in London. I was on the West Coast last week talking to investors, and a lot of people were concerned about the potential of a no landing scenario. And I think that one of the reasons why it's been hard for the 10-year to rally significantly over the last couple of weeks is really because of the idea that we might not have a significant economic slowdown.
So when you go to the West Coast, do you just start your whole trip at PIMCO and just kind of go from there?
I did not go to Newport this time, but spent 2 days in LA and a day up in San Francisco, visiting all kinds of different buy-side investors, hedge funds, a lot of real money, mutual fund kind of accounts. And interestingly, there wasn't a lot of consensus overall, but there was a lot of concern about the idea that, hey, we might not have a meaningful economic slowdown. And that means that there are some parts of the Treasury market that probably are somewhat mispriced. So not only the 10-year might be able to sell off another 10, 15, 20 basis points, but you look at the belly of the curve, the 3-year and the 5-year, and I think under a no landing scenario, those are pretty mispriced right now for the potential outcome if we don't get a significant slowdown in the economy over the next 6 months.
Did you talk to the people at DoubleLine? Because I find them, interesting in that Gundlach said the Fed's never going to get to 5%. And obviously they've blown through that level. On the other hand, Jeff Sherman over at DoubleLine has said he's preparing for a very bad economic situation, and he seems to be an outlier in that sense.
Well, I'm not going to talk about my meetings with any specific clients, but let me say in general, that's the kind of narrative that we heard either within different shops or between them. So there was one client that we talked about that thinks we're going to have an absolutely terrible economic recession in the first or second quarter of next year, whereas you had others, like I was mentioning, where it's suggesting that we might not have any landing at all, and they're prepared for that. So I think some of that bifurcation kind of in the potential for economic outcomes, it's not really showing up directly in linear rates, so what we call, the 10-year or just looking at Fed funds futures. But when you look at the options market and you look at SOFR options, and we put this in a note that we put out this morning, we're still pricing for the Federal Reserve basically to do nothing between now and the end of next year or cut interest rates 200 basis points. So that is showing up in the way that some traders and some investors are positioning with hedges using options on SOFR futures, which have replaced Eurodollars. If in case you used to be familiar with the old Eurodollar market, now it's all based on SOFR, the secured overnight financing rate.
Oh, that's going in the weeds. All right, do we get dots coming this week?
Yeah.
And if so, do I
SEP.
have to go dots go on Thursday?
Yeah, so we do have the summary of economic projections. We have some new members, so it'll be interesting to see what those new members put for their dots. I think overall you probably won't see much of a change for December, but I'm really paying attention to what the 2024 dots show, because if we have a scenario where and situation where most members of the Federal Reserve seem to think that we're going to have a modest slowdown next year, and maybe they won't cut as much as the dots are currently suggesting.
Yep.
And then the dispersion of those dots is very important to me, because I want to see, okay, do we have some major outliers that are bringing down kind of the average of those dots? And I suspect that we will have a reasonably large dispersion.
All right, we will pay attention to that, of course. Dots go, DOTS, on your Bloomberg terminal. Howard Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence, joining us here, getting a little bit of a preview of what we're going to see from our Federal Reserve on Wednesday. 2 p.m. Wall Street time is the meeting. 2:30 is the press conference, and we'll keep an eye on that. WTI crude oil up again 0.9% here at $91. So very important. Right now, we're going to bring you an interview with Chevron CEO Mike Wirth. He joins Alex Steele and Guy Johnson on Bloomberg Television. Let's go to that conversation right now.
We welcome now our Bloomberg TV and radio audiences. Today, we are focused on oil as Brent nears $95 a barrel. No better guest to discuss that with than Mike Wirth, Chevron chairman and CEO, joins us now. Mike, it's such a pleasure to see you. Thanks for joining.
Alex, it's good to be here.
Okay, $100 oil, is that going to happen?
Sure looks like it. We're certainly moving in that direction. The momentum, supply is tightening, inventories are drawing. These things happen gradually. You can see it building, and so I think the trends would suggest that we're certainly on our way. We're getting close.
Mike, good morning. It's Guy in London. What impact do you think $100 a barrel will have on the U.S. economy? What impact will it have on the global economy?
Well, certainly those are higher prices than we tend to see out over the long term, and so I think it will have some effect on the economy. But we've had relatively higher oil prices here now for most of this year and certainly all of last year. The recession that everyone's been talking about hasn't arrived, and so I think the underlying drivers of the economy in the U.S. and frankly globally remain pretty healthy. So I think it's a drag on the economy, but one that thus far I think the economy's been able to tolerate.
Have you adjusted your price deck? Meaning, that's my question, being like, are these higher prices sustainable for the long term?
Yeah, we take a very long-term view on supply, demand, policy, technology. We haven't changed our long-term price, but we really don't change that very often, and not in response to what our short-term. And we've been in a volatile market really going back to the pandemic when things came down, the recovery when it was high, the war. So this has been a period of time where prices have been unpredictable and volatile, and not what you would call mid-cycle.
Mike, if I worked for you, if I worked for Mike Wirth and I worked for Chevron, would this be my cue to say, Mike, can I have a pay rise, please?
Well, we're certainly seeing, I think you're making reference to what's going on in different parts of the world. We're seeing organized labor, in many different industries now, kind of assertively step forward and say, look, we want to be compensated. We see the inflation in the economy, and we've seen companies recover. We've had a very strong pay program last year for our employees. We try to stay very competitive, and I would expect we'll continue to do so.
That is Guy's way of getting into the strike action that's happening in Australia with Gorgon and Wheatstone. So far, cargoes have not yet been impacted. You're using some non-union workers, right? Is there a point where that would change?
Well, we certainly hope that what we'll see is a negotiated agreement. Others in Australia have reached agreement with these unions. We've been at the table bargaining in good faith, and that's our desired outcome. That said, when we face potential strikes anywhere in the world, we have to prepare to maintain operations. Our products are vital to the global economy and the flow of those commodities, particularly LNG, in a world, as we've seen last year, where it's important to keep economies going, not just in the region in Australasia, but also in Europe. That's our responsibility. And so we do prepare to maintain operations even during an industrial action. And thus far, we've been able to successfully do so in Australia.
Do you think if I'm sitting here in Europe, I should worry about what's happening here? Is this going to be a problem when we get to winter, do you think, Mike?
Well, last winter, Europe came through better than I think most thought, Guy. Now, inventories were high going into the winter because Russian gas had been flowing in. Industrial demand really came off, and then it was a relatively mild winter. We certainly can't count on all of those things happening again, but gas inventories in Europe are pretty strong right now relative to history. And so I would say Europe is set up much better than it was last year. The weather is always difficult to predict, but I feel like Europe is in about as good a place as it could hope to be at this point in time.
That's one of the weird things about looking at China growth, because obviously Europe wants China growth, but the energy sector probably doesn't want China growth if you're in Europe because of the demand pull. What are you noticing in China, whether it's LNG or oil demand pull?
Well, it's been gradual. It's been slower than people expected it to be, but it is coming back, and I think that's one of the reasons why you've seen crude oil prices tightening.
Is that inventory restocking, do you think, or is that end user demand?
It's always a little bit hard to tell. The data out of China isn't exactly as transparent as it is in other parts of the world, but I think it's probably indicative of an economy that is finding some traction and is moving forward. We're going to see record oil demand this year. All-time record demand, right up a couple million barrels a day versus the prior year. It'll grow again in the year ahead. And so as long as the global economy stays relatively healthy, demand for these products steadily marches forward.
Mike, you've mentioned inflation a couple of times already in the conversation. Are you still seeing inflation? Are you starting to see deflation in certain areas? What does the cost side of the equation look like?
Yeah, so we've certainly planned for inflation. What we're experiencing is consistent with how we laid out our budgets for this year. I wouldn't say we're seeing deflation anywhere in a meaningful way. We may be seeing disinflation, right? So a reduction in the rate of inflation. And it tends to be isolated to certain parts of our supply chain, certain geographies, a little bit more than something you would describe as widespread. I think wage pressure is pretty broadly distributed. Other things in our supply chains tend to be focused in areas where there's a lot of activity, like West Texas and the Permian Basin, which has seen a little more pressure than some other parts of the world.
Yeah, so to that point, can you increase, if you take U.S. shale for a second, the Permian, can you increase productivity enough to offset those costs when a lot of your spending in the next, say, 10 years will be in U.S. shale? That
is the big question right now that we're confronting as we're putting our plans together going forward. Thus far, that has been the case. And in fact, productivity at a time when we saw lower inflation was marching forward much faster than costs were, which is why we saw cost of production coming down. I think those are coming into more of a balance today. And I think the forward view, the question is, can you continue to move up that productivity ramp and offset inflation or not? I think it's early to say. The one thing that is sometimes not talked about in this discussion, we've seen a lot of productivity gains on drilling and completions. We're still only recovering about 10% of the molecules that are in place. If we can improve recoveries, that changes the entire economic equation in a very profound way. We're working hard on that. We expect to see recoveries improve over time. So it's another leg of that equation, which is not necessarily productivity on the activity, but it is on the recovery and the economic equation.
What is that? Is that 3+ mile laterals? Is it going to be just different types of enhanced oil recovery? Like, what's the super magic sauce for you?
Yeah, we're working on a lot of different things. We're certainly drilling
You're not
longer.
gonna tell me.
We're drilling longer laterals. We're working on different completion technology to create different fracture geometry so you can get more flow.
Does that all cost more money, though, to do, too?
It does, and so that's why you've got to evaluate the economics of this. We're working on chemicals that can enhance recovery in terms of the interaction right down at a molecular level. And all these things you have to pilot them in a lab, you have to pilot them in the field, you have to understand if you can scale them up and if they make economic sense. That's been the history of our industry. The technology tends to solve these things. We've got a lot of smart people in our company and in this industry, and a lot of incentive when you know where those molecules are to figure out how to get them to flow in a way that's economic.
I said to Alex this morning, Mike, that she wasn't allowed to use any technical jargon. I think you guys just about skirted around it in that part of the conversation. You were fine. You were fine. You get a pass on that one. Mike, you talk about the fact that you've got lots of smart people. Do you have lots of smart lawyers? One of the things that Alex and I were kicking around before we spoke to you this morning was what is happening with this California case and the fact that increasingly it looks like climate change is going to be litigated. Is litigation the right way of dealing with this?
In a word, no, it's not. Look, this is one of many such actions that we've seen over the years. Ironically, a number of them filed on behalf of people who have actually profited from and encouraged energy development. Climate change is a global issue. It calls for a coordinated global policy response, not piecemeal litigation that benefits attorneys and politicians. So we do have smart lawyers. We will deal with the lawsuits. But more importantly, we're working on finding ways to meet today's energy demand with energy that has less carbon intensity and still is affordable and reliable for the economy, even as we're investing in new technologies like renewable fuels and hydrogen and carbon capture to build a new energy system over time that is inherently lower carbon. That's a constructive approach. That's where we're engaged. That's where most of my attention is focused.
Okay, so to this point, you guys are going to become majority owner in what could be the world's largest hydrogen production and storage facility. There's that. You do have a huge carbon capture facility next to Gorgon in Australia, et cetera. These things are huge and they're expensive, and some have been around for a while. Hydrogen, though, is new. How do you know how much CapEx to realistically allocate before you're like, this is too big and it's a money suck? How do you see this playing out?
Well, it requires a lot of judgment. You have to spend time. You have to really select. There are many opportunities out there. There's a lot
so why hydrogen, for example?
There are a lot of places you could invest in hydrogen. You can invest in blue hydrogen. You can invest in green hydrogen. There's different carbon intensities. There's different technology pathways. We've got an entire organization that spends all its time working on the technical, the commercial, the practical engineering realities of these things, and looks to find the best places to start. Certainly in the U.S., we've seen some policy through the IRA, which creates incentives. Those aren't intended to last forever, but they can help prime the pump as we bring the technology costs down. The project you referenced is a project in Utah, which is actually very economic today. We'll take surplus renewable power that comes primarily from wind in the western U.S., and when it's more than the grid needs, which happens during certain times of the day, we can use that to convert water into hydrogen. We'll store the hydrogen in underground caverns, and then at other times of the day when you want to bring that power back, we can bring the hydrogen out of the caverns. It can be put into a gas-fired power plant along with natural gas to produce lower carbon electricity. So it's an example of something that's technically feasible. The economics and the contract terms on it give us a return on our investment, and it's a platform from which we can then grow.
So great to see you, Mike. We could go on forever, but we have to leave it there. You're also a busy man. Mike Wirth, Chevron Chairman and CEO, thank you so much.
All right, that was Alex Deal, Guy Johnson, Bloomberg Television, with CEO of Chevron, Mike Wirth, talking about the investments they're making in carbon and the investments they're making in green energy. It's kind of a balancing act there, but boy, when WTI crude oil is $92 per barrel, you got some wiggle room. All right, right now, let's go to John Tucker and get a Bloomberg Business Flash for a reset.
Yeah, and not a lot of movement today. The S&P 500 is 2 points lower at 44.48. Dow Jones Industrial Average down 8 points. That's down to 34,609 on the index. The NASDAQ 100 right now 20 points lower That's down just 0.1%. Start of a busy week for the major central banks. Airlines, they're falling. Energy producers rising. Oil extending the rally, as Paul just mentioned. You have Apple leading gains in mega caps. Tesla dropping as Goldman Sachs lowered its earnings estimates for that company. And as the Federal Reserve meets this week to map out interest rate strategy, Andrew Balls at PIMCO says, don't count out a U.S. recession.
Yes, the data has been better than expected, particularly in the US this year. But as we all know, these central bank tightening takes time to feed into the real economy. So looking forward, the jury's still out on inflation, but that recession risk remains significant.
And U.S. home builder sentiment falling to a 5-month low for the month of September. The reading below all estimates in a Bloomberg survey of economists. So higher mortgage rates, they do matter when it comes to home builder sentiment. And some breaking news crossing the Bloomberg. We're talking about the Americans being held in Iran. They have been released, arriving in Doha, Qatar at this point. So that is good news on that front from the State Department. Yep. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you so much. We appreciate that. I'm seeing some video here on our screen of them walking down the plane of Qatar Airlines. So that's good news for them. So it's good to see that. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker studio. Let's talk I don't know, alternative energy? How about that? Matt Breitart, he is the Senior PM and Managing Director at Ecofin. Ecofin is a $2.3 billion alternative energy asset manager based in London. Hey, Matt, thanks so much for joining us here. Talk to us about the types of investments you make at Ecofin.
Sure. Thanks for having me on. We spend a lot of time looking at both sides of the equation in terms of energy supply and energy demand, and in particular, those companies that are providing products, technology, and services associated with decarbonization and efficiency. So while we look at a lot of new types of technologies that are being implemented, we also look at a lot of traditional companies and the way they're integrating a lot of new technologies into their existing platforms. So rather than thinking about it as an investment strategy focused on just clean tech or smaller type companies, we actually look at some of the biggest companies in the world and the way in which they're adjusting to this, overall energy transition.
So how do the biggest companies, the biggest factories, the biggest offices change over to alternative energy for things like, production lines and air conditioning? I mean, it seems like we still use old energy for those things pretty much everywhere.
Yeah, that is a common belief. But if you were to visit a factory in China today versus 15 years ago, you would notice a few major differences. One thing you would notice is a lot less people, so there's a lot more automation. The second thing you would notice is that the factory is now almost completely electrified. So whereas in the past you might have been using a lot of direct heat or direct fossil fuels in the factory, today you're using electricity to run not only your automated systems, which could include belts and robotics, but increasingly you're using cloud in order to synchronize all of the activities together on the production line. You're using a lot of back-end data and data analytics to monitor and censor all of that production. Increasingly, you're even not lighting the factory as much, again, because there's not as many people. If you think about motive in the factory, that used to be fossil fuels. That's all been electrified. So electricity as the component or fuel of the future is really taking over and taking very significant market share. And that's also true for HVAC, as you mentioned. In the case of heating, ventilation, and air conditioning systems, almost all of them today are electrified. And increasingly, the demand is being pulled in a couple different directions. The first is around cloud and AI. As you can imagine, when you build these large server farms, they have very intense cooling needs. So in a way, you kind of get a synchronized cycle with the HVAC side of the business with growth in AI edge and in cloud. But equally, I think the other big opportunity is it's getting hotter. The pull on cooling degree days in any kind of contained facility is just going up.
That's kind of where I wanted to go. I mean, one of the takeaways of this past summer is man, it was hot out there. I mean, not just in the Pacific, in the western part and the southern part of the U.S., but kind of all over the world. What kind of investments do you make to kind of address that issue?
Especially as it's not just getting hotter, but there is such a wave of concern about cooling Bitcoin server centers, right? Which is going to be a drop in the bucket compared to AI server centers. I mean, that's what we're all hoping, right? That's why we all bought NVIDIA. Not me and Paul, but everybody else. Is there enough power for all of these server centers?
Yeah, the answer there is yes. I think this may come as a surprise, but if you had to guess what the electricity demand growth in the United States has been over the last 20 years, with GDP in the last 20 years, easily doubling, what would you expect that growth rate has been? And population having grown by at least 50 million in the last 20 years.
I would guess it's exponential of GDP.
It's zero. It's zero.
Unbelievable.
We've had zero electricity demand growth in the United States in 20 years. So
and why is that? Because we're just creating it more efficient. We're just using electricity more efficiently?
Yes. Correct. So effectively, you should think about this as the electricity grid system is not only the largest machine in the world, it's one of the least efficient in terms of a utilization rate, because we have to overbuild that system to handle all the pinch points. But the reality is we've infilled that system over the decades with a lot of kind of existing technology, and our energy budget's been very cheap. We haven't really thought about the emissions. Technologies like lighting were as much as 12 or 13% of that total budget. That number has fallen 600 basis points, in the last 15 years as LEDs have come in. Equally, in your house, if you used to have a plasma TV or you used to have an old, LCD TV, the energy consumption of an LED TV, an edge LED TV, could be 80% less than what you were seeing with your old solid state. So while we're certainly electrifying more and our daily lives are overwhelmed with things that we're plugging in all the time, the reality is there was all this low-hanging fruit to take out of the system. There's still more low-hanging fruit to take out. But I will say we're entering now what we think is a new multi-decade bull cycle around electricity demand. And it's not just us thinking this. We're hearing this from electric utility companies, industrial companies, the renaissance of manufacturing in the U.S., where we think electricity growth in the U.S., we'll leave aside Europe because they're having their own problems at the moment, but at least for the U.S., between 1% to 2% now on an ongoing basis, with some parts of the country considerably higher as EV penetration, gets going in earnest.
Hey, Matt, thanks so much for joining us. Really fascinating discussion. A lot to unpack there. Matt Breitert, he's a senior portfolio manager and managing director at EcoFin. So just kind of really looking at that alternative energy business and a lot of interesting technologies coming to bear there and putting some money to work. Looking at this market, kind of a little bit of a mix here. The S&P's pretty much unched on the day. The Dow's up about the same, up 22 points. Not much going on there. So not a lot of big moves in the indexes. We kind of take a look at that. Nice. But looking at the 2-year, 5.05 on the 2-year Treasury, you could just hang out there for a couple of years and get a pretty nice coupon. That's interesting. 10-year, 4.33%. We're going to have more coming up. This is Bloomberg. Good morning. Let's get some company news right now with Lisa Mateo.
Instacart has been flirting with an IPO for years, and now it's finally making a move with its trading debut tomorrow. Its parent company is seeking to raise as much as $660 million today, valuing the company at more than $9 billion. Bloomberg's Sonali Basak says its investors are key.
Even though the market is watching the story on margins moving forward on Instacart, you do have PepsiCo coming in as an investor into the IPO, as well as cornerstone investors that could take up 60% of the shares. That includes a division of Nordea Bank and Dan Sundine's D1 Capital.
Now, Instacart is also striking while the iron is hot on the heels of ARM Holdings launching the year's biggest IPO. And Disney has held preliminary talks with potential buyers for its India streaming and television business. Bloomberg's Ed Ludlow has more.
What Bloomberg sources are saying is they could take the Disney Star property in India and sell it outright, or they could do more of a piecemeal approach where they take the sporting rights that are India-based and the Disney Hotstar regionalized streaming platform, put them in combination. And it's interesting because one of the parties in talks, according to Bloomberg sources, is Mukesh Ambani's Reliance Industries. That goes back to Disney losing the rights to the Indian Premier League cricket in that nation.
Now, shares of Disney right now down about 0.5%. And Nexstar and DirecTV have agreed to end the blackouts while they hammer out details on a permanent content agreement. Nexstar has owned 200 owned partner or TV stations in 116 markets, including many affiliated with Fox, NBC, and CBS. Shares of Nexstar right now down just a fraction. I'm Lisa Mateo. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, Matt Miller and Paul Sweeney live here in the Bloomberg Interactive Broker Studio. Looking at these markets, really not much happening on the index level. S&P unchanged, same for the Dow. I'm going to say same for the NASDAQ, all less than 1% moves there. So looking at the yield space, 2-year Treasury 5.05% to 10-year 4.33%. So still got that inversion, but the action's really been in the energy space over the past several weeks. Another big move higher in WTI crude oil, up 1.4% to now $92 for WTI crude, and Brent, we're on a $95 watch, $94.79. So a lot of movement there in the global energy space. With our news in New York City, here's Michael Barr.
Thanks, Paul. Matt, Iran released 5 Americans as part of a prisoner swap deal. Washington hopes that it could ease regional tensions and clear a path for more diplomacy to limit the country's nuclear program. The prisoners were released after the U.S. allowed the transfer of $6 billion to Iran. President Biden is in New York at the start of this week's annual United Nations General Assembly. First up for the president, campaign fundraisers, including a concert event on Broadway tonight featuring some of the biggest stars in theater. Tomorrow, the president gets down to business, delivering a speech to the General Assembly. Meanwhile, tens of thousands of people in New York kicked off a week of demonstrations seeking to end the use of coal, oil, and natural gas blamed for climate change. It was part of the opening to New York's Climate Week, where world leaders in business and politics and the arts are gathering ahead of the new special UN summit Wednesday. Student organizer Emma Beretta said President Biden's political career could become extinct if he does not come through.
We're targeting Biden because he needs to completely reverse course. He's not even showing up to the Climate Ambition Summit, which is completely unacceptable.
Sunday's gathering to end fossil fuels featured such politicians as Representative Alexandria Ocasio-Cortez. The search continues for the suspect who ambushed a Los Angeles County Sheriff's deputy shot in his patrol car over the weekend. The community mourned the loss of 30-year-old Ryan Klinkenbrummer. L.A. County Sheriff Robert Luna pledged to mourners his team was dedicated to catching the killer.
Ryan was a 30-year-old, young, beautiful man full of life, and represented what many members, all the members of the Los Angeles County Sheriff's Department represent over and over, and that's to come out and serve you.
Sheriff Luna says there are some leads, including a description of a vehicle near the scene, a dark gray Toyota Corolla. Thousands of striking auto workers stretching across state lines are calling on Detroit's big three car makers to bring back the benefits of pre-2008. The strike entered its fourth day. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mike LeBar, and this is Bloomberg. Paul, Matt.
All right. Thank you very much. We appreciate that, Mr. Barr. All right. You're going to be speaking with, you and Guy and Alex are going to be speaking with the Mercedes CEO.
I mean, dude, there's an overwhelming amount of car news today.
There is.
First of all, you actually did trade in your
the Beamer
535 with the stick, and you accepted the times are a-changing, and you're rolling along with them. You no longer have a manual transmission.
I do not, and it was very tough to come to that decision. Once I did, I just went out and bought a car in like 5 minutes. No kidding.
So, but me, it's taken like a year to get my new car, and I got an email on Friday that it's being made, and then I just got an email now. It's done.
It's done.
It's finally been finished.
Now, did they put it on a train or a truck?
Well, it's got to come from Ontario, Brampton. So I don't know. I'm estimating to make myself feel better that it's going to take up to a month to ship.
I'll go up and get it for you.
I would do that too, but that's not how it works. We also have the CEO of Mercedes, the global CEO of Mercedes.
Nice.
Here in the office. He's at 731 Lex. He made it here on time.
Nice.
The traffic didn't stop him.
Yeah, the UN, forget about it.
And I got a ton of questions for him.
Yeah, I mean, Guy and Alex, they're not going to have a chance with this interview. They should just, it's just going to be you guys chatting car talk.
We'll all participate. And then later in the hour, we have the CEO of Maserati.
Wow. In the radio studio. How about that? So that's just going to be a car talk day. I'm going to have nothing to do with that. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, a lot of stuff coming up in this hour. We're going to kick it off with the Markets Roundtable. We're checking in with Jess Mensch. She covers the equities for Bloomberg News. And Mike McGlone, he's down in Miami. He is our commodities go-to guy. We've got to figure out what's going on with oil, so we'll do that. And as Matt mentioned, the Mercedes CEO at about, we're going to speak with him this hour. Matt's got plenty of questions there on the Mercedes front. And then we got to figure out if this government is going to shut down or not. So we go to Nathan Dean, senior U.S. policy analyst at Bloomberg Intelligence. He's down in Washington, D.C. He might be to blame for this whole thing. I don't know, but he'll know where we are in those discussions. But first, let's kick things off with John Tucker.
All right, thanks, Paul and Matt. Major averages kind of mixed right now. Stocks, little change. 10-year Treasury yield right around 434, just off its 52-week high. Investors, of course, looking ahead to the Fed's policy announcement Wednesday. Lori Calvasina at RBC Capital Markets isn't expecting any surprises.
Central banks are the big story of the week. Unfortunately, our rate strategy team thinks that this is going to probably be another fairly boring Fed meeting. They see basically no risk that we're going to get a hike coming up. They don't expect anything particularly interesting coming out of the commentary. They think the Fed really likes how the data's been progressing.
Right now, energy best performing major industry group in the S&P 500 as oil continues to push higher. DoorDash jumping after Mizuho Securities upgraded the stock. Instacart's IPO that debuts tomorrow. The actual name Maple Bear. They're seeking to raise as much as $660 million. S&P 500 up 2 right now. The Dow Jones Industrial Average down 7. The NASDAQ 100 up 10 points. Trying to get people back to the, we're here. But Meta Platforms, they might be setting the example for everybody else. The company's reviving a number of popular pre-pandemic perks.
For the kids.
For branded T-shirts.
Sure.
Well, this is the one that would get me back, not that I ever left, but happy hour.
Oh, that'd be nice.
Yeah.
Booze.
Yeah.
That is the last thing that you would need. Paul and I maybe, because we could handle it. We're adults.
We can enjoy
Dude,
it.
I'm on my 14th month with no booze.
I know. You're
How crazy is that?
Is there a substitute?
I was going to quit for 4 weeks. And thanks to new laws in these United States of America, it's been 14 months.
Didn't miss a beat.
Children listening to the program, don't follow certain hosts' example.
All right, John Tucker, thank you so much. We appreciate it. Matt Miller, Paul Sweeney live here in the Bloomberg Interactive Broker Studio. We're streaming live on YouTube, so head over to youtube.com and search Bloomberg Radio. We're going to check out these markets, and the way we like to do it is round table it with a couple of smart voices here, and we got that today. Jess Menton, she covers the equities and for Bloomberg News, and Mike McGlone, he's a macro strategist for Bloomberg Intelligence based down in Miami, Florida. Hey, Mike, let's start with you here. Energy's the call of the day here. Citi's out with a note here saying, hey, as we get closer to $100 here on Brent, you can expect some supply to come onto this market and push it down. What do you think about that?
That's the higher price cure kicking in.
Yep.
And that's typically what happens. And that's all you've seen it in the macro and the micro, and you saw it last year. Crude oil spiked to around $130 a barrel, and this year's low is $63.64. I think it's doing again. So for instance, you see the Fed, its finger's still on the tightening button. It's not going to tighten this month, might tighten next month, but the ECB did last month, Bank of England did. And a lot of that's because we had this recent spike of inflation on the back of crude oil. So it's its own worst enemy. And then you look at the macro, what's really been driving crude oil in the last 10 years. It's not OPEC. It's the U.S. and Canada. Excess of liquid fuel production minus consumption is approaching 6 million barrels a day. That's the highest ever. And if you keep prices high and we tilt towards this recession, I see crude oil more likely to collapse than inch higher, basically inch higher, and then go down in that escalator.
So
the elevator.
Is there a level, Mike? I mean, Citi's calling out $100 just because it's a nice round number, I'm guessing. But is there a number here? And if so, will we just see it in the price per se, or are there supply things that you look at?
It's got to cause the most pain. That's one lesson you learn in markets. So right now I look at managed money net positions, basically hedge funds. They're about the longest is near the peak last year when it kept trying to bounce up near 100 and go down. Now hundreds of people, the level people watch, nice round numbers. But the fact is the price you see in that screen right now in crude oil was first traded in December, I think it was November 2007. It's the world's most auto-correlated asset. So this is why I always tilt over to gold, at least the highest price this year. The average price this year is the highest ever. So that's the thing about crude oil. It gets everybody excited. And right now, it really reminds me of 2008. I remember when it reached all-time highs and the average price of gasoline in this country reached around $4 a gallon. Then everything tilted lower. And the difference is the Federal Reserve and most central banks are still tight, except for the main source of demand in the world, and that's China, and they're tilting towards more of a recession.
Hey, Jess, as we look at the broader equity markets here, not a lot of activity out there, despite kind of this move higher yet again
Energy
in energy
stocks,
prices.
though, of course.
Okay, so bring us.
That's
So what are we seeing there?
There we go. Since Miami Mike's with us, I'll call out what's happening in the energy sector. So more broadly in the S&P 500, it's up about 1%. If you want to look month to date, Valero Energy, so that's ticker symbol VLO, up almost 13%. So on pace for its best month of the year and its best since last October. Also, if you're looking at Marathon Petroleum, ticker symbol MPC, up about 10% this month, so on pace for its best month since July. And then also Halliburton's up about 11%, so that would also be its best month since July, looking at that ticker symbol HAL. So obviously when you do see it advance with Brent crude creeping towards $95 a barrel, obviously extending that powerful 3-week rally of double digits, you are seeing some big support there on that. But the opposite side of that, you would look at airline stocks today. So if you're looking at that sub-industry group in the S&P 500, it's actually down about 1.5%. So when you're looking at Delta, Southwest, and others, those coming under pressure. So the flip side of that coin when you are looking at what's happening with energy.
You know, it's interesting. When we came into the new year here in 2023, you're like, hey, does energy have any more legs? Can it, you know, because it was so out of favor in the S&P for decades, it seemed like.
So in love.
And the answer is, yeah, it does. I mean, some of the names like Marathon up 34% year to date.
Right.
So interesting. So, Mike, you know, on the commodities front here, we'll wait and see where this thing peaks. Gold here, what is your thought on gold here? It's up another $2.50 here today, just under $1,950 an ounce.
Now, that's a consolidating bull market. The average price this year of 1933 is the highest ever. It's also a significant year when the U.S. basically debased the dollar versus gold. And it's just, to me, a matter of time gold breaks out to new high. Juxtaposed is the crude oil average price is the same as almost 15 years ago. So I think gold's just a matter of time, but it has that major headwind. You look over that 2-year note yield today, 5.05%. That's almost the highest since 2007. That's a major pressure factor. And the stock markets remain resilient. So I think it's a matter of time. But tilting over a little bit, gold almost always outperforms copper, crude oil, and corn, the other 3 C's. But the key thing about what's happening in commodities with all this hype about crude oil, it's not getting any endorsement from the other commodities. Like copper is going down. It's down in the year. It's down about 1%. It doesn't believe in this big demand pull. Corn's down 30% on the year. It's not seen it. So that's where crude oil is just kind of the outlier. But gold is the main commodity. I still think it's going to continue to appreciate. It has in the long term. I think it's going to continue, particularly if we're right, Bloomberg Economics, about heading towards that U.S. recession.
Which they have a very, I guess, 100% call that we're going to hit a recession. Hey,
next 6 months.
Yeah. Hey, Jess, ARM, a big IPO last month. It kind of IPO'd at 51, had an intraday high of 69, but been falling back ever since. I'm not sure if I'm an Instacart banker. I'm liking that kind of movement.
Right, that stock once again under pressure. So still trading actually above when we do look at that $51 a share price offering from last week, but still coming under pressure once again today. So ARM was actually valued at more than $60 billion and obviously a considerable premium on a price to earnings basis when you think about some of its peers in the chip industry, including NVIDIA. So that has had some market commentators taking a little bit of a skeptical tune, potentially on its future prospects. So Bernstein actually initiated coverage on the stock on Monday with an underperform rating, saying it was too early to say if ARM will be an AI winner. But obviously, people looking ahead to Instacart tomorrow.
So that price is tomorrow after the close?
Right. So that's something that people are keeping a close eye on for another when we're looking at sort of the IPO pipeline. And especially over the last couple of months, I mean, we had Kava. We've talked a lot about that. Obviously, when you have ARM, biggest IPO of the year last week, and then still you have more coming up this week too.
Hey, Matt, just generally speaking for commodities and maybe energy in particular, how active are hedge funds trading commodities?
I think he means Mike.
Mike, sorry, Mike.
Oh yeah, absolutely. Well, that's the world I came from. How to compare that? I don't know really how, but that's how I lost my hair. I'm so used to dealing with those kind of people, and I know what's happening now. Is people like me are like, okay, we know what's going on here. It's not really fundamental driven. It's little tweak. We're stopping everybody out. People like me get short. They get stopped out, and at some point you'll be right. So that's the way I see it right now. But it's the thing about these commodities. They're actively traded, but as far as buy and hold, you stick with what Jess was talking about, the equities. No, they go up over time. But commodities like this, they're so autocorrelated. They get too expensive, they get too cheap, and they just knock around the range. The only one that really goes up over time is gold.
And so, I mean, so I remember last time or one of the times we chatted recently, long gold and kind of short everything else.
Still, that's been my call for actually a couple of years, but particularly, but it's a question of when we get that recession to kick in. And as what's happening now, what crude oil is going to aggravate it because it's keeping the Fed tightening. And then we see the tilt with inflation. So to me, that's still a long-term base for gold. And again, there's a history of gold. It's money, and it outperforms versus everything, particularly when you have this big pump in liquidity that's still dumping.
All right, Mike, thanks so much for joining us. As always, on a day when we've got energy moving higher again, always appreciate getting your perspective. Mike McGlone, he covers all the commodities and macro strategists there for Bloomberg Intelligence via Zoom from Miami. And Jess Menton covers all the equity markets for us here in our Bloomberg Interactive Broker Studio. Looking at the stock of Mercedes-Benz, off 1.2% today, but up 8% year to date. Now, we're going to bring you an interview with Ola Källenius, the CEO of Mercedes. He joins our Guy Johnson and Matt Miller on Bloomberg Television. Let's go to that conversation right now.
We welcome now our Bloomberg radio and television audiences to a fantastic conversation with Ola Källenius. He is the Mercedes-Benz CEO. He joins us in New York, as does, of course, Bloomberg's Matt Miller. Ola, great to see you. Thank you very much indeed for taking some time to drop by and see us here at Bloomberg. Ola, the story we've been talking about over the last few days has been all about China. We're trying to work out whether Europe is going to start a fire with China that is going to impact Mercedes-Benz. There's talk of tariffs. There's talk of trade wars around autos and EVs. Are you worried?
Well, it's great to be with you this morning, Guy. No, we're not fundamentally worried. We have a very strong business in China that has grown significantly over the last 10 years. And we're continuing to invest in China to make sure that we bring the product that the Chinese customers are expecting from us. I think it's important in these types of discussions to not forget what has made us so successful over the last decades. It's been opening up markets, free trade, free competition, but also a level playing field. So as long as all of those frameworks are in place to make sure that we can do business in a sensible way, we're not worried.
Well, we have, though, Ola, an EU inquiry into Chinese car imports. Don't you expect Beijing to react with countermeasures?
We will see how this plays out and what comes out of that. And we like to remind people that open markets is what drives growth and also drives wealth creation. In fact, if you look at the history of our company, it didn't take Gottlieb Daimler more than 15 years to figure out that Germany is not the only attractive market in the world. And we've been here in the United States for more than 120 years now. So that companies go global and that competition goes global, I think that's natural. We had the Japanese come to the United States in the 80s and the 90s, then the Koreans, then Tesla came now when we're going into electrification. So let's keep markets open, let the market participants fight it out.
Annalena Baerbock, the German foreign minister, was speaking to our good friend and colleague Anne-Marie Hordern a little bit earlier on, Ola. She was saying that there's a risk that Europe is too exposed to China, that we need to be cautious in our approach to China. Do you think that European, German luxury car makers are, though, at risk of being overexposed to China, that that market has become too big for you and the politics could get in the way? How do you think about it when you get warnings like that from German ministers?
On the one hand, I think we learned a thing in the pandemic, that supply chains can be fragile. And to create some optionality and more resilience into your supply chains is generally a good thing for businesses. This is something that we have already started, especially on battery materials, where we have devised a strategy where we're going to try to, as best as we can over the next years, go into a kind of region for region sourcing. So yes, we do look at different commodities to make sure that our supply chain is resilient. But it would be a complete illusion to think that we can divide the world, the automotive world, into individual regions that have nothing to do with each other. These supply chains, or supply networks rather, are much too sophisticated. There are 5 continents in every Mercedes that is being sold. And that is the strength of market economy, that the invisible hand of the market figures out what the economic optimum is. So supply chain resilience, yes, but keeping the markets open and the market working, I think, is even more important.
You have a strike going on here in the U.S. Well, not you. The UAW is striking on Ford, GM, and Stellantis. You have production here in the U.S. Doesn't have UAW workers, but you still got to be prepared for supply chain issues due to the strike. What are you expecting now, and how do you expect it to affect your business?
We don't expect any major impact on our business. And of course, Mercedes-Benz doing business in more than 150 countries and have operations in all major economic regions. We try to make sure that we're competitive, that we're an attractive employer. But at the same time, we're in transformation. The auto industry is getting more competitive, not less competitive. So whatever pressures we have on cost is going to have to be made up in productivity. So I think we have to be very mindful to keep the gain on productivity up and make sure that we don't have costs that run out of control.
But don't you expect, Ola, if they get a 20-25% increase at UAW plants, you're going to have to raise your price, your pay at some point in Tuscaloosa as well. Otherwise, you're going to lose workers to plants up north.
We have been in the United States, in the southeast of the United States with our plant in Alabama and also our commercial van operation in South Carolina now for, in Alabama, more than 25 years, almost 30 years. And we have always kept lockstep with what's going on in the economy to make sure that we have attractive jobs. So we watch that and we make adjustments as we go along. But at the same time, we look at, how can we do things better? How can we do work in a smarter way, get leaner, because the cost competition is not going to go anywhere.
Ola, do you think that companies such as yourself, companies like Stellantis and Ford, should be guaranteeing that workers that are working on combustion engines will have a place in the new EV world? Should they be guaranteed jobs? Should they be carried through this transition process?
I cannot speak for other automakers, but if I look at what's happening at Mercedes-Benz around the world, and primarily in Germany, where we have most of our operations, yes, we're investing heavily into the new technologies. The lion's share of our capital allocation goes into electrification and digitalization, and we're creating new jobs there. But the fact of the matter, on the powertrain side of things, the net at the end of this transition, which is a 10-year plus affair, is going to be less jobs on powertrain. On vehicle assembly, it's about the same, but we will use demography over this 10-year plus period, our demographics, to make sure that we can get into a position where we do this in a sensible way.
Ola, I drove recently the EQS. It's an electric, your electric SUV. Obviously a very luxurious product as you move even more upscale. At the same time, the Tesla Model X and Model S are getting kind of long in the tooth. If you have lost customers to Elon Musk, are you gaining them back with this new push into, luxury electrics?
What we have seen with the EQS and the EQE, both on the sedans and the SUVs, and here you have some extremely high-tech, luxurious products. We didn't make carbon copies of our combustion equivalents, but really tried to create a complementary offering. And yes, we have a lot of conquest customers coming into those vehicles. People that maybe didn't look at Mercedes before, that goes like, wow, Mercedes is going electric. This is interesting for me. So far that plan is working out quite well.
Matt, I have to say, you got a big smile on your face. You look like you're enjoying driving that car. Is it as good as a nice engine? Are you a convert yet? I've been tracking Matt's history as he's worked his way through this process.
You know what?
I'm wondering if we're there yet.
This is the one electric vehicle that may be able to win me over because of the pedal feel, because of, I hate to say it, I don't want to get flamed, but the fake sound, which I absolutely loved. It really felt like a big block more than an EV. And Ola, are you going for that? I mean, are you trying to make these electric vehicles feel like, the luxury V8s that we long for?
Of course, there's a different sound profile, but the way a car drives and rides, what you expect from a Mercedes, the safety, the quality, how everything just feels right. That is true for an electric vehicle as it is for a combustion vehicle. But for you, Matt, I got a special coming up next year. I know you're a big fan of the G-Wagon, the G-Class, and next year we're going to have an electric G. It's going to blow you away, promise.
I am absolutely looking forward to that. As you know, I have had the V8 version, so I'll see what the EV version is like.
This is a high bar we're talking about here, Ola. So I hope you know what you're doing here. That's a big promise for Matt. Final quick question. Champagne sales are beginning to falter. Luxury goods companies like Richemont are talking about the idea that even upper-end consumers are beginning to feel the inflationary effects. Is that going to be a challenge for you as well? Are you in that kind of bracket? Are you going to be affected by those same forces?
Our top-end vehicle sales for the first 6 months of this year were very strong. But at the same time, you have to watch the macro picture. In North America and in Europe, we have higher interest rates. Those higher interest rates are probably going to stick around for a while. That affects the pricing of capital goods in terms of financing and leasing, and that's about 50% of our transactions. So we have taken a cautious view on the macroeconomic side. That is why we have guided for vehicle sales at around the same level this year as last year.
Ola, great to see you. Thanks for stopping by to see us. We really appreciate it. I know Matt's looking forward to that. Is it G-Wagon next year? I'm very excited. I've heard him talking about it. So this is a big moment. Ola Halanus, the Mercedes-Benz CEO, and of course, Bloomberg's Matt Miller.
All right, that was good stuff. Guy Johnson and Matt Miller speaking with Ola Kalenius, the CEO of Mercedes. A lot of investments in the electrification of that company, as well as we see across the industry. Right now, let's get a little bit of a reset here. Check in with Mr. John Tucker.
All right, going nowhere fast as far as stocks are concerned. Kind of treading water. S&P 500, 4 points higher. That's up 0.1%. 44 at 54. The Dow Jones Industrial Average is 25 points higher right now. And the NASDAQ 100, 20 points higher. That's up 0.1%. In the S&P 500, you have 6 of the major industry groups in the green. 5 are lower. The best performer, that's energy, with oil over $90 a barrel. Now, earlier, you heard the Chevron CEO, Mike Wirth, tell us that oil probably is headed for the $100 mark. Tesla shares dropping close to 3%. A Goldman Sachs analyst lowering his earnings per share estimates for the company. And then you have shares of Microsoft. They're down about 0.4%. The company did say today that its chief product officer is leaving, not given a reason. That's a significant departure for the company's hardware division. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Does Matt clean the cars before he returns them to?
I don't know, but I mean, you know,
he doesn't take the kids to McDonald's with the
French fries and all that, the ketchup getting all over the place. I don't think he does, but boy, I love it when he brings the cars into here to Bloomberg and we get to take a look at them. So
never gotten the privilege.
Oh, he brings them into the courtyard downstairs and gives it a little. Now it's all about the video kids putting on TikTok and all that kind of stuff. All right, John Tucker, thank you so much. We appreciate it. Matt Miller and Paul Sweeney here. Is our government going to shut down at the end of the month? We got to keep that on the front burner, kids. Nathan Dean, senior policy analyst at the covering the U.S. government for Bloomberg Intelligence. He's based down in Washington, D.C. He is my go-to person for all things D.C., for better or worse. Nathan, where are we now on the discussions among lawmakers about keeping this government open, or maybe not?
Yeah, so just over the weekend, the House Republicans came together and tentatively agreed on a package that at least would allow them to fund the government. We're talking about, I think it was an 8% reduction in costs minus defense and veterans. But, this doesn't really change the political perception of we are headed for a shutdown. We're ascertaining a high percentage, around 70-75%, that the government shuts down. And, this is just something this is one of the steps of the process that they're going to have to work out over the next few weeks. There's going to be a lot more scary headlines to come. If there is a shutdown, though, we don't think it's going to last long. I mean, look, anything can happen at this point, but you're probably looking at like a 5 to 7 day, even maybe a 10-day shutdown, as opposed to, what we saw under the Trump administration. I don't think you're getting anywhere close to the 31-day shutdown that occurred in 2019.
All right, if there is a shutdown, I guess the first thing people will try to do is assign blame. Would there be any blame if there were a shutdown?
Yeah, I think obviously it's the party that is pushing for the shutdown that ultimately pays the political price here. And, when the Senate agreed, or at least agreed to open up debate on their spending package, it was by a vote of 91-7. So that's a bipartisan issue over in the Senate. It's really the Republicans in the House that are driving this at the moment. But what we would say, though, is that when it comes to a shutdown, the impact can really differentiate on who you are. If you live in the Washington area, or if you are exposed to federal contracting, or if you're a government deemed non-essential employee, you may not get paid during that time. Now, government employees have always been retroactively paid. It's those government contractors that are furloughed that are not. But when it comes to markets and large contractors in terms of their equity share prices and so forth, you usually see like a 1 or 2 day worth of confusion in the markets, but then ultimately there's not much of an impact at all.
All right. So how about it just as it relates to Washington per se, getting this stuff done? Speaker McCarthy, where are we in his leadership of his party dealing with the various factions there? Because it feels like there's just a relatively small part of the Republican Party that may be looking for a shutdown.
Yeah, I mean, that's exactly it. I mean, Speaker McCarthy has an extremely difficult position where he can only afford to lose 5 votes. We went through this during the debt ceiling, and he was able to get the party through that issue as well. I mean, he's done this quite a bit, and I think to a lot of people in Washington, he's exceeded expectations in being able to corral the Republican Party. But now you've got different factions here. You've got the House Freedom Caucus demanding certain cuts. You've got Main Street Caucus may say, look, I'm not going to go along with those cuts, or I'm not going to go along with those changes, especially if you're a Republican in a Biden district. But he can only afford to lose 5 votes. The Democrats aren't really in a position where they're going to want to help him at this. I think eventually they will. But, there is also an impeachment inquiry going on. A lot of Democrats, I think all the Democrats aren't happy about that. So this is something that Speaker McCarthy is going to have to work through, and he's not going to actually make a decision on how to move forward until that exact moment when he needs to. And that could be a couple of days after the government has shut down.
So how is the White House going to play this? Because there is an election coming up, and I'm sure the administration doesn't want to be saddled with any kind of blame here, or too much blame here. So what are we hearing from the president and from the administration?
So I think the White House is in a position of strength going into this because, a lot of this was already agreed upon during the debt ceiling issues. And, these funding levels, especially the vote in the Senate, signifies that there is somewhat bipartisan agreement, at least over in the Senate, that, the funding issue is somewhat resolved. Obviously, there's always nuances that have to be hashed out and so forth like that. But I think what you're going to see from the White House is essentially just look, this is a congressional issue. This is what Capitol Hill is going to have to deal with. It's the other side of Pennsylvania Avenue. Once the House comes together and actually can figure something out with the Senate, then send it to the president's desk. But I think ultimately the president's going to try and at least initially, stay out of this and let Capitol Hill fight it out.
Well, it seems like there's a ton of risk here for the Republican Party because it feels just at this stage, as you suggested, that they're the ones kind of pressing for it here. And I guess they hope the calculus is, yeah, but what we're arguing for, less spending and the other things they're arguing for, that's really what the people want, and they'd be willing to deal with a government shutdown to get that. Is that their calculus?
Yeah, absolutely. I mean, like I said before, the Speaker McCarthy can only afford to lose 5 votes. But really what it comes down to is that some of these Republicans that are insisting, look, you've heard language saying that a government shutdown saves money. That's not entirely true. But it plays well in, Peoria, Illinois, or in Alabama, or in Georgia, or in Nevada. And so, a lot of these Republicans, are thinking of their specific constituents here. And so, it's one of those things where eventually they're going to have to work this out, meaning the Speaker McCarthy is going to have to make a decision at a certain point. Do I keep the government shut down, or do I push for a shutdown, or do I try and come up with a bipartisan package? If he moves forward with a bipartisan package, he could see a motion to vacate. He said language last week. He's like, look, I would welcome a motion to vacate me as Speaker, because I think if that would be successful, who would take his place? I'm not exactly sure if there's anybody that would want the job at this point. So, it's just unfortunately we're going to have to go through this every few months or every few years where, there's discussion on whether the government should be shut down. It doesn't save any money. It actually doesn't really help. The last one cost about $3 billion in GDP output, according to the Congressional Budget Office. But again, these policymakers won't make their decision to come to a bipartisan agreement until their backs are against the wall, and those backs won't be against the wall until they absolutely are, which probably will be, 3 to 5 days after a shutdown.
I don't know how you do this, Nathan. You got to deal with these people all the time and this whole policy all the time. You're our buffer. You're the guy we go to. We need to really figure out what's going on down at D.C. Nathan Dean, senior policy analyst, covering, yes, our U.S. government. Somebody's got to do it, and he does it for Bloomberg Intelligence. Hey, Matt, so I was listening and watching your conversation with the Mercedes CEO. It was interesting. They're cautious as it relates to the consumer, it seems like, cautious because their production numbers are pretty flattish, he was saying. But their positioning in the market, it feels like it's still as strong as ever.
Yes, and keep in mind, they're reaching up. So they don't care if production is flat. And frankly, I think Olo would tell you, probably not in a television interview, but he would tell you, I don't care if our production numbers drop a little bit, as long as they can boost margins. Because they want fatter margins, they want a better valuation. They're trading at 6 times earnings.
Right.
But they want to be valued more like a luxury player, more like an Hermes, more like a Ferrari, which is trading for 32 times earnings. You know, so they're hoping to get that valuation higher.
So how would you characterize their embrace of this switch over to electric?
They're doing it for very big ticket prices.
Yep.
The EQS that I drove was $129,000. And, that's for a family truckster, It's like a medium-sized SUV. But what they're saying is, look, we're going to drench it in leather. We're going to make it feel like a very expensive V8 or V12. And it's going to be the best experience you could possibly get. Whereas with the Tesla, you're paying that much for, a Model X or a Model S with all the bells and whistles, but they still feel Spartan in comparison. And then, they're going to make like the G-Class, which is like $140,000 to start. They're going to make an electric version of that, and I'm hoping to drive it. He just invited me over to Austria next month.
Well, that's a done deal.
To be the first driver. I would be
that.
The first person outside of the company to drive it.
Nice. I'll approve that ticket. You put that in there, I will sign off on that. Looking at the markets right here, S&P, we're getting a smidge of a lift here, up about 0.25%. The NASDAQ up 0.3%. With our news in New York City, here's Michael Barr.
Thank you very much, Paul and Matt. 5 Americans wrongfully detained in Iran have been freed today as part of a prisoner swap brokered by the Biden administration. Iran confirmed today that the final element of the deal, $6 billion in unfrozen Iranian funds, have been, as agreed, transferred to a bank account in Qatar. A deal the White House has repeatedly defended. This is not a payment of any kind. It's not ransom. President Joe Biden arrived in New York City last night ahead of the annual United Nations General Assembly. And while the president will be speaking, there will be some notable absences from the podium at the UN. Russia's President Vladimir Putin says he is skipping the General Assembly, but some of Biden's biggest allies, including the President of France and the Prime Minister of the UK, they are also skipping this year's General Assembly. Yesterday, climate activists marched through Manhattan, demanding the Biden administration stop any and all future drilling projects.
What do we want? Climate justice! When do we want it? Now! What do we want? Climate justice!
On Wednesday, a special UN climate conference will be held. The UAW strike against the big 3 automakers is now in its 4th day. Contract talks are expected to continue today. Picket lines are up outside a Jeep Wrangler plant in Toledo, Ohio. Brandy Kelly is a strike captain and auto worker at a plant in Detroit that is still operating. She drove to Ohio to bring pizzas to the striking workers.
We're trying to fight for all the same things. If I'm fighting there, they're fighting here. It's all the same fight. So come up and support. We're working right now. They're not. So it's a struggle for everyone right now. So just come up and support, the UAW.
Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Michael Barr, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom with this Bloomberg Business Flash. You have the S&P 500 fluctuating, airlines falling, energy producers rising, oil extending a rally, Apple leading the gains in the mega caps. Then you have Tesla dropping as Goldman Sachs lowered its earnings estimates for the company. The Treasury 10-year yields, they're hovering near the highest level since 2007. The Federal Reserve officials expected to keep rates on hold Wednesday. Traders are going to be focused on the dot plot summary of the economic forecast as the central bankers do battle inflation. Kimo Ek at AXA Investment Manager says there are no easy choices.
You want to kill inflation, especially when it started to get entrenched in wage negotiations. You probably need to engineer some sort of softening of demand. There is not a lot in the textbook that would tell you otherwise.
Right now, the S&P 500, 10 points higher. That's up 0.2%. 4460 on the index. The Dow Jones Industrial Average is up 67 points. That's a rise of 0.2%. We're at 34,684 on the index. And the NASDAQ 100 up 37 points. That's a rise of 0.2%. So at two New York City locations, Shake Shack is swapping out soybean oil for a cultured alternative that's made by a company called Zero Acre.
Cultured like yogurt?
Yeah, no, this is a sugar cane derived version of oil. So it's supposed to be healthier, environmentally friendly, and doesn't alter the taste of the food.
All right,
At least so they say. So
if it
we're
doesn't change the taste of the food, then
no.
I don't think I
Have you
care.
had the sodas up on the 6th floor?
I have
the new machines.
not.
Okay, the colas and the root beers, they're not the real thing. They are, and I've been told by the fellow who kind of manages our canteen up there that it is, in fact, it is not the name brand colas or the name brand, which it says. It's like some plant-based alternative. And I'm saying, it's terrible, dude. You're killing us. Can you just give us an old Coke machine like we had before?
I mean, I don't drink that kind of.
Once in a while,
That's
I like
bad
it.
for you.
There's a million things that are bad for me.
Very rare, because I feel like I'm just knocking diabetes down my throat when I drink a Coke.
Right. But just a Coke every once in a while, too much to ask. All right, let's move on to it. Let's get down to some business here, because I want to talk about the IPO market. We've seen a pickup here in IPOs here since the end of the summer here in September. But what we're noticing, we got ARM, and then we got Instacart, and we've got the other one that Bailey talks about all the time also this
plus
week.
there's the sports, the Wilson Rackets owner, Immerse Sports.
But what we're seeing is down rounds, coming public at a valuation below kind of your last private round, and that's not good. Akshata Balkari joins us. She's head of research at EquityZen. Akshata, when I was a banker, I can say clearly never did a down round. So I don't know what's happening out there, but it seems like companies now are willing to deal with that. What are we seeing in the IPO market today?
Yeah, thanks for having me on. Yeah, I mean, look, down rounds are kind of what's happening right now after all the higher valuations and the raises that we saw in 2021. I think companies are coming to realization about their actual valuation, and it's something that they have to deal with the reality of. We're already seeing significant discounts in the secondary market for these private companies. So going to IPO at a down round just shows that they're aware of the reality of the situation. And, it may make it easier for other companies who have been hesitant to go public with a down round to actually come into the market now.
How does it affect, private trading? Because don't you do that?
Yeah, I mean, yes, we do. We're our marketplace. We do a lot of secondary trading. I think it helps just to make sure that our investors can see that these companies agree with some of these down discounts that we see. We're seeing all of the late stage tech companies trading at 35+% discounts for their last round of funding, especially their raise during the high volume raise time in 2021.
35% discounts plus.
Discounts plus. It just depends on the company. And again, it has to do with the timing of their last funding round. If you're raised way before or if you're raised at the peak, it obviously makes a difference to where you're trading at now. So I think it'll make investors, at least in the secondary side, also more comfortable with understanding that these are the valuations. And this is how we're looking at these companies in the future as well.
So what did we learn from the ARM Holdings deal? I know it went public at 51, the high end of the range. That's good. It traded up to an intraday, got to like, I don't know, 69 or something like that. But here we are, we're off 4.7% today at just under $58 a share. Still above the IPO price, but so what do we kind of learn here from ARM?
Yeah, I think there was a lot of excitement for the ARM deal, right? You're looking at a deal that was very much oversubscribed by a lot of their own customers. And that showed a lot of interest and belief within the company and the AI kind of trajectory that was there. And I think that still exists for ARM. Obviously, that bounce is always exciting. And I think it, gave a lot of other companies like Instacart and Klaviyo the momentum to price the higher end of the range and be more sure that that's what those kind of offerings will be well received in the market. Obviously, that full jump up at 25% would put their PE multiple close to like north of 170. Well, Nvidia, which is like still a premium, has a multiple of 109. So you're looking at that was a significant pop. So coming back down a little bit makes a lot of sense in the nature of how ARM was actually priced and how that bounce really reflected off of it.
Do you think the success of Equity Zen and others like it reduces the need for IPOs? I mean, you give liquidity to employees who've gotten shares, right? So there's less pressure for an exit.
I think there's different ways to look at it. I think it definitely, if your company is looking to not have an IPO in the near future, having an option for providing liquidity is necessary for both the shareholders and from a consumer perspective to be able to get access to some of these private companies that you wouldn't have access to before. And I think Equity Zen does a particularly good job of that. But like having the IPO markets also come up creates that excitement in the private markets as well. Investors have been hesitant to come in, and I think a revived IPO market also helps signal and brings people into both secondaries as well as back into private investing and into the new IPOs offerings that we see.
Matt Miller is a big Birkenstock guy, loves the fashion. I know that company's coming public here. What can you tell us about that?
Dude, I gotta say, first of all, I shunned Birkenstocks for the first 48 years of my life.
Yeah.
Now I've tried them and I am a huge fan.
Really?
And guess what? My wife has some. I went to the beach this weekend. Everybody out there is wearing them, and not just the old leather Jesus sandals, but new funky colors. It is a hot product right now.
Really?
It is very trendy. And what is that, Akshata? Like a $6 billion business, right?
Yeah, the IPO was apparently could value more than $8 billion, and they're extremely comfortable. They were in the Barbie movie recently, very very popular. They're filing more than 2 years after private equity firm L. Catterton was valuing it at $4 billion. So that's almost twice the price that
No down round for Birkenstocks.
No down for Birkenstock, apparently. But we don't have definite figures on it yet. But it's very exciting to see them come into the market as well.
The pro tip is you got to be prepared for 2 weeks of pain.
Really?
Before you get to Pleasure Town with those shoes. Because they hurt a little bit.
Do you have the Jesus sandals? Is that what you're sporting?
I have the Jesus sandals, yeah. I have the old school, the Grateful Dead Birkenstocks. But my wife has the lime green, some kind of sustainable plastic version.
Really?
Yeah.
Boy, we're learning so much about you. Akshata, thanks so much for joining us. Akshata Balkari, she is the head of research for Equity Zen. Equity Zen is a platform for investing in late-stage technology companies while they are still private. So
you have no Birkenstocks?
Please, no.
And you've never owned a pair?
No.
I gotta say, I recommend checking it out. Dude, you never thought you'd like a pickup truck, and you never thought you'd like an EV.
And then I was out there driving.
Then you drove the Ford Lightning, and you loved it.
I did. It was awesome. It was awesome.
Yeah.
So we'll have to see. But yeah, that's just not going to happen. When your values were formed in '80s Wall Street.
Yeah.
It ain't happening.
Right. It's just like duck boots and squash rackets for you.
Exactly right.
Where's your Saab?
Yeah, right, exactly, the sob. SPX, it's up 0.25% here. A little bit of a lift here off of a flat market earlier in the day. Same for the Dow, up 0.25%. NASDAQ up 0.3%. WTI crude oil up 1.4%, $92. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Paul, you got to embrace the Birkenstocks. Come on. Good morning to you. Oil is pushing closer to $95 a barrel, being driven by strong demand and supply cuts by Saudi Arabia and Russia. Earlier this morning, Bloomberg spoke with Chevron CEO Mike Wirth about what $100 a barrel could mean for the U.S. and global economy.
Certainly, those are higher prices than we tend to see out over the long term, and so I think it will have some effect on the economy. But we've had relatively higher oil prices here now for most of this year and certainly all of last year. The recession that everyone's been talking about hasn't arrived, and so I think the underlying drivers of the economy in the U.S. and frankly globally remain pretty healthy.
And the shares of Chevron right now up about 1%. An executive of a cybersecurity company thinks he knows how hackers broke into the computers at MGM Resorts. Bloomberg's Kimberly Adams explains.
The chief security officer at Okta says the criminals probably tricked MGM's information technology help desk into resetting the multi-factor authentication settings of some highly privileged users. MGM Resorts isn't commenting on specifics. The company says it is working with the FBI and other officials.
Now, shares of MGM right now down about 0.7%. And Shake Shack testing out an oil that's said to be healthier and greener. The fast food chain swapping out soybean oil at 2 New York City locations for a sugarcane-derived alternative made by Zero Acre. That company says its oil version is more expensive than soybean, but has healthier fats. I'm Lisa Mateo, and this is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
That's right. Matt Miller, Paul Sweeney, live here in our Bloomberg Interactive Brokers studio. We are seeing markets trying to lift a little bit here. The S&P 500 is now up 0.3%. The Dow up 0.25%, and NASDAQ up almost 0.4%, to trying to get a little bit of a lift here as we get to the later part of the morning. Treasuries 2-year 5.05%, 10-year 4.32%, and a goal. And of course, WTI crude oil. Oil continues to move higher, 1.3% higher for WTI, just under $92 a barrel. We've crossed that a few times here today. With our news in New York City, here's Michael Barr.
Thank you very much, Paul and Matt. Officials say that 5 prisoners sought by the U.S. in a swap with Iran have flown out of Tehran and landed in Doha. That's part of a deal that saw nearly $6 billion in Iranian assets unfrozen. National Security Council spokesman John Kirby.
This is not a payment of any kind. It's not ransom. These aren't U.S. taxpayer dollars. And we haven't lifted a single one of our sanctions on Iran.
Despite the deal, tensions are almost certain to remain high between the U.S. and Iran. The countries are locked in various disputes, including over Tehran's nuclear program. Iran says the program is peaceful, but it now enriches uranium closer than ever to weapons-grade levels. Russell Brand is denying accusations by 4 women of rape and sexual assault between 2006 and 2013. The comedian and political commentator says he was promiscuous during those years, but not criminal in his relations with women.
During that time of promiscuity, the relationships I had were absolutely always consensual. I was always transparent about that then. And to see that transparency metastasized into something criminal that I absolutely deny makes me question, is there another agenda at play?
One alleged victim says she was 16 at the time. Hunter Biden has filed a lawsuit against the IRS. He is arguing that 2 agents violated his right to privacy when they publicly aired his tax information as they pressed claims that a federal investigation of Biden had been improperly handled. The lawsuit filed today says that his personal tax details shared during congressional hearings and interviews was not allowed by whistleblower protections. The suit comes days after Biden was indicted on federal firearms charges amid a long-running Justice Department investigation. President Biden is in New York City as the UN General Assembly begins today. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Michael Barr, and this is Bloomberg. Paul, Matt.
Hi, Michael Barr. Thank you so much. We appreciate that. We've been talking oil most of the day. We've been talking oil really for the last couple of months as it moves higher here off the recent lows. Brent crude today, $94.70. And we had Mike Wirth, the CEO of Chevron, on Bloomberg Television, speaking with Guy Johnson and Alex Steele. And he said oil is probably headed for the $100 mark soon amid tightening supply. So that kind of got my attention. And he said, quote, we're going to see record oil demand, all-time record demand, Wirth said. Consumption will expand by a couple of million barrels a day versus the prior year. So, I mean, that, talk about a push-up on inflationary pressures, Matt, because you'll see that at the pump. We are seeing it at the pump with regular gasoline at like $3.88 right now.
Yeah, so, I mean, the interesting thing to me is that he's saying they're seeing record demand, right? And he expects that to rise. So the question at these prices lately has been, is it the demand picture that's pushing them up, or is it the supply cuts that's holding them, that's underpinning those rises? Mike Wirth is saying it's the demand, so I think that's very interesting. That means, you know, that the economy is strong.
Yeah, and, you know, the city is out with a note early this morning saying that they think as we get closer to that $100 level, that's a level when you'll see some supply from some non-OPEC members come out in French Guiana, Brazil, some other countries that, and the U.S., the shale folks will get in the market. That might be an area that where they will come onto the market. Then maybe there push prices down, as Mike McGlone from Bloomberg Intelligence likes to say. The cure for higher prices is higher prices. So he expects supply to come on and push prices down going forward. We're going to have more coming up. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to get the latest on those markets. They are turning green out there. We're going to check in with our buddy Alex Semenova. She'll join us in studio. Also joining us in studio for Matt Miller's Davide Grasso, the CEO at Maserati.
He's coming for you too.
I don't know. I've seen Maseratis. I don't think I've ever been in a Maserati. Certainly haven't driven a Maserati.
Well, we've got to change that.
Yeah, maybe. And then following up on this whole auto thing, Kevin Tynan, he's a senior analyst at Bloomberg Intelligence. He covers, guess what? The auto business. We're going to talk to him about the strike and what's happening there and what it means for the auto companies. But let's kick things off this hour, as we like to do with Charlie Pellet.
Hey, thank you very much. And we are higher across the board with the Dow, the S&P, and NASDAQ all advancing on this back-to-work Monday. 13-point gain right now for the S&P at 44.64, higher by 0.3%. Just about the high of the session. We've got the Dow up 94 right now, up 0.4%. NASDAQ, the composite index, up 35 points, higher by about 0.3%. 10-year yield now 4.32% with a 2-year at 5.05%. Gold up $6 the ounce to $19.29, up 0.3%. Crude West Texas Intermediate closing in on $95 a barrel, up 0.7%. We've got Brent at $94.60. West Texas Intermediate crude up 1.2%, $91.90 for West Texas Intermediate crude. So to be clear, Brent, the global benchmark, at $94.63, up 0.8%. And again, WTI up by 1.3%. Bitcoin back above 27,000. Mercedes-Benz, meanwhile, keeping an eye on U.S. labor negotiations with 13,000 auto workers at GM, Ford, and Stellantis on strike. Our guy Johnson and Matt Miller spoke this morning with Mercedes-Benz Group Chairman Ola Kalenius.
We have been in the United States, in the southeast of the United States with our plant in Alabama and also our commercial van operation in South Carolina now for, in Alabama, more than 25 years, almost 30 years. And we have always kept lockstep with what's going on in the economy to make sure that we have attractive jobs. So we watch that and we make adjustments as we go along.
And you can hear more of the conversation on the Tate podcast. You can download it wherever you get your podcasts. GM shares now down 1.3%, Ford down 1.7%, Stellantis down by 1.2%. Again, recapping, we've got the 10-year 4.32% with the S&P up 12, up by about 0.3%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Matt Miller and Paul Sweeney live here in a Bloomberg Interactive Brokers studio. We're also streaming the video thing on YouTube, so just head over to youtube.com and search Bloomberg Radio, and that'll get you where you need to go. A little bit of green on the screen, kind of a lift from where we were earlier this morning. Let's check out where the action is under the hood with Alex Semenova. She covers the equity markets for Bloomberg News. She joins us live here in our Bloomberg Interactive Broker studio. Alex, what are you looking at?
Hey guys, so a stock that I'm watching right now is Clorox. Shares are down around 1%. That's after they said that unauthorized activity they detected in some of their IT systems last month will have a material impact on fiscal first quarter results.
Material. When I first read that
impact.
statement, I was prepared to see the word marginal.
Yeah, no.
But it's material.
They're apparently going to take a big hit on that. This caused substantial order processing delays and elevated the level of product outages. Clorox did say that it has resumed production at the vast majority of its manufacturing sites
They still just make
since
bleach,
the attack.
right?
I guess
it's a bleach
so.
maker.
I guess so.
So
Bleach
this
maker,
is a
but
bleach maker telling us that we've had real IT problems.
That's a problem.
Yeah.
yeah, well, I mean, cyber attacks are apparently becoming very widespread, and there are, companies taking a big hit. We had Caesars Entertainment just pay millions of dollars in ransom after a cyber attack. So it's becoming a big problem for companies. You can see that with Clorox, with Caesars. The SEC actually said starting this month, it is requiring companies to disclose most cyber attacks within 4 days of the incident.
It's interesting. interesting. I just, for these companies that have been around forever, kind of household names, old technology, old school kind of companies, I always like to go back and see when they went public. This company went public September 1st, 1983.
No, it's not that old.
No, it's not.
I would have thought Clorox bleach was from like the 1910s.
Exactly. That's what I thought. Goldman Sachs was the lead manager on a share price, $22.88. Stock's $145. So interesting to see that. But Clorox, Oakland, California.
Yeah, I guess people are finding some holes in these older companies and
I don't know. Hey, I know ARM is kind of one of the names you were looking at.
Yeah, obviously a lot of investors have been keeping their eyes on ARM. Shares are down around 5% today. That's after analysts at Bernstein initiated an underperform on the stock with a $46 price target. Basically, they said that it is too soon to declare the company an AI winner like so many people were hoping.
That was my point, and totally.
Yeah.
Yeah, because they designed the chips for phones and games, I guess.
Yeah.
And of course, you come public because you want to get that AI magic and get that AI valuation.
A repetition of NVIDIA.
Yes.
Is what a lot of people were
Yes,
hoping
and it's
for.
a little bit free. You have to take a leap of faith if you were buying this IPO on that, because while they do have some of that business, it's not really the big part of their business.
Yeah, absolutely.
Okay.
They also did cite that they're conservative on their ability to deliver increased royalty rates at the pace that management is guiding. So that was another factor in that underperform initiation.
Any other stocks we should be watching today, individual stories? I mean, I know Disney was a big story, and Apple was a big story. Now we got Clorox, and what else is there to care about?
I'm actually going to go a little big picture macro strategy and plug in a story that I wrote this morning, which is...
Always plug your stories.
Always got
Jess Menton is very good at that.
myself on the back a little bit.
Yes,
but
always do that.
This one was an interesting one. The title was Mike Wilson and Savita Subramanian agree on something, which kind of speaks for itself. Their price targets on the S&P 500 vary by around 400 points. So Savita has become quite bullish this year. She was one of the first people to turn on her outlook. Mike Wilson, of course, is a permanent bear, has kind of been doubling down on his expectations that recession risks are going to catch up to stocks. But they have some common ground, and despite the differences in their views, one thing that they agree on is that this is a stock picker's market, and it's better to be selective than just track the broader benchmark. So it's really interesting to see these two strategists who have very different stances on where the broader market will go share, this view that the S&P 500 has kind of seen its best days this year, and it's time to look for opportunities elsewhere. Savita Subramanian has said that the equal weight index is actually going to outperform the cap-weighted index going
SPW.
forward.
Yep.
Yeah, Bank of America said that apparently we are in the recovery phase of the regime, so that means that small caps, value stocks, a lot of the laggards of this year are actually going to be part of a rotation from mega caps and some of the winners. And Mike Wilson also said that it's time to be selective, and he sees opportunities in other areas of the market.
Great stuff, as always, Alex Semenova. She covers equities for Bloomberg News, joining us live here on our Bloomberg Interactive Brokers studio. Appreciate that. We're talking more cars, dude?
Yeah, it's a great day for cars.
It is a great day for cars.
Well, let's just say there's a lot of news, because there are some negative stories, right? That the strike continues to linger on. It's only day 4, but you've had some big offers out there. Stellantis, for example, offered a 21% increase in wages, and the union just batted that away. You've had, I think, 20% offers from Ford and GM, but they're demanding 36%, plus they want to bring back defined pension benefits, and they're also pushing for a 4-day work week.
Okay, I'm pushing for a 4-day work week. Nobody's listening to me.
We have talked to Ola Kalenius today, the CEO of Mercedes, and now we've got Davide Grasso in here, the CEO of Maserati. And okay, to be fair, obviously you're part of a much bigger group, Stellantis, and I'm sure you're not dealing with the strike yourself, as you're not producing cars, your Maseratis, on this side of the Atlantic. But does it have an effect on you indirectly? I mean, do you have supply chain problems if this drags on? How do you see it?
Well, great question. Directly, as you said, we don't have issues because we don't produce. It's 100% made in Italy, Maserati. Clearly, we're a global brand. And for us, North America is an important market. So we look forward to the resolution of this, because longer-term impacts would be on everybody. I mean, on everybody in every sector. So so far we haven't been impacted, but the long-term ripple effects it could be far-reaching for everybody.
All right, I got the new estate down on the Jersey Shore, right?
Yes.
Across the street in the driveway, not one, not two, but 3 Maseratis.
Wow.
Is that
Does
amazing?
Joe Walsh live across the street
I don't
from
know.
you?
Exactly. WD, talk to us about your business these days. Where are you in terms of your global business and in the U.S.?
Well, global business, we are experiencing a nice growth, fueled by the introduction of the new product that we launched over the last 18 months, I would say.
The Grecale.
The Grecale,
Yeah.
the SUV, and now we just released the Gran Turismo, which is hitting this market in these very weeks. And before that, we have the MC20, which represent a little bit the rebirth of the Maserati brand. As you know, Maserati was born on the track. So for us, having the MC20 going back from the street to the track, and we had the GT2 program, and then recently we just unveiled the extreme version of MC20, which is called the MC Extrema, that we unveiled at Pebble Beach, which as the Beast. So all this has generated the rebirth and the going back of the brand where it belongs. Which is epitomizing Italian luxury. The beautiful thing about the Maserati brand is that, you mentioned 3 in the driveway, because, you can find the Maserati for you. Like, there's a 2-seaters, there's a 4-seaters Gran Turismo. By the way, Maserati invented the segment of Gran Turismo. It's a trademark word that we've had 75 years ago, actually.
And now anybody has a GT car, right?
Yeah.
And that all comes back to you. How do you differentiate the GT from the MC20? Because they're both, 2-seaters, sports cars, right?
No, the GT is a 4-seater.
Oh,
the GT is the Gran Turismo is a 4-seater.
I did not. So,
and it's a very
so you're
comfortable
putting that
4-seater.
versus a 911, essentially.
There's different type of competitors for the Gran Turismo. I tend not to name competition, by having worked previously in different environment, including sports. You focus on our game, but it's true. You have 4-seaters as a competitor for the Gran Turismo. Gran Turismo actually was originated 75 years ago by the Maserati creativity, if you will. And ingenuity, because they basically put a coupe, but with the spaciousness of a sedan, and the drivability of a sport coupe, but with the plush comfort of a sedan, and that created the Gran Turismo.
That's why. I don't mean to compare it to a 911. I'm just saying it's among those class of cars where you say it's a 4-seater, but we're not putting a couple of adults in the back, right?
No, I'll be happy to drive you around, and you'll sit in the back, and you'll tell me how you feel after 2 hours drive to the Hamptons.
Wow.
Look at that.
That's a great offer as well. He's going to drive you to the Hamptons.
And he's going to drop you
I
off.
have driven the Grecale and the Trofeo. I had the Trofeo version, which is, I think, starts at 103 grand. Amazing car, and for me it was kind of a life-changing experience because I had previously shunned V6s.
Really?
But this power plant was everything in that car to me, and it's, I think, derived from the MC20, right?
It is, yeah. And the MC20 is powered by the Nettuno engine, which is, again, made in Maserati. Again,
Nettuno is from King Neptune, by the way.
Yeah.
He carried the Trident. Hence their,
Yeah.
Okay. Oh, that Maserati.
Yeah.
It's all tied
It all
in now.
comes
Okay.
together. It all comes together.
Thank you. Davide, who is your customer is there a typical customer, or is it different in Europe versus North America versus maybe Asia?
Oh, that's a great question. We, again, as we repositioned the brand and we started, so the results we're getting, and North America is on the forefront of this growth, because it's a critical market for us, where historically we had a great position, and now we're actually enjoying that history, but with new product and new growth spurts. So, we refocus the brand on its values, which are, it's Italian luxury and performance. Yeah. So we're focusing on a new luxury consumer, which is by nature global. So the mindset of the consumer is similar. The lifestyle of the aspirations, the type of activities are similar. So there's many more similarities between New York and Shanghai and London modern luxury customer than differences, right? And then there, of course, there's different regulations, different urban or suburban type of situations. But that's what is actually giving us the confidence that this growth path we're on is going to be a long-term growth. That's definitely it's our intention and our plans. We're a growth company. The other thing is the global luxury consumer is not looking anymore just for super sports cars or just for Gran Turismo, but they have a lifestyle for which they may need a medium-sized SUV. But, you know, just like you were saying, is, you know, you have certain needs or desire in terms of the responsiveness of the engine or the type of luxury experience you have as a driver or as passenger, not only in terms of materials, but also in terms of the digital interaction that you have with the car. So we put a lot of efforts also and focus on the digital driving experiences.
So this is a whole new generation, essentially, of
completely
Maseratis.
new, completely new.
How do you're trading within Stellantis, they own Maserati, but you should be trading at a much higher valuation. That is, they should be getting a lot more value from Maserati than they do inside the company. And they break out
investment banker now trying to
your
do a spin out
financials.
here?
They break out your financials, and they don't break out. Stellantis doesn't break out all of their brands' financials, but they do for Maserati. If you do well, do you see an IPO in your future?
It's a question it's a great question. It's a question that's been asked several times.
I'm hoping you'll give me a different answer.
To me, to CFO, and to Carlos Carlos Tavares, our CEO, group CEO. And the answer is like right now it's not in the cards. Right now the cards, we are focusing totally in really capturing the growth potential long term that Maserati has in order to deliver the high demands that a global luxury customer has. And we're focused on that. We're very pleased about the journey we've had. 4 years ago, we're in a very different situation as a brand, as a business, but we still have a long ways to go.
So how much can you grow? I mean, aren't you limited to some extent by unit sales? Isn't there a ceiling as far as how many you can actually sell?
It's a great question because it allows me to shift, to build on what you were saying. And when you work in luxury, the focus is not on volume. If you want to be healthy and delivering to the customer needs over the long term, you have to focus on profit. Without, and on quality, of course. So without quality, these are the two fundamental elements of our plan. Without quality, you don't have luxury. You know, quality brands, luxury brands, even in other fields, you know, normally are like 100 years old, and they were born as a high quality brand, right? And over time, you become luxury because you're very steady in delivering luxury. The other thing you need to do is you need to have your added value recognized by the customer in pricing, right? So we put a lot of effort in that and rebalancing and redefining our business model. And we have now a 9.2% AOI, adjusted operating and margin. And you know, our goal is there's no reason why we shouldn't be at 15% first, which is like benchmark, and above 15%. So that's what we're looking at. And the volume then is, could be a really dangerous trap to fall in the mindset, oh, I need to sell more, I need to sell better. We don't want to be much bigger, but we want to be recognized as the best in terms of, Italian luxury.
Real quickly, 30 seconds on your evolution to going electric. Where are you guys?
We're almost ready to actually have Maserati cars, electric cars driven in the roads. You know, by now and the end of the year, we're gonna launch the Grecale electric, and the electric version is Folgore. Folgore, going back to mythology, means lightning, and Folgore is the Maserati. The name that identifies Maserati electric, and then we also have the Gran Turismo electric.
All right, the next time we get you in, I want to figure out how you went from the sneaker business to the luxury automobile business.
You went, and before then, let's get you in a Maserati.
Yeah,
you
then
have
get me in a
drive the product before you interview the CEO next time.
Yeah, next time we'll do that next time. Davide Grasso, thank you so much for joining us. CEO of Maserati, joining us live here in our Bloomberg Interactive Broker studio. It's been a great card day for you, man.
Yeah, I've been enjoying it.
Yeah, we got it's just, I mean, you drive everything that's out there on the road, you might as well.
Well, I haven't driven the GT yet. I got to drive the GT.
Okay, we'll get you behind. I think we know.
And we didn't do the Joe Walsh joke. Have you heard the Joe Walsh song, Life's Been Good to Me So Far?
No.
He says, my Maserati does 185. You must know that.
It's a rock star. Yes, you do know that.
Okay, good.
All right, right now, let's go to Charlie Pellet, I believe. Is that where we're heading here?
And we have got stocks moving higher. The Dow, the S&P, and NASDAQ all in the fast lane right now with the S&P up 12. That is a gain of just about 0.3%. Dow Jones Industrial Average up 84, higher now by about 0.2%. NASDAQ, the composite index, up 32 points, up by about 0.2%. 10-year yield, 4.32% with a 2-year 5.05% right now. Spot gold up $4.50 the ounce to just about $19.28 the ounce, a gain right now of 0.3%. Brent crude oil, 94.56 a barrel, highlighting inflationary pressures just as policymakers prepare for interest rate meetings. But what about Brent heading to $100 a barrel? That question this morning for Chevron CEO Mike Wirth, who was interviewed right here on Bloomberg Markets.
Sure looks like it. We're certainly moving in that direction. The momentum, supply is tightening. Inventories are drawing. These things happen gradually. You can see it building, and so I think the trends would suggest that we're certainly on our way. We're getting close.
And you can hear more of that conversation with Mike Wirth on the Tape podcast. You can download it wherever you get your podcast. Chevron shares up 0.7%. ExxonMobil up 1%. BP, the ADR, is down 0.3%. Among some of the other names, EOG Resources up by 0.2%, and Pioneer Natural up by about 0.5%. Apple shares are higher. Some analysts positive on the stock about early signs of demand for the latest iPhone. Apple shares up now by 1.9%. Recapping, stocks higher. S&P up 12, a gain of 0.3%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Matt Miller and Paul Sweeney live here in our Bloomberg Interactive Broker studio. We're also on that streaming thing, youtube.com. So head over there and just search Bloomberg Radio, and that'll find you. You'll find our feed there. Kevin Tynan joins us, senior automotive analyst for Bloomberg Intelligence. Hey, Kevin, I'm thinking about this strike here, and as a Wall Street guy, I'm usually kind of pro-business, but boy, the auto workers got some good points here. I mean, they gave up, it seems like a lot during the great financial crisis, and then the pandemic they came in. From the automaker's perspective, what can they really afford?
Well, look, I think the issue for the union is that, look, we've seen you make a lot of money over the past, really since that period, since the bankruptcy period, 2008, 2009, even into 2010. And they can't hide that. The manufacturers can't hide that. I think what they're going to try and get out of these negotiations, the manufacturers, that is that flexibility to adjust capacity and headcount going forward, because even though they've made more money, the production, especially in North America and U.S. specifically, is down significantly. So the idea that the manufacturers kind of pay up for their earnings through these contract negotiations also has to include the idea that, hey, if we move to a smaller market, which is what has happened, and especially if electrification means fewer unit sales, as that volume declines, you have to have that flexibility to take out headcount or production capacity going forward.
So there is a pretty big bid-ask spread here. I mean, I guess the auto companies are talking about a 21% increase, and I think the last proposal from the unions were something like 36%. If you had to guess, I mean, do we just do a simple split the difference, or is there a level upon which when these big folks in Detroit look at Elon Musk and say, I can't compete at 36% increase?
Yeah, that it is going to be difficult. But again, if that flexibility there is to adjust to a market that is, 15 million units a year going forward, but at $52,000 in an average transaction price, the revenue pool is actually larger, even though the unit volume is down. So I think what you're going to see is the ability to pay up So if I had a bet, I would say that the likelihood is that the union gets closer to their number than what the manufacturer is willing to give. But again, that flexibility on the other side to say, yeah, if this is a 15 to 16 million unit market going forward, where we're used to 17 plus, then we have to have the ability to close plants, take out some headcount, and adjust to the market going forward.
I mean, maybe they'll be able to give a huge raise in wages as cover for getting that kind of flexibility from the UAW. Because, you hear numbers like 20% and you think that's probably going to break these automakers. But it's not, because people don't realize how small a percentage of the cost labor actually is, right?
Right. And again, that 20% or 40% or whatever it ends up being is over the 4 years of the contract. So it's not immediately all at once. The other one is going to be the signing bonus for ratifying the deal, which would be a nice number. But really, that's what the manufacturers have to give, is to give back some of that profitability they've earned over really the past decade, or since the bankruptcy period. That's what they're going to be able to do. But ultimately, the idea of having too many workers or pensions and legacy costs going forward, that's where the manufacturers, that's where it would hurt them, not so much in the hourly increase in the wage going forward, because you can cut costs, right? You can increase revenue, which is what's happening as mix shifts to truck from car or to electric from internal combustion. But you have to have the ability to right-size your business going forward.
So do you think, I guess just the question, I think I would guess if I were an investor considering, any one of these auto companies, is just, do I think these companies can generate better, worse, or the same returns in an electrified world versus internal combustion world? Do you have a view on that?
Yeah, I mean, so far it looks like worse.
Yep.
And I think what we're starting to see is a little bit of pushback on that. And I've been saying this for years, is that the U.S. is behind in EV adoption, not because the consumer does or doesn't want it, or it's expensive, or it's just not as profitable as the business that the manufacturers have been doing forever, which is an internal combustion. So the idea
even if they get if they get the development costs behind them, and I mean, Tesla's running 18% margins, right? So they're super profitable.
Yeah, but you're talking about regulatory credit sales. You're talking about deferred revenue from full self-driving, right? And when you look at their gross margins or, operating margins even, they're not as profitable as, they're not the most profitable in terms of margin of all the automakers either, right? They're kind of middle of the pack when you adjust everybody onto the level playing field. So the idea is that, you've had things over the years, right? The mix shift to truck from car, which I've been talking about for 10 years, that's profitable on day one, right? And that's why that shift has happened. Now what you're looking for is, when does this get profitable? Now, I've been saying, if you look at software and subscription and services, that's profitable on day one. And I think that's going to be your profit bridge going forward until the if EV is as profitable as internal combustion. And I think that's why you're starting to see a little bit of a hedge in terms of, why don't plug-in hybrids make more sense these days? And now we're starting to see some of that come into the market. Toyota, Lexus has been talking about it for a long time. And even consumers I talk to are asking me, like, why isn't that more of a thing? We don't have to worry about charging infrastructure. We don't have as high a cost as a consumer. So I think the market's kind of taking a step back from the singularity of either internal combustion or full battery electric to the steps in between.
So, but Kevin, I know you're, as big or bigger car geek than Matt Miller here. Can you tell me, what is the demand out there, the real demand out there for EVs? Do people want them, or do people feel like they're kind of being pushed upon them?
I think shoved down their throat is a good way to put it.
Well, look, I mean, I go a lot of places and I talk to a lot of people, and especially at the dealership level. And I have dealerships come to me all the time at these, I'll speak at a convention and I have people, and I talk about the average transaction price relative to internal combustion. I have people, from the middle of the country come to me and say, look, my dealership is in an area where, household income just can't afford $50,000, never mind $65,000 for an EV. So what are our people supposed to do? So I think there is a little bit of that. But, look, I'm one that says the consumer will go where the manufacturers need them to go because they're the ones producing the vehicles, right? If we had manufacturers who didn't care about profitability or, thought that the idea was to move to electric, even if it were unprofitable, that's what consumers would get. So right now in this country, if the government isn't penalizing the manufacturers or subsidizing them, and it falls to where profitability is best, that's what automakers are chasing right now. So from the consumer's perspective, it almost doesn't matter what they want or what they prefer. They can't buy what a manufacturer doesn't build, and a manufacturer is not building what's not profitable.
I'm gonna go somewhere else real quick. So I had a truck that had some problems, and there was a catastrophic event, not of my doing, right? And a dealer friend of mine said, you got a Monday truck. I said, what's that? He said, well, it's probably built on a Monday when everybody came in hungover and wasn't paying as much attention. Now, I push back a little, and I say, I've met a lot of people on production lines at many different brands, and they tend to be responsible adults, professionals who take pride in their work. So I don't really buy that as much. But I just got my Challenger built. I just got an email.
Nice.
My Dodge Challenger RT Scat Pack wide body in Fate Green has been built up in Canada, and I put it on. I'm so excited. I put it on the Challenger forum, and they said, "Man, you don't want to buy a car around these strikes. Everybody's in a bad mood. Maybe they're knocking back some beers before work." What do you buy any of that kind of mythology around the wrong time to buy a car or get a car built?
Look, I would say there was a period through the pandemic. My son and I, he's also a big car guy, we talk about that. Like, we wouldn't buy a 2020 model year or, and I'm not, and look, the whole chip shortage thing, not that it wasn't real, but, look, there was issues where vehicles had to be decontented because you just didn't have the chips, right? Or, features or options were just lower just because if there is a finite amount of chips, you're putting them in your high-end vehicles, and then some content gets left off of everything else in the portfolio. So I think there's more that than the actual worker saying, it's Monday, I don't feel like doing this well. But yeah, there's periods, look, and I think the other one to note is, I started talking about bankruptcy being inevitable in 2005. So automakers see that now investment kind of stops, right? You get in defensive, like, let's save some cash. So, for me, that period from 05 through the bankruptcy is, there wasn't a lot of good investment happening.
All right, Kevin, thanks as always. Kevin Tynan, Senior Automotive Analyst for Bloomberg Intelligence. Right now, let's head down to Washington, D.C., World and National News with Nancy Lyons.
Thanks, Paul. 5 Americans are on their way home as part of a prisoner swap that will return 5 Iranians to Tehran that had been held here in the U.S. The deal also allows Iran to access $6 billion of its oil money that was frozen due to sanctions. Speaker Kevin McCarthy is making it clear he does not want the government to shut down on Republicans' watch, but that does not mean it will not happen. Over the weekend, a deal was reached by House Republicans on a continuing resolution, or CR, that would keep the government running in the short term.
McCarthy's been trying to bring his rebel faction into line, but it's not working, Greg Valliere, political analyst for AGF Investments, said in a Bloomberg interview.
He's on really thin ice. I don't think he can get a deal before the October 1 deadline. These people are on a different planet from you and me, so we do have a shutdown. We're not going to kill Social Security and Medicare benefits, but if you want to go to a national park, you're out of luck.
It could be well into the holiday season, Valliere said, before the issue is resolved. In Washington, Irv Chapman, Bloomberg Radio.
Ukraine's President Volodymyr Zelensky will be holding meetings and lobbying for more financial support this week as world leaders gather at the United Nations. He'll also be bringing his message to Washington, where he'll push lawmakers to approve an additional $24 billion in aid proposed by President Biden. Bloomberg's Anne-Marie Hordern says it'll be a tough sell for Zelensky.
How does he convince Republican lawmakers that at the moment are still unnerved and concerned about sending more taxpayer dollars to Ukraine that they should pass that bill. Remember, the U.S. administration, the White House, asked for in a supplemental spending bill more Ukraine aid, and that Ukraine aid was missing from that CR that the Republicans were discussing last night in a phone call.
Bloomberg's Anne-Marie Hordern reporting. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:40 on Wall Street. We do check markets all day long at Bloomberg with the Dow, the S&P, and NASDAQ pushing higher. S&P very close to session highs right now, up 14 points at 44.64. That is a gain of just about 0.3%. The Dow up 92 now, up by 0.3%. NASDAQ, the composite index, up 38, up by 0.3%. 10-year yield at 4.32%. We have got the 2-year now yielding 5.05%. Spot gold up $6 the ounce to $19.29, higher by about 0.3%. While West Texas Intermediate crude is up 1.1%, $91.76 a barrel. Keeping an eye on Brent at $94.64. Brent, of course, the global benchmark, up now by about 0.8%. Wall Street is looking ahead to Wednesday's Fed decision, and we will likely be getting more insight into the path of interest rates later in the year and into 2024. Joanne Feeney is a partner at Advisors Capital Management, and she was interviewed this morning on surveillance.
I think this week is a non-event when it comes to the Fed. Everybody recognizes they're going to pause. But there are a lot of risks to work around as an investor, not just the labor strikes over at the motor companies, but also the government shutdown that's likely coming by the end of the month.
And you can hear more of that conversation on the Surveillance podcast. You can download it wherever you get your podcasts. As for those automakers, shares are lower across the board right now. General Motors down 1.4%. Ford is down 2%. And day 4 of the strike now, we have got Stellantis shares down by 1.3%. Again, recapping, stocks are higher with the S&P up 14, up by about 0.3%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Brokers studio, also streaming live on YouTube, so check it out there. Search Bloomberg Radio. Talking about ESG investing, it's been a thing for maybe 15 years. It's become a little politicized here in the United States, not so much in the rest of the world. Still very big driver, sustainability. We talk about all of it. Here's another way to think about it. Marina Severanovsky, she is head of sustainability in North America for Schroders, the British bank. Marina, thanks for joining us live here in our Bloomberg Interactive Broker studio. In your notes, I learned something new. Natural capital. What is that?
Yes, thank you. And thank you for having me. So natural capital is, what you would imagine, it's sort of the atmosphere, it's fresh water, it's oceans, it's land, but we translate that into what we call ecosystem services. That's the phrase. So that's like pollination, water purification, sequestering carbon. And those things obviously have a benefit to business and to society, but it's something that we don't price very well in the market. And so those of us who are investing here are thinking about kind of what is the value of those ecosystem services. Roughly, we say about half of all GDP, so $44 trillion, is directly dependent on these ecosystem services, on, let's say, water, for example, for a beverage business. And the overall value of ecosystem services annually is about $140 trillion. And that's, we only pay for about 1/40th of that in the market.
So what are some examples, for Schroders, for your investment teams, is it your role to kind of overlay this type of analysis onto what some of these PMs and what the teams are doing?
Yes, exactly. So it sort of goes from two directions. One direction is risk. We need to know that companies understand the risks of their dependencies, their reliance on nature, and if something over time goes wrong, if you have to pay more for these ecosystem services. They also have to be wary, these companies that we invest in, of sort of ongoing regulatory change and also society's expectations. So they have to disclose more information over time, and again, they have to pay a higher price for the use of some of these things that have been kind of in the public commons. And then the other side is just opportunities. Where do we find an opportunity around companies that are doing this better than others? They're managing their risk better, so therefore they will be rewarded for that. Or companies that are providing actual solutions that will have a tailwind. Or even direct sort of nature investment, which provides carbon credits. So this is Climate Week in New York. Everybody's very focused on, obviously, climate change. One of the major solutions, in effect, to sequestering carbon is nature. Nature is our best carbon capture technology, but it's very underinvested in. And so that's another thing that we focus on as investors. How do we bring money to that?
What's an example of a company that you've invested in because under this framework, and maybe what's an example of a company that just didn't screen well.
Yeah, without specific names. But,
Okay.
you know, if you can imagine, again, sort of companies, every company we think that is reliant on some of these things, and that's most companies, should have a biodiversity policy, right? They should, you know, think about this at the board level. They should be aware of how they, let's say your water, right? You're thinking about how your usage of water. You're thinking about how to reduce water usage. You're thinking about kind of the impacts to local communities, right? So all of those sorts of things. So, you know, again, like a beverage company might be a great example of something like that. But, you know, there's a lot of things. Another focus that we have where we might avoid investing in a company, and this is a big initiative for us, is deforestation.
Okay.
So commodity-driven deforestation, things like beef, pulp, soybeans, oil, those things are very damaging. And again, there's a huge cost over time with more regulation around that. And so we've committed to removing from our portfolios companies that promulgate sort of commodity-driven deforestation. That will be done by 2025. Now, we're engaging with those companies. Most of them understand those risks, and they won't be left behind, but probably some will be. And they become just too risky to invest in because of all the potential associated cost.
How does your framework kind of tie in, again, natural capitalism, tie into this, the ESG? I'm not sure if it's broader ESG, but just ESG in general. Is that the E in ESG?
It's one of the E's, yeah. So you have environment would roughly be kind of climate and nature, and I'll say that, you know, a moment on that, and then, you know, social, and then kind of governance. So the climate and nature, I think there's been a lot of focus. Everyone's sort of talked about climate change and net zero. Nature is not a separate thing. Both climate change and depletion of nature drive from the same source, which is the human overuse of sort of finite resources. And as I said, in part, nature is a major kind of solution. About 30% of the overall solution to climate change in terms of being able to take the carbon out of the atmosphere will come from forests and peat and oceans that can kind of pull the carbon back in. But we have to make sure that we don't cut the forest down, right? We have to make sure that we preserve those things. So I think we tie those together and we say that when we focus on healthy natural systems and biodiversity, it also, as an ancillary benefit, helps us with the climate change challenge. So we want to tie those things together.
ESG investing, broadly defined, I first heard about it 15 years ago when I was talking to my European clients. And then I brought it back. I was like, what is all this ESG thing? Now it's obviously huge. But I would guess a client meeting for you in London talking about this topic and a client meeting in, say, Dallas, Texas is probably different. Talk to us about the politicization, I guess, if you will, of ESG in the U.S.
Absolutely. So you're right about it being about 15, 16 years old. We actually wrote a piece earlier this year and said it's a teenager, you know, like this is a tough time. You know, you're trying to get driver's license, you have acne. It's in transition. What I would say, yes, I think in other parts of the world, in Europe, in the UK, it's just a given. There's a lot of regulatory pressure there too, so companies are disclosing this information, investors are expecting it. There's this sort of understanding that if you understand companies better via this additional information about their risks and opportunities, you'll be a better investor. That's kind of the baseline. When I started in the role at Schroders, I wrote a piece on ESG through a U.S. lens, and the things that I talked about were actually this kind of nature and focusing in not on the argument over who caused climate change, but what we want for our kids and their kids, which is a healthy, clean environment, right? So kind of making it less political and more about kind of what can bring us together. And then I talked about not forgetting the social side. So when you say there's going to be transition and change in climate, that obviously impacts people, their livelihoods. And so if you don't address that, if you don't talk about a just transition, a transition that addresses the folks who work, let's say, in fossil fuels today or communities that are dependent, that's a problem. And then the third part, and this is maybe the most relevant here, is I thought about the American psyche, which responds very poorly to sort of gloom and doom and shame and sacrifice. I think Americans want to have a positive conversation about where they can have opportunity. So if you say, look, a lot of money is moving from here to here, don't you want to be on the right side of that? These are exciting opportunities to invest early, or I mean, not even so early, in real solutions, right? The governments around the world, by the way, 90% of global GDP is now under a net zero commitment. So governments are clearly moving along. You want to be part of that as an investor. So rather than sort of really a negative story, it's all, you know, terrible, it's that kind of positive, where do we find that opportunity to frankly, profit?
All right, absolutely. That's good stuff. Appreciate it. Marina Severanovsky, she is head of sustainability for North America for Schroders, a UK-based firm. Great firm, been around forever over there in the city of London. So we appreciate it. Looking at the markets right here, the S&P 500 up 0.3%. NASDAQ also trading higher, so we'll keep an eye on those markets. We're going to have more coming up. This is Bloomberg. Let's get some company news right now. Lisa Mateo.
Thanks, Paul. The strike against the big three automakers enters its fourth day, and both sides still remain far apart on wage increases and job guarantees in the EV transition. Earlier this morning on Bloomberg, Mercedes-Benz chairman Ola Kalenius was asked how the work stoppage affects his North American business.
We don't expect any major impact on our business. And of course, Mercedes-Benz doing business in more than 150 countries and have operations in all major economic regions. We try to make sure that we're competitive, that we're an attractive employer. But at the same time, we're in transformation. The auto industry is getting more competitive, not less competitive.
Shares of Mercedes right now down nearly 1%. Tesla plans to expand in the Middle East. That's according to a report from the Wall Street Journal. Bloomberg's Valerie Teitel has more.
The government of Saudi Arabia is in talks with Tesla about setting up a manufacturing facility in the country. This is according to people familiar with the matter. The talks are at a very early stage and could fall apart, the Wall Street Journal notes. But if they are successful, a deal with the Saudis and Tesla could help Tesla realize those aspirations to sell 20 million vehicles by year 2030.
Now, Saudi Arabia already has an existing partnership with Tesla's electric vehicle rival, Lucid Group. Tesla shares right now, they're down about 2.5%. And Macy's is ready to hire for the holidays. The retailer says it plans to bring on more than 38,000 full and part-time seasonal positions. It's at its Macy's, Bloomingdale's, Blue Mercury stores, and also at its distribution centers. Shares of Macy's right now down about 3%. Those are the company stories we're following this hour. I'm Lisa Mateo. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, looking at these markets here with the S&P 500 up 0.3%, NASDAQ up about 0.2% here. Looking at it here at 12:55 Wall Street time. Looking at the yields, 2-year Treasury still getting over 5%, 5.05%. In the 10-year, we're getting 4.31%. WTI crude oil, not quite as high as it was earlier, now at $91.22, up 0.5%. It had breached that 92 level, so we're keeping an eye on that move in WTI crude oil and Brent for that matter as well. Let's head down to D.C. right now. Nancy Lyons has got world and national news for us.
Thanks, Paul. 5 Americans are now free after a prisoner exchange between the U.S. and Iran. President Biden is applauding the agreement that led to their freedom that also involved the release of 5 Iranians in U.S. custody. He thanked the leaders of Qatar and Oman for helping facilitate the agreement that also includes freeing up $6 billion in frozen Iranian assets. Well, it's day 4 of the auto workers' strike with little to no progress made over the weekend. Stellantis did bump its pay hike offer to 21%, but that was quickly rejected by the union. Bloomberg's Detroit bureau chief, David Welch, says some of the union asks will never be met by the big 3 automakers.
They're willing to move on pay, obviously. They're already up over 20%, and I think they'll continue to bump that, not interminably, but they will. That's something they can play with. But those other retiree benefits and a 32-hour work week, I don't think they'll budge on either one of those.
Bloomberg's David Welch reporting from Detroit. Hunter Biden is suing the IRS, claiming so-called whistleblowers illegally disclosed information about his taxes. Bloomberg News legal reporter David Voriakis explains why Hunter Biden and his legal team believe the 2 IRS employees do not deserve whistleblower protections.
Essentially, they're saying that most whistleblowers uncover government misconduct and not the details of an employee's opinion about the alleged wrongdoing of a private person. That's how Hunter Biden argues it in the lawsuit. And that in this case, these 2 investigators are not normal whistleblowers and presumably are not entitled to the same sort of whistleblower protections.
Again, Bloomberg's David Voriakis. A federal judge in Georgia is hearing arguments today from former Justice Department official Jeffrey Clark, who wants his election interference case moved to federal court. The judge has already rejected similar efforts by former White House Chief of Staff Mark Meadows. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Paul and Tim.
Hi, Nancy Lyons. Thank you so much. We appreciate it. Well, our good friend Belly Lipschultz at Bloomberg News has got an interesting story out today on the IPO market. Instacart and Klaviyo reacting to the strong reception of this year's biggest IPO, have increased the amount of money they want to raise with the goal of bolstering their cash positions while driving an opening day pop. The first test comes Monday with the pricing of online grocer Instacart's initial public offering, which may raise as much as $660 million. Klaviyo, a marketing and data automation provider, may follow suit this week, targeting up to $557 million. The debuts aim to continue a recent trend of IPOs that generate buzz and strong gains in their first day of trading after an 18-month-long dormant market. ARM Holdings, that jumped 25% last week after the biggest U.S. IPO since November of 2021. Even with Instacart and Klaviyo's higher targets, Wall Street still sees the valuations as modest, with bankers coaxing companies to meet would-be investors at prices seen as attractive. Of the 10 companies that raised more than $300 million through IPOs on U.S. exchanges since May, the median stock generated a 26% climb on the first day. That's data compiled by Bloomberg. That's serving as a signal that investors are getting the action they want while companies can get much-needed deals done. So again, we'll look at Instacart after the close today, so it'll be very interesting to see how that plays out. And on the markets, you know, we've got the little bit of a green on the screen here. The S&P 500 up 0.25%, same for the Dow. NASDAQ up about 0.2%. Gold, that is up a little bit, $1,930 an ounce, and energy continues to move a little bit higher. WTI crude oil up 0.5%, $91.23 per share. Sound on with Joe Matthew from Washington, D.C. That starts right now.